Hello, hi guys. This is CA Balakrishna Kovuru. Welcome to CA Inter Audit marathon classes. So before you start watching this marathon session, I just wanted to communicate with you people how you can best utilize these marathon sessions and how we will be taking forward these marathon sessions. Okay, so first of all, coming to applicability of this marathon class, see, it will be applicable for all the attempts from Jan 2026. Okay, if you are preparing for Jan 2026 or May 2026 or further attempts, for all the attempts, this classes will be applicable. So if at all in future any changes come, I'll make the updates and I'll keep. Okay, until and unless I upload any new marathon session, if you are watching, this will be the applicable marathon session for your attempt. Okay, so that is the first point with respect to applicability of these classes. Next, which book we will be using in this classes? So I have prepared summary chart book I have prepared. We will be taking up these revision classes completely from those summary chart books. Okay, so these are the summary charts which I will be using in the class. Okay, that is with respect to the book that we will be using. And coming to, see, this video is the first part of marathon session. This will be around 10 to 11 hours. After this video you will also get a second part. So these marathon classes will be in two parts. Okay, first part will be around 10 to 11 hours. Even the second part will also will range in that time around 10 to 12 hours. You will find the second part also. Now, in this first part that you are watching, what chapters get covers? So these are the 7 chapters that we will be covering in this first part of marathon. So if you see, I have arranged the chapters, I have arranged the standards such that it will be very easy for you people to follow the flow. Okay, I have arranged in such a manner that it reflects the practical way of how the audit will be done. If you see the flow in which chapters are given in the ICA study material, it will be a little bit confusing and a little bit difficult to study in that flow. So I have just rearranged the flow of chapters. Okay, so here in this particular first part we will be covering these particular chapters. Firstly, nature, objective and scope of audit. This first chapter it will be same here, and even in the ICA study material also this first chapter it will be same. I haven't done any alteration to this. Okay, see, whatever the content is there in the ICA study material, same exact thing we will be discussing here. I will not be skipping even a single point or a single concept also. Only the thing is, I have just rearranged the rearranged the chapters for the purpose of clarity of understanding. See, only if you have a proper flow, you will be able to properly understand it, right? So that's why I have rearranged them to bring a proper flow. Next chapter will be ethics and terms of engagement. Here we will be covering essay 200 and essay 210. And third chapter, essay 300, we will be covering. Fourth chapter is risk assessment, 315, 320, 330, 450, 265. These things we will be covering. And fifth chapter is essay 700 to 710, complete reporting aspect including CARO. And finally, evidence, essay 500 to 530 and 230. So these 7 chapters we will be clearly seeing in this particular marathon session. See, for the name's sake, these are marathon session, revision session, but I have given 100% conceptual clarity in these sessions also. If you once watch these sessions, you will get to know, okay, I haven't compromised on any concept understanding. I have tried to give utmost concept possible in these classes also. Understanding? Yes. See, apart from this, there are some individually recorded classes that are available on my channel. I haven't just attached them and kept here. This is completely newly recorded marathon session. Understanding those individually available chapters are different, and this is a completely newly recorded marathon session where I have tried to give utmost concept possible in a little bit of time. Understanding? Yes. So these 7 chapters we will be covering in the first part of marathon session. After this, I'll also be uploading the second part of marathon session where we will be covering the remaining chapters. Understanding? Yes. So this is the flow in which we will be covering the entire, we will be revising the entire chapters. Got it? Yes. Next, coming to the book, sir, this summary chart book that you have used in the class, where can we get? See, I have made hard copy, okay, hard copy of these summary chart book, which is completely a color book. Okay, this is available on our website. You can, okay, the link for this I will be giving in the description. Okay, you can take this summary chart book from there. Got it? Yes. So this is about the upcoming marathon session that you are going to watch. Okay, these things I wanted to communicate with you people. Now you can start watching the marathon session. All the best. Hello, hi guys. Welcome to CA Inter Audit marathon session. So through this marathon session, we will be revising the concepts, the chapters of CA Inter Auditing. See, for the namesake, these are marathon sessions, but I will be giving you complete conceptual clarity. Got it? So before starting the first chapter, so first of all, the name of our subject, auditing, right? So what is meant by audit? Generally, the financial statements are prepared by management, and management is also involved in day-to-day operations of the entity. So if management has committed any frauds in their day-to-day operations while preparing the financial statements, they might cover up those frauds. Such a possibility exists, correct or not? So to give confidence to the users that in the financial statements there are no frauds, there are no misstatements, to give such a confidence, management will appoint, not the management, users, that is the shareholders will appoint the auditor to do the audit of a financial statement and give confidence to the stakeholders, right? So confidence means, the technical term for the confidence is assurance. We will be discussing what is meant by that assurance. Okay, in this first chapter we will be covering it, right? So this is basically the purpose of audit. Purpose of audit is to give assurance to the stakeholders. Stakeholders will be all shareholders, employees, creditors, government, all these people will be the stakeholders, right? This is a basic requirement of why audit will be conducted, right? Now we will start discussing the first chapter. See, we will be revising through this chart. See, all the content that you will find in your ICA study material will be present in this chart. I haven't missed any of the content. 100% content you will get here. Got it? So starting with origin of audit. So where did you can find the reference to the word audit for the first time? So if you see in the 4th century BC, there is a book written by Kautilya, and the name of the book is Arthashastra. So that is the book where you can find the origin, the reference to the term audit for the first time. And this term audit is derived from a word audire, which is a Latin word. Meaning of this term audire is to hear, because in the olden days accountants used to auditors used to listen to the accounts that were read by the accountants. So the word audire has been renamed, or the word audire has been used to derive the word audit. Understood? Yes. Next, the first Auditor General of India was appointed in 1860, that is during the British time. Actually, the present day C&AG is there, na? Comptroller and Auditor General of India, who will take care of audit of public sector accounts. This C&AG has come from this Auditor General only. So the name Auditor General is renamed to C&AG. got it? And to govern the profession of chartered accountancy, see, because audit, it is exclusively reserved only for the chartered accountants. Chartered accountants will do the audit. So to govern the profession which does the audit, a body by name ICAI has been established by government, right? So this is a brief intro about the audit. Now coming to meaning of audit. See, generally audit means verification. Generally understanding audit means verification, but in the examination you can't write that audit means verification. You need to write the technical definition, right? So what is the technical definition for the term audit? Let us see. So audit means independent examination of financial statements. Here you need to observe the term independent. So the auditor, he must be independent. Independent means the judgment of the auditor should not be dependent on the management or any other person. That means there should not be any biasedness when auditor makes any decisions. Understanding? So judgment of the auditor should not be subordinate to the will and wish of the management or the other party. So if auditor's decisions are made without compromising, without dependent on the management or other person, then you will say that auditor has exercised independence. So the audit should be always a independent examination. Got it? So it is a independent examination of what? Of financial statements. You will audit financial statements in case of audit, and whether such entity is a profit oriented or not. So whether you are earning profits or your purpose is charitable purpose, in both the situations audit is required. Correct or not? You can't say that I am not established for the purpose of making profits, I am a charitable organization, so I will not get my books of accounts audited. You can't say like that. You have to get your books of accounts audited, whether you are a charitable organization or a profit oriented entity, irrespective of its size or legal form. Size means whether you are a 1,000 crore company or you are just 1 lakh revenue earning company. In both the situations audit is required. And legal form, that means if you are a company, audit is mandatory as per Companies Act 2013. If you are a partnership firm, then Partnership Act has not mandated any audit. But if your turnover crosses 1 crore rupees, then tax audit becomes mandatory to you, right? So the definition of audit, it doesn't change whether you are a partnership firm or whether you are a company or you are a sole proprietor. The definition of audit is always same. It is always a independent examination only. Getting it? And when such an examination is conducted with a view to express an opinion, so the output of audit, the final output of the audit is you will express the opinion in the audit report, right? So this is the definition of audit. What is the definition of audit? It is an independent examination of financial statements, whether profit oriented or not, irrespective of legal size, irrespective of legal form or size of the entity. When such an examination is conducted for the purpose of expressing an opinion thereon, right? So during the audit you will verify certain aspects. So some of the points that you will verify during the audit, let us see some of the examples. So you will verify whether financial statements have been prepared as per books of accounts or not. So accounts are drawn up as per the books of accounts or not, you will see. Next, in the books of accounts there will be entries passed. For each and every entry there should be sufficient and appropriate audit evidence. That also you will see. So if you are passing a entry, sale entry, there should be a sufficient document to support that sale entry. That also auditor will see, right? Entries in books of accounts are supported by sufficient appropriate audit evidence. And no entry should be missed from the books of accounts. Let's say during the year you have made a sale of some 10 crore rupees, then all the 10 crore rupees worth sale should be shown in the books of accounts. There should not be any omission, right? No entry should be omitted. And information that is presented in the financial statements, that should be clear and unambiguous. That means users who are reading the financial statements, they should not get confused By reading the financial statements, this also auditor will see. Generally, if financial statements are prepared as per Schedule 3 of the Companies Act, it will be proper. Okay, there will not be any unambiguity in understanding the financial statements, provided you prepare as per Companies Act 2013 Schedule 3. That format you have to follow. So this also auditor will check whether the financial statements have been properly presented, disclosed. See, properly classified, described and disclosed. So whatever the amounts, generally in the financial statements you will show amounts, and those amounts, those items should be properly classified. Current assets as current assets, non current assets as non current assets, revenue as revenue, and expenditure as expenditure. That is classification. You should not take the expenditure and put it in revenue. You should not take a revenue expenditure and capitalize it. Only capital expenditure should be capitalized. So that is classification, whether properly classified or not. That also will be seen by the auditor. Got it? And next, whether accounts present true and fair view. True and fair view means whatever is the actual position, that position, has it been correctly shown in the financials or not. So in case of profit and loss, if entity actually made a profit of 2 crores, whether actually 2 crores only shown or any more profit has been shown, that is known as true and fair view. Actual picture should be presented in the financial statements. That will also be seen by the auditor. In fact, this will be part of objective of auditor as per SA 200, that we will discuss in this chapter itself. Got it? These are some of the areas that will be verified by the auditor. Next, see, by getting your books of accounts audited, what advantage do you get? Generally, only if we get any advantage, we will do that work. If we don't have any advantage of doing that work, we will not do that work. Correct or not? So if you are getting your books of accounts audited, what advantage the entity will get? Let us see. So first of all, as we have already discussed, audit will give confidence to the users, right? Users nothing but stakeholders, all the government, bankers and the shareholders, creditors. For all these people, assurance will be given by showing audited financial statements, right? That is the first advantage. Next, it will act as a independent mechanism. Why independent mechanism is required? Because shareholders money has been invested in the company, and company is managed by management. Shareholders will not come and check day to day operations of the company. Now shareholders should have a mechanism wherein someone from outside the entity will go to the entity and verify books of accounts of the entity and give assurance to the stakeholders or the shareholders, right? So audit will act such a independent mechanism for the benefit of shareholders. On behalf of shareholders, auditor will verify the books of accounts. Auditor will give confidence to the shareholders. See, shareholders, each and every rupee of yours has been properly utilized. Like this assurance will be given by the auditor. So that's the reason why auditor will be appointed by whom? Who will appoint the auditor? Will the management appoint the auditor? No. Shareholders will appoint the auditor in case of company. Correct or not? That point also it will be there. We will cover here. Next, it will act as a moral check on the employees. So moral check on whom? On employees. So employees, if they know that at the end of the year, this particular person, auditor, he will come and he will verify all our transactions. If the employees know this, they will be very much careful. They will think twice before committing any fraud. Correct or not? So the audit will act as a moral check on the employees, preventing them from committing the frauds and errors in the books of accounts. Getting it? So that is also one of the advantage of audit. Next, determination of taxes. See, government, you need to pay tax to the government on the profit, right? Now, how will the government get the confidence that whatever the profit that has been shown in the financial statements is Correct only. Only when the auditor audits those financial statements and gives such an audit report, government can believe on the audited financial statements. So this is also one of the advantage of audit. Next, credit decisions by bankers. So when you go to a bank asking for a loan, will bank give you loan just like that? No, it will ask for audited financial statements, right? So that bank can take a decision of whether you are having proper cash flows for giving the loan to you so that you will repay the amount, whether you are having proper assets to offer as a security. These things will be checked by the bank through audited financial statements. So for this purpose also audit is required. Advantage of audit. Next, of course, auditor during the audit, he will identify all the frauds and errors, right? And finally, review of controls. So controls means, example for control, best example is CC camera. So auditor during the audit, he will also review whether controls are working properly as designed or not. Now tell me whether auditor is having any responsibility to verify controls. Does he have any responsibility to verify and to give opinion on the controls? The answer is no. Auditing standards nor the shareholders or the stakeholders haven't put any responsibility on the auditor to verify internal controls and give assurance to the stakeholders. Then why auditor verifies internal controls? See, to make his audit work easy, auditor will verify the internal controls, but there is no responsibility on the auditor to verify the internal controls. Let me tell you. So let's say, for example, auditor is performing audit procedures on sales. Auditor wants to verify sales. So sales will be lot of transactions, right? Sale transactions. If he perform audit procedures on all those transactions, it will take a lot of time, correct or not? So what auditor will do is, he will first of all verify the internal controls that are operating around sales. If he finds that internal controls are operating effectively, then the amount of procedures that he will perform in the area of sales will be less. If he finds that internal controls are not operating effectively, then amount of procedures that he will perform in case of sales will be more. So to make his work of audit easy, he will first of all verify whether internal controls around that particular area are operating properly or not. Understanding, but there is no responsibility that has been put on the auditor to verify internal controls except internal controls over financial reporting. Okay, internal controls over financial reporting in case of listed companies, auditor needs to verify them. That aspect we will see in the reporting chapter. Okay, so apart from internal controls over financial reporting, auditor need not verify the internal controls. Getting it? Yes. Next, other aspects related to audit. Some other aspects related to audit. So firstly, audit relationship with other subjects. If you see, audit is a playboy. It is having relationships with almost all the subjects that you will learn in your syllabus. So we will see how audit is related. So firstly, audit is having a close relationship with accounts. You can say accounts is the first wife of audit, because in case of audit you will verify the accounting aspect only, right? The financial statements, they are part of accounting only, correct or not? So audit is closely related to accounts. Next, law. How law is related to audit? So if you are auditing a company, then you should verify compliances of Companies Act. Next, for almost all the companies, requirement of Provident Fund Act, ESI Act will be applicable. You need to check the whether PF have been properly deposited, whether it has been properly calculated. These things you need to see, correct or not. Next, if you are auditing a bank, then in case of bank, lot of regulations, lot of laws will be applicable. RBI Act, SARFAESI Act, PMLA Act, right? Banking Regulation Act, like this, lot of number of acts will be applicable on the bank. You should be well aware of all those acts, right? So audit is also related to law. Next, economics. So in economics, the terms that you will listen are like inflation, rate of interest, right? So when auditor is conducting the audit, let's say he is conducting audit of a car manufacturing company, then he should have knowledge of this entire industry to which his client belongs to. Okay, how is the rate of inflation in that industry, how the economics are operating in that industry, what are the macroeconomic aspects and what are the microeconomic aspects. All these things should be known by the auditor, right? So audit is also related to economics. Next, financial management. Various ratios will be used by the auditor while performing analytical procedures. SA 520 ratio analysis is one type of analytical procedure, right? While discussing SA 520, we will see how you will perform analytical procedures, right? So there ratios, various ratios, current ratio, gross profit ratio, debtors turnover ratio, all these are part of financial management. Next, working capital management, right? All these are part of financial management, the concepts of which should be known to the auditor to execute the audit work properly. Next, production. Production means manufacturing. So if auditor has been is doing audit of a manufacturing company, then he should know how the manufacturing process of that particular company is working. Why? Let's say, for example, to produce 1 unit of finished goods, 2 units of raw material is required. If auditor doesn't know that for producing 1 unit of finished goods, 2 units of raw material is required, what the management can do is that they can commit a fraud saying that we have consumed 4 units of raw materials for producing 1 unit of finished goods. If auditor doesn't know this equation between finished goods and raw material, he cannot question the management, right? So when will he know this equation? Only when he is having complete knowledge about the production process, he will get to know about that, correct? So auditing is also related to production. Next, stats and mathematics. So statistics, sampling, the best example. Auditor will use the concept of sampling for performing audit procedures, because in the company there will be lot of transactions and auditor cannot perform audit procedures on all the transactions. It will take huge time, right? So auditor will go for sampling. Sampling you would have learned in the statistics, various methods of sampling. We will see this in SF 530. There is a separate standard for that. And mathematics, see, management, they will calculate various provisions, right? They will take various assumptions which are nothing but part of mathematics. All those calculations, preparation of BRS, additions, deductions, all these are concepts of mathematics. So audit is also related to mathematics. Next, data processing. Data processing means, let's say for example, tally software which you will use for maintaining books of accounts. So you pass a journal entry in the tally software, so you are entering the data. Once you enter a journal entry, that entry gets reflected in the journal book, in the respective ledgers, in the trial balance, in the profit and loss statement, in the balance sheet, right? So how single entry is getting reflected in these many areas? The system is processing that data to get reflected in all those areas. So auditor should understand how the system is processing the data that has been given as an input, right? So data processing should also be known to the auditor, and it is related to the auditing in this technological world, correct? Next, behavioral science. So behavioral science means knowing how the other person behaves. This is nothing but a psychological study. So why behavioral science should be known to the auditor? Because auditor during the audit, he will communicate with various people within the organization and outside of the organization to get exact, correct, accurate information from these people. Auditor should know how to ask that information, how each person behaves. So if I ask the information to that person, in which manner I will get the exact information. For example, in most of the cases in audit firms, when you go to the client place, sometimes it will happen. The accountants will be, some accountants will be, if the lady article assistant asked for the information, he will give the information within no time. But if a gent, a boy article assistant ask for the information, they will delay. They will delay a little bit for providing the information. They will not show much interest, correct? So there will be some accountants like that. So this is behavioral aspect. So if you observe this behavioral aspect with that particular accountant, what you can do from next time onwards, every time you can send, you can push lady article assistant to ask for the information, so that you will get the information early, correct or not? So this is nothing but a behavioral science, understanding how the other person behaves and using it in your favor. Got it? Yes. Next, is audit mandatory or voluntary? See, you can't say a single answer to this. It depends. If you are a company, then it becomes mandatory. Okay, it is not always mandatory, but if you are a company, it becomes mandatory, because Companies Act 2013 has mandated audit for all the companies. If you are a partnership firm, then as per Partnership Act, audit is not required, no audit specified. But if your turnover crosses 1 crore rupees, then tax audit might become applicable. Same will be the situation even in case of individual also, correct or not? So tax audit might be applicable as per the thresholds, and companies audit is mandatory. And in case of some schools, in case of some charitable organizations, for the purpose of getting grants, they will have to get their books of accounts audited. Why? Let's say, for example, there is a school. Now, for this school, government has granted a grant of 1 crore rupees. But entire 1 crore rupees, it will not give straight away. First of all, it will give 20 lakh rupees. And government will ask the school, see, I am giving 20 lakh rupees. You first of all utilize these 20 lakh rupees. Now, school, after utilizing it, expending this 20 lakh rupees on education, it will again go to the government, again ask for the grant. Now, because 1 crore has been sanctioned, now of that 1 crore only 20 lakhs has been given, still 80 lakhs has to be given. So it will ask the government has spent 20 lakhs, give balance grant. Now government will say that, see, I have given you 20 lakhs and asked you to spend. What is the guarantee that you have spent that 20 lakh rupees on actual purpose, on actual education only, for the purpose for which I have given? So what you will do is, you get your books of accounts audited by the auditor, so that I can get a belief that yes, you have spent this amount for actual education purpose only, and based on that audit report, I will release the remaining grant. Like this, the government can say. So for this reason, some of the charitable organizations, some of the schools might get their books of accounts audited. Next, some entities, even though audit is not applicable for them, we have seen lot of advantages that will be generated because of audit. So to get those advantages, the entities might voluntarily get their books of accounts audited, right? So when someone asks you whether audit is mandatory or voluntarily, you should not give straight away single answer. You should understand the situations. You need to ask them the questions, reverse questions, whether you are asking for company or partnership firm or the individual. So based on the scenario, you need to give the answer. Got it? Yes. Next, who will appoint the auditor? Of course, if it is a company, then owners, that is members in the annual general meeting, will appoint the auditor. If it is a partnership firm, then partners, they themselves will appoint the auditor. If it is an individual, then individual, he himself will appoint the auditor, right? Yes, that is with respect to appointment of auditor. Companies, AGM members. In case of government companies, C&H, there is a separate authority, Comptroller and Auditor General of India. So in audit of different entities, we will be discussing this concept, audit of government accounts. There we will learn in depth about Comptroller and Auditor General of India. Next, as I told you, in case of partnership firm, partners will appoint the auditors. Yes. Next. Now, going to, so in this first chapter, the basic introduction has been discussed. Along with the basic introduction, essay 200 also discussed. So now we will see the portion of SA 200 that is covered in the first chapter. So SA 200 is the basic standard which will set overall objective for the audit, right? So if you see auditing standards issued by the institute, are they voluntary or mandatory? So auditing standards that the institute has issued, should they be complied mandatorily? Yes, they have to be complied mandatorily. If you are doing audit of a company, if it is a statutory audit, you have to comply. Even in case of a tax audit also, auditing standards are mandatorily applicable. Understanding? So there is a list of around 36 auditing standards there, but in your syllabus you have only 30 auditing standards, right? So I will tell you the list of auditing standards that are not applicable to you people. So from 200 series, 240 is not applicable to you, and 300 series everything is applicable. 400 series, 402 is not applicable to you, and 500 series, yes, they 540 is not applicable to you, and 600 series, yes, they 620 is not applicable to you, and coming to 700 series, 720 is also not applicable to you. Okay, except these 5 standards, remaining all standards are there for your syllabus. See, even 250 I forgot, yes, they 250 is also not applicable to you. Okay, except these 6 standards, remaining all the standards are applicable for CA intermediate syllabus. Getting it? Yes, we will be revising all those 6 standards. See, along with the interlinking in depth, we will be revising all those standards. You need not worry. Getting it? Yes. See, if you really like this lecture, you motivate me for making more lectures of this kind by commenting this, the best lecture. So you put this in the comment section to motivate me, so that I will also be motivated to make more content of like this to you people, because I am here sitting in the room in the studio and making the videos. Even I should get a motivation to work, right? So please comment this in the comment section. Think this as a small guru dakshana that you are giving to me. Okay, yes. So if you really like it, comment this, the best lecture. Got it? Yeah. Now, starting with essay 200. So, essay 200 deals with the overall objective of independent auditor and conduct of audit in accordance with standards on auditing. So, this essay 200 sets base for all the standards. So, how it will set the base? See, if you are doing any work, I told you there should be a goal for that work, right? So goal means nothing but objective, right? So objective means the goal behind that, right? So for doing the audit, what is the goal? What is the objective of the auditor? That will be told by essay 200. This is the first aspect. Next, essay 200 also discusses the fundamental principles. These fundamental principles are nothing but ethical principles. They are common in essay 200 and even in the second chapter, ethics. So we will be discussing that fundamental principles here in essay 200, and same again in the ethics also, second chapter also. Getting it? Yes. So first of all, we will see this standard deals with essay 200. It deals with objectives of independent auditor. So what is the objective of independent auditor? See, by this time, this objective of independent auditor, it should have you should have by hearted this, right? You should have properly remembered this line. So tell me, what is the objective of independent auditor? To obtain reasonable assurance that financial statements as a whole are free from material misstatements, whether due to fraud or error, thereby enabling the auditor to express an opinion on whether financial statements as a whole are prepared as per the applicable financial reporting framework or not, and to report thereon, right? This is the overall objective of auditor. Sir, you have said the entire objective, but what is the meaning of that objective? We will understand each term by term. So first of all, in this objective, the first term is reasonable assurance. So assurance means, giving confidence to the users, giving belief to the users is known as assurance. But they are using the term reasonable assurance. What is meant by reasonable assurance? See, if they are, instead of using just normal assurance, they are using reasonable assurance, means there should be some types of assurances apart from reasonable assurance, right? So basically there are three types of assurances. What are those three types of assurances? First one is absolute assurance. Absolute assurance means you are giving 100% confidence to the users, saying that, see users, I have done the audit and there is not even a one mistake. There is not even a one misstatement in the financial statements. Like this, if you give assurance, that will become absolute assurance. And you please remember that auditor, he will never ever give absolute assurance. Okay, this absolute assurance can never be given by the auditor. Auditor will give only reasonable assurance. Why auditor cannot give absolute assurance? Because of inherent limitations of the audit. There are certain inherent limitations in the audit which we will discuss. Okay, in the further, see here you have inherent limitations of the audit. Okay, because of these inherent limitations, the auditor can never give absolute assurance. He can only give reasonable assurance. Now what is meant by reasonable assurance? Reasonable assurance is a high level of assurance, but not absolute assurance. Understanding? So absolute assurance, you will give 100% confidence, but in case of reasonable assurance, a little bit less confidence you will give when compared to absolute assurance. Like you can say 99.99% confidence you will give, but not 100% confidence. See, high level of assurance, but not absolute assurance. Okay, so in case of audit, you will always give reasonable assurance. So reasonable assurance engagement is nothing but audit engagement. There is also another assurance which is limited assurance. Of course, limited assurance means the level of assurance will be less when compared to reasonable assurance, right? So limited assurance lower than reasonable assurance. So on one side there is reasonable assurance, on other side there is limited assurance. If you provide reasonable assurance, we will call it as audit. If you provide limited assurance, LA means limited assurance, we will call it as review. So review is mandatory for listed entities generally. So on a quarterly basis, for each and every quarter, review engagement has to be done. So in case of this review, limited assurance will be given. That means level of assurance that is less than the reasonable assurance. Understanding? Now one more difference between reasonable assurance and limited assurance. To obtain reasonable assurance, you will perform almost all audit procedures. You will perform all the audit procedures to obtain reasonable assurance. But to obtain a limited assurance, you will perform only limited procedures. Understanding? Generally, here in case of limited assurance, the procedures that you will perform will be limited to inquiry you will perform, some analytical procedures you will perform, and some observation you will perform. Only these limited procedures you will perform. Whereas in case of audit, almost all the audit procedures you will perform. Understanding? So, if you perform all audit procedures, you will get complete evidence. Correct or not? So if you get a complete evidence, on the basis of complete evidence, you can give reasonable assurance. But if you perform limited procedures, you will get only limited evidences, only some evidences you can gather, right? Limited evidence you can gather. If you gather only limited evidence, your opinion is based on, of course, the evidence. If you have only some evidence, the type of assurance that you can give will also be limited, because you are basing on only the available evidences that you got. Correct or not? So here since you have got only limited evidences, you will give limited assurance. Understanding the reason why reasonable assurance and limited assurance will be given, this is because of the procedures that you perform. Understand, there is a link, okay, to the evidence and to the procedures that you perform. I hope you understood this. See, that is, these are the three types of assurances. And in case of audit, the objective is to obtain reasonable assurance that financial statements as a whole are free from material misstatement. Now, what is meant by misstatement? Misstatement means something wrong, that is generally anyone will say, but you are CA intermediate student going to write CA examination, you should not say that misstatement means something mistake, right? You should give the correct definition for misstatement, right? We will understand the term misstatement. Before understanding the term misstatement, we should also understand one more term, which is, see, we will understand misstatement, just to keep it on hold. Material misstatement, whether due to fraud or error, enabling auditor to express opinion on whether financial statements are prepared in accordance with applicable financial reporting framework. What is meant by applicable financial reporting framework? So only if we understand what is meant by applicable financial reporting framework, based on that you can understand misstatement. So first of all, we will discuss what is meant by applicable financial reporting framework. So applicable financial reporting framework, I will give some examples for applicable financial reporting framework. You only will know accounting standards, Indian accounting standards. These are the some of the examples for applicable financial reporting framework. See, framework means it will contain rules on how to prepare the financial statements, right? Based on that rules, you will prepare your financial statements. Getting it? So generally, applicable financial reporting framework discusses about four things. Let's say, for example, accounting standard 2, which deals with inventory, which is a financial reporting framework, right? Now, AS2 will provide you guidance about amount. That means at what amount you have to recognize the inventory. This guidance will be provided to you by AS2, correct or not? Next, AS2 will also provide you guidance with respect to classification. Classification means whether inventory is a current asset or non-current asset. It is a current asset. How did you know that it is a current asset? Because accounting standard 2 has provided you a guidance that this has to be classified as a current asset, right? Next, presentation. So how to present this inventory in the financial statements, regarding that also guidance will be there in the accounting standard 2. And finally, disclosure. So with respect to disclosures, where you will make disclosures in the notes to account. So with respect to inventory, whether in the financial statements, in the notes to accounts, any disclosure is required, that will be said by accounting standard 2, right? So guidance with respect to, I will call it as A, C, P, D. So a financial reporting framework will give you guidance about ACPD of an item. Understanding? So you have to prepare your financial statements as per that guidance only. Clear? That is the applicable financial reporting framework. Now, if management, while preparing their financial statements, the rule is they have to follow this guidance. If at all management has followed their own rules, okay, ACPD that has been followed by the management is different from the ACPD that is prescribed by the applicable financial reporting framework, then you will call this situation as misstatement. Understanding the meaning of the term misstatement? See, I have explained you both the terms, applicable financial reporting framework and also misstatement, right? So applicable financial reporting framework will give you guidance about amount of classification, presentation, disclosure of a item. and you have to follow those things. If at all there is a difference between ACPD prescribed by applicable financial reporting framework and ACPD followed by the management, you will call such a situation as misstatement, right? Yes. Now these applicable financial reporting frameworks, they are of two types. One is the fair presentation framework and another one is the compliance framework. So what is this fair presentation framework? Generally, any framework that allows the management to provide additional disclosures than required. Okay, additional disclosures than required by the framework. Oh, just a second. There is some issue with this. I guess you are not able to see the screen, right? Yes, I have fixed that screen. Now you should be able to see the screen. So now fair presentation framework means this the framework that allows to give additional disclosures in the financial statements. So framework has told to give these disclosures, but if management want to give, they can give additional disclosures also in order to show more fair presentation of the financial statements. Understanding? Or if the framework allows to deviate from requirements of the framework, then also such a framework will be known as a fair presentation framework. Understanding? So framework has given some rules, and framework told that, see management, if you feel that if you deviate from these rules, or if you give more disclosures than required by these rules, you will be able to show more fair presentation of the financial statements, then you are happily allowed to deviate, or you are happily allowed to give additional disclosures. Understanding? This is the fair presentation framework. Whereas in case of compliance framework, these two points will not be there. You have to strictly follow the framework, rules of the framework. Examples for fair presentation framework: your accounting standards, Indian accounting standards, these are examples for fair presentation framework. Examples for compliance framework: if you see in the bank audit, RBI has given provisioning norms. Provisioning norms, they are also framework, only framework prescribed by the bank. So for NPS, if it is in substandard, you give this much provision. If it is in doubtful, give this much provision. This is also a framework that the RBI has prescribed for provisioning, that has to be strictly followed. You cannot deviate that framework. So that is the example for compliance framework. Understanding? Yes. So this is complete discussion about applicable financial reporting framework, types of financial reporting frameworks, and misstatements. See why I am spending this much time for this, because these are the basic terms. In our further discussion of standards, we will see these terms. So when you find those terms, you should not confuse what is the meaning of those terms. That's why I have explained you. Clear? Yes, sir. So now we covered complete discussion of the objective of auditor, right? And these misstatements, they can occur either because of fraud or because of error, right? Next, after that, to report on the financial statements and communicate as required by the auditing standards. This is the total objective of auditor as per SA 200. Next, I told you SA 200 is also having further discussion with respect to ethical requirements or the qualities of auditor, you can say. See, requirement on the part of auditor to achieve these objectives. So what are the requirements? Auditor needs to possess certain qualities. What qualities he needs to possess? First of all the ethical requirements. There are 5 ethical requirements which are issued by Code of Ethics. Code of Ethics is basically a 3 volumes of book issued by ICAI. In that volumes of book, there is a discussion about fundamental principles, or you can call it as ethical requirements. What are the 5 ethical requirements? Integrity, objectivity, confidentiality, professional behavior, professional competence, and due care. Now, what is meant by integrity? Integrity means being truthful. So, if there is loss in the financial statements, you have to report the same. You should not say that there is a profit. Okay, what is the actual position? The same has to be reported. Truth has to be reported. That is known as being integrity. Next, objectivity. Objectivity is related to decision making. So there are two concepts, objectivity and subjectivity. So when making any decisions, if you are making those decisions based on your emotions, then it will be known as you are acting subjectively. If you are taking decisions based on underlying facts, it will be said that you are acting objectively. So tell me, should the auditor be subjective or objective? He should always be objective. His decisions should be objectively taken based on the underlying facts, but not based on the emotions of the auditor. Understanding? Yes. Next, confidentiality. Simple. Whatever the information that you get during the audit, the client's information that you get, you need to keep it confidential. You should not disclose it to third parties or any people outside the entity. Understanding? Yes. Yes. Next, professional behavior. Professional behavior means the chartered accountant during his normal life also he needs to behave professionally. He should not drink, go on to the road and dance. Then it will be said that he is not behaving professionally. Understanding? So if you don't behave professionally, then also institute can take action against you, because if you do like that, next day in the paper what it will be written, so and so chartered accountant. They will not use your name, they will directly use your profession, chartered accountant. So your behavior will impact the entire profession. Understanding? So once you are a chartered accountant, whatever you do, you are doing in the capacity as a chartered accountant. So whatever, if you commit any wrong, if you don't behave professionally, the people, the public will criticize the entire chartered accountancy profession. So anything which brings a disrepute to the profession, you should not do. Understanding? You have to behave professionally. Next, professional competence and due care. Professional competence means having the capability, competence to do the work that you have accepted. So if you have accepted tax audit, you should have knowledge to do that tax audit. Without having experience, without having knowledge, you should not accept the work, because you cannot discharge that work with utmost quality to the client if you don't have experience and the knowledge, right? That is the professional competence and due care. While discharging the duty, while doing the work, you have to do with due diligence and due care. Got it? Yes. Next, auditor, another quality he needs to possess is professional judgment. See, there are two concepts. One is professional judgment and another one is professional skepticism. Students, they will be confusing between these two things. Professional judgment, PJ, professional skepticism. What is the difference between these two? Professional judgment means applying your knowledge, applying your skill, applying your experience for decision making, for the given situation, applying all those things and take a decision is known as professional judgment. On the other hand, professional skepticism includes the three things. Professional skepticism is basically a quality of the auditor which includes questioning mind. So whatever you find during the audit, you have to question it. That quality you need to possess. You will call that quality as a professional skepticism. Next, being alert to the misstatements. So during the entire audit, you have to be alert to find the misstatements. This is also part of professional skepticism. And whatever the evidences that you obtain, you need to critically assess those evidences. Critical assessment of evidences. So these three are part of professional skepticism. Understanding? So You should not confuse between professional judgment and professional skepticism. Both are different. Both are the qualities that the auditor has to possess. Then next, auditor should also be independent. Independence, we already discussed, it is basic concept. Your decisions should not be subjected to will and wish of other people. Next, SA 200 also discusses about duties of auditor. See, auditor, he needs to obtain sufficient appropriate audit evidence. SAAE means sufficient appropriate audit evidence. So SA 500 will discuss about this concept of sufficient appropriate audit evidence. There in SA 500 we will discuss, we will revise in depth about that concept. Next, as per SA 200, you should also conduct your audit in compliance with all the auditing standards. If you see the name of the standard itself, the first part is overall objectives of independent auditor, and second part is conduct of audit in accordance with standards on auditing. Got it? So the second aspect is conduct audit in accordance with standards on auditing. Next, professional judgment we have discussed, I have explained you. Professional skepticism also I have explained you. Being alert, questioning mind, and critical assessment of audit evidence. Right. Next, applicable financial reporting framework also I have explained you two types: fair presentation, compliance. Fair presentation means additional disclosures are permitted, departure from the framework permitted. Compliance means you have to strictly comply. Next, coming to the inherent limitations of the audit. I told you auditor cannot give absolute assurance because of the inherent limitations that are there in the audit. I'm just checking my mic because recently what happened is I recorded the video, complete video got recorded, but no voice was there. I have to again re-record it. So I'm just checking it whether mic is working properly or not. Yes. So inherent limitations of the auditor. Inherent limitation means something that is causing you, that is preventing you from achieving a particular task is known as limitation. Here in this situation, these inherent limitations are preventing the auditor from getting absolute assurance. Correct or not? So what are those inherent limitations that are preventing the auditor from getting absolute assurance? We will see. That's the reason why, because of these inherent limitations only, auditor has to give reasonable assurance. Auditor is getting reasonable assurance instead of absolute assurance. Let us see them. First of all, nature of financial reporting. Financial reporting means the process of the process of preparation of financial statements is nothing but financial reporting. The rules that you follow, the estimations that you make, all these comes under financial reporting, right? Preparation of financial statements. Now, while preparing the financial statements, management will provide various estimations. Basic example, debtors. There will be doubtful debtors. For doubtful debtors, you need to make provision. Let's say you have provided provision of 1 lakh rupees in the financial statements for the doubtful debtors. Now tell me whether exactly same amount of debtors will become bad. There can be more debtors who can actually become bad, or there can be less debtors than 1 lakh rupees that actually become bad, right? Because this is related to a future event, you cannot exactly predict it. So like this, lot of predictions, lot of provisions will be there while preparing the financial statements, right? So the financial reporting itself is such that you cannot get absolute assurance. Okay, you cannot exactly predict whether this amount will be correct or not, because management also made it based on prediction only, understanding based on certain assumptions. So this is the first limitation because of which you cannot obtain absolute assurance. Next limitation, inherent limitations of internal controls. So the internal controls, why will you establish internal controls? Let's say for example, there is cash is subjected to theft, there is a risk of theft. To avoid that risk, what you will do, you will establish internal controls. CC camera. Now, is there 100% guarantee that CC cameras will 100% prevent the theft? No. There is a limitation even in CC camera also. Someone can put kerchief, correct or not? Someone can put kerchief on the CC camera and take away the cash. So CC camera has not prevented it. So there are inherent limitations in controls also, right? So because of inherent limitations of the internal control, auditor cannot obtain absolute assurance. This is also one of the inherent limitation of audit. Getting it? Yes. Next, nature of audit procedures. See, the nature of audit procedures are also such that auditor cannot get absolute assurance. The best example is sampling only. So what you will do, let's say there are 1000 population, okay, total population, sales transactions are 1000. Now you cannot perform audit procedures on all the transactions because it will take time. So what you will do, you will take sample of 100 vouchers and you will perform audit procedures on 100 vouchers. Let's say you have found one misstatement in this 100 vouchers. So what you will do, 100 vouchers, one misstatement means in total 1000 population, how many misstatements can be there? You will project the misstatements. There will be 10 misstatements, right? 100, 1 means 1000, 10. You will just cross multiply it, correct or not? So how you will do this? For 100 misstatements, there is one misstatement. For 100 sample, there is one misstatement. Then for 1000, how many will be there? 10. So you have just cross multiplied it, correct or not? So you will say that there will be 10 misstatements in population, but will there be actually 10 misstatements only? There can be more than 10 misstatements or less than 10 misstatements, who knows? You haven't verified complete transactions. Just based on sample you are taking a assumption, understanding? So because of this also, auditor cannot get absolute assurance. He will get only reasonable assurance. Okay, this is also one of the reasons. See, nature of audit procedures. Audit sampling. Management may not provide complete information. See, auditor is outside party. He has went to the company for doing the audit. All the information about the company is known to the management. Management has to provide the information to the auditor. Now auditor will ask the information and it is in the hands of management whether they will provide complete information or not. Auditor cannot impact that, correct? Auditor can just ask. Auditor cannot force the management, and auditor can even not identify whether management has given complete information or not, right? This is also one of the nature of auditing procedure which creates a limitation on getting absolute assurance. Next, concealing fraud. See, the person who has done the fraud, by doing the fraud, will he be just keep that fraud as it is? No, he will try his level best to cover up that fraud so that no one will identify that fraud, right? So he will conceal it in such a way that it will become difficult even for the auditor also to identify the fraud. So this is also one of the inherent limitation. Getting it? Next, audit is not an investigation. See, what is meant by investigation? In case of investigation, you will perform in-depth checking of the transaction. So let's say for example, you got a doubt there is fraud in the area of sales, then you will launch an investigation in the area of sales. So investigation will be restricted only to the sales, but you will go very deep into the sales. That is investigation, to find out the actual facts. Okay, investigation is a fact finding mechanism. But audit, in case of audit, you will cover all the items but not that much depth as the investigation covers. See, there is a difference between audit and investigation also. Let us see. Meaning, audit is a reasonable assurance engagement. In case of audit, you will give reasonable assurance. Investigation is a critical examination of accounts. In case of audit, you will provide opinion, but in case of investigation, you will find out the facts, right? Like who committed the fraud, from how much time that fraud is being committed, and how much amount is involved in that fraud. Like that facts you will find in case of investigation. And scope of audit is general and broad. I told you, in the audit, broadly you will cover all the areas, but you will not go in depth. Generally you will cover, but in case of investigation, it is specific. you will focus on specific item, you will leave all other items. Sales fraud means you will focus on sales, and you will go in depth into the sales, but it is narrow means you are restricting. Understanding? Yes. So this is difference between audit and investigation. Next, timelines for reporting. So for doing the audit, you will not get a complete year of time. You have to complete it within 15 days or 1 month as per the available time. So there is a limitation of time also, because management should also furnish the audited financial statements to government authorities, and there is a time limit for furnishing them. By 30 October you have to furnish to MCA. Understanding? In case you are listed by May 30, you have to submit to stock exchanges, right? So because of these time limitations, auditor cannot get absolute assurance. This is also one of the limitation. Next, future events. I have told you with respect to provision for bad debts. So like this, in the financial statements, there will be estimations with respect to future, and future means always uncertain. You cannot exactly predict the future, right? You are not Prabhas in Radheshyam to exactly predict the future like this, right? You can't predict the future. So this is also one of the inherent limitations. So whatever the amount that you have recognized in the current year as an estimation, that might differ with the actual amount that can occur in the future, right? This is also one of the inherent limitation, because of which you cannot give absolute assurance. Next, coming to scope of audit. Scope means what areas will be covered in the audit. See, almost all the financial areas will be covered in the audit. See, cover all aspects of the entity. You will cover almost all the aspects of the entity, and you will also check reliability and sufficiency of financial information. So whatever the financial information, see, you need to observe, they are not saying financial statements. Financial information. Financial information is a broad term which includes the financial statements also. Understanding? So books of accounts is also financial information, but books of accounts is not a financial statements. Understanding? So auditor should also verify reliability and relevance of that financial information that is submitted by the management. Next, proper disclosure of financial information, whether in the financial statements financial information has been properly disclosed as per the requirement of applicable financial reporting framework or not. That will also be checked by the auditor. This is also included in scope of auditor, right? Next, what will be excluded from the scope of audit? Following things will be excluded. Preparation of financial statements. See, financial statements have to be prepared by whom? By management. It is not responsibility of auditor. So preparation of financial statements is excluded from the scope of audit, right? Next, duties falling outside domain of his competence. Competence means his capability, his skill. Auditor is expert in audit and accounts, right? He is having competence in audit and accounts. Let's say management is asking the auditor to value a building. How can auditor value? He cannot do it. So the works which are outside the competence of the auditor are not covered in the scope of audit. They are excluded. Understood? Yes. Next, authentication of documents. Authentication means verifying whether document is correct document or is it a forged document. Auditor cannot identify it. Forensic people can identify it. Auditor is not a investigator. Auditor is not a forensic accountant to identify them correct or not. So this is also outside the scope of audit. So all these things are outside the scope of audit. Next, elements of assurance engagement. Assurance engagement means a work. So a work in which you will provide assurance to the client is known as assurance engagement. So in case of assurance engagement, there are certain elements. What are those elements? We will see. There are certain 5 elements. First one, three party relationship. So always in an assurance engagement there will be 3 people involved. Who are those 3 people? First of all, the auditor, the person who is providing the assurance, right? Next, responsible party, that is management. And final one is user. User means for whom the assurance is provided. These three people will be involved in the assurance engagement. See, practitioner, none other than the auditor. Next, responsible party. Responsible party means management, who is responsible for preparing financial statements. And finally, intended users, nothing but stakeholders, for whom you are, for whose purpose you are providing the assurance, right? These are the three people that are involved in the assurance engagement, three party relationship. Next, subject matter. Subject matter means the item that you are auditing, or the item on which you are providing assurance, is known as a subject matter. So in case of audit, subject matter will be financial statements, because on financial statements only you are providing the opinion. Understood? Next, suitable criteria. Suitable criteria means the criteria as per which subject matter is prepared. So in case of audit, subject matter financial statements will be prepared as per applicable financial reporting framework, right? Accounting standards or the Indian accounting standards. So applicable financial reporting framework becomes a suitable criteria. Criteria means nothing but the one with which you will compare the subject matter. So auditor, in case of audit, what he will do, he will compare whether financial statements are prepared as per the applicable financial reporting framework or not. That means he is comparing subject matter with the criteria. Understood the meaning? Yes. Next, sufficient appropriate audit evidence, which we will see in SA 500, and written assurance report, which is the final output of the audit. So all these are the five elements of the assurance engagement. Next, I told you institute has issued various standards, and in our syllabus there are 30 standards. Now what is the purpose of these auditing standards? Let us see. So by issuing these auditing standards, it will act like a benchmark. Benchmark means a established standard, a established rule as per which you can follow is a benchmark, right? So let's say for example, in the class there is a particular student who is very clever and always he will top the exams. So now every student in the class will take benchmark of that particular student, correct or not? So that is known as benchmark. So auditing standards will act like a benchmark for the auditors to comply with, to do the audit as per the auditing standards. Next, improve quality of financial reporting. Of course, auditing standards will prescribe the auditor how to do the audit. So as per that auditing standards, if the auditor does the audit, if at all there are any misstatements in the financial statements, he will be able to identify those misstatements. So the quality of report that the auditor issues will be increased if he follows auditing standards. Understanding? So auditing standards will also help to increase the quality of report, financial reporting. Next, promote uniformity. Uniformity means, let's say for example, auditor 1 issues audit report in his own format, auditor 2 issues audit report in his own format, auditor 3 issues his own audit report format. So like this, in the country all the chartered accountants are issuing their own formats of audit reports. Then users will get confused, users will get mad to understand that audit reports, correct or not? If there is a single format of audit report, all the users, they will be easily able to understand that audit report, and audit reports will also be comparable if there is a standardized format. So auditing standards will help for standardizing it. Okay, it will promote uniformity among all the audits. Next, equip professionals with skill. Professionals means we only, we chartered accountants. Now chartered accountant has to conduct the audit. Now how to do the audit, how do we know? Until and unless we learn. So there should be some guidance which will help us to learn how to do the audit. So auditing standards will provide the professional accountants with the skill to do the audit and ensure quality of the audit. So all these are the purposes for which auditing standards are required. Understanding? Yes. Next, difference between audit and review. This we have already discussed. Audit means we will give which type of assurance? Reasonable assurance you will give. Review means which type of assurance you will give? Limited assurance we will give. I have explained this concept to you, right? So assurance given is reasonable assurance in case of audit, limited assurance in case of review. And this also I told you, in case of audit you will perform exhaustive procedures, all the audit procedures you will perform, whereas in case of review you will perform fewer procedures, right? And audit deals with financial statements, even review also deals with financial statements only. Got it? Yes. Next, coming to the engagement and quality control standards issued by ICAI. Now if you see, our Institute of Chartered Accountants of India, it has issued engagement standards. Engagement standards. So in our syllabus we are having only auditing standards, or you can call them as standards on auditing, right? Standards on auditing, you have only this. But apart from standards on auditing, ICI has also issued standards on review engagement, which is SRE. So, in case of audit, you will give reasonable assurance, right, for the historical financial statements. If you wanted to give limited assurance on the financial statements, you will call it as review, and the SRE series have been issued by the institute for that review. Next, there is also SAE series, which is standard on assurance engagement. Assurance, sir. In case of audit, we are giving assurance. Then why again another assurance series? See, in case of audit, you are giving assurance on historical financial statements, but you can give assurance not only on historical financial statements, you can give assurance on internal controls also, you can give assurance on prospective financial statements also, you can give assurance on various items other than historical financial statements. Assurance means just giving confidence. That assurance, that confidence you can give on whatever item you wanted, correct or not? So if you are giving assurance on historical financial statements, we will call it specifically as audit, and auditing standards will be applicable for it. If at all you are giving assurance on items other than historical financial statements, then standards on assurance engagement will be applicable for that. Understanding? So if you are giving assurance on historical financial statements, technical name for that engagement is audit. If you are giving assurance on other than historical financial statements, you will call it as assurance engagement. Clear? And standards on assurance engagement will be applicable for that. Next, finally, you also have SRS series, standards on related services. So here in these three situations you are providing assurance. There, tell me, will the audit firm take up only those services where it provides assurance, or it will also take up some non-assurance services like preparing financial statements, compilation of financial statements, filing income tax returns, right? In these situations, for preparing financial statements, for filing income tax returns, for filing GST returns, no assurance will be provided. In such a situations, you need to comply with SRS series, standards on related services, where no assurance will be provided. Understanding? So these four engagement standards have been issued by ICAI. Now, in all these engagements, you need to have utmost quality. About this quality, we will discuss in chapter number 10. There is SQC1 and SA220, which deals with quality. Understanding? Ensuring quality in all the services provided. So, how to ensure the quality in the services that the chartered accountant provides? Institute has given a separate series of standard by name SQC1. Okay, you can call them as standards on quality control. So these standards on quality control, they are applicable for all these engagement standards. Okay, so these engagement standards taken together with quality standards, we will call it as uh, engagement and quality control standards. That is the full name which we will give. See, you can find it here. Engagement and quality control standards. Auditing standards, SRE, that is standard on review engagement, standard on assurance engagement, standard on related services, standard on quality control, which deals with quality. SRS deals with related services like compilation engagement. I have also given some examples of the standards. Got it? Yes. So I guess you are clear with the first chapter. I have tried my level best to give complete concept in as much as lesser time as possible. So if you like this revision, don't forget to comment the best. Understanding this will give me motivation to make more and more content, more and more lectures to help you people. Understanding? Yes. Now I will open the second chapter. We will revise the second chapter. Yes. Now I have opened second chapter. Let us quickly revise second chapter. So second chapter, it deals with two aspects. Firstly, ethics. About ethics it will be covering, and it also deals with essay 210. Essay 210 deals with agreeing to the terms of audit engagement, right? So terms of audit engagement. These two aspects will be covered in this particular second chapter. Already in first chapter we have discussed 200. Now we will be covering essay 210 and some ethics. Got it? So first of all we will start with ethics. What is meant by ethics? Ethics means moral principles, right? So when you are going on a road, if you find a wallet, and in that wallet there is some 10,000 rupees and also identity card of the person to whom that wallet belongs to, then if you are a ethical person, you will identify that person to whom that wallet belongs to and you will give that wallet to him. If you are not a ethical person, what will you do? You will take that amount. That is nothing but being ethical or unethical, right? So meaning of ethics, what is meant by ethics? It is moral principles and comes from individual intrinsically, right? So it depends on the individual whether he is wanting to be ethical or he doesn't want to be ethical. That depends on him. It comes from intrinsically within the individual and it is inculcated in the habit. So whether the person is ethical or unethical, it depends to a large extent on his upbringing. So what is his upbringing, in which type of society he has been brought up, that will have a huge impact on his moral principles and the ethical values, right? And also it is a state of mind, right? So the same person can be ethical in some situations and can be unethical in some situations. So everyone can't be ethical in all the situations, right? Correct or not? So being ethical or not being ethical is a state of mind. It changes as the time passes. Understanding? So this is a brief understanding of generally what is meant by ethics. Now these ethics has to be followed by chartered accountants also. If you apply these ethical requirements to the profession of chartered accountancy, they becomes professional ethics. Understanding? So our ICAI has given code of ethics. I told you already, code of ethics is a 3 volumes of book which contain the requirements of ethical principles that has to be followed by a chartered accountant, right? So institute has given 5 fundamental principles which we have already covered in essay 200, also in the first chapter: integrity, objectivity, confidentiality, professional behavior, professional competence and due care. I have explained about these things in the first chapter, so I will not be explaining these things again here. Got it? I guess you remember them in the first chapter. Next, now for complying with the ethics, there are two approaches. One is principle based approach and another one is rule based approach. We will understand this principle based approach and rule based approach with the help of an example. So firstly, principle based approach. Now you know that on 31st March of every year, inventory closing stock will be there now. Closing stock, physical verification of closing stock will be done by the auditor in order to get evidence of this closing stock that is available with the entity. So auditor, he will physically go and he will verify whether that stock that is shown in the balance sheet is actually present physically or not. This procedure will be performed on 31st March because financial statements will be prepared on 31st March only. So the inventory lying as on 31st March, for that he wants the evidence, right? This is the principle. On 31st March, you have to go to the client's place and verify the inventory. Now let's say, for example, on 31st March, huge flood has occurred, because of which it is impossible to reach the location where inventory is kept. Then if you are following principle based approach, what you will do is, the principle says that I have to get evidence about inventory lying as on 31st March, right? That is the principle. I have to achieve this. But on 31st March, I am not able to visit. So what I will do? I will go to the inventory location on 4th April. On 4th April, complete situation of flood is got over, everything is normalized. Now I can go visit the location. So on 4th April I will go. On 4th April I will go and I will perform physical inventory verification of the closing stock. Now if I perform physical inventory verification on 4th April, I will get evidence about stock that is present on 4th April. But for financial statements purpose, I want as on 31st March. Principle says that you have to, the principle, it says that you have to obtain audit evidence as on 31st March. Now what I will do? I got audit evidence about closing stock as on 4th April. For this closing stock, I will reduce sales that has taken place during this period, and sorry, I will add sales that has taken place during this period, and I will reduce purchases that has taken place during this period. Then what will I get? I will get evidence about closing stock as on 31st March, right? So I didn't follow exact principle that is said, but I have achieved the underlying purpose. What is the underlying purpose? The underlying purpose is you have to get evidence about the inventory as on 31st March. For achieving that purpose, I have followed a different rule and I have achieved it. Understanding? Here, you will not follow exact principle. You will try to achieve the underlying purpose of that particular rule or the principle. You will call it as principle based approach. Understanding? Yes. Next, coming to the rule based approach. Rule based approach. Rule based approach to what? To compliance with these ethical principles. Now under rule based principles, if you take under rule based approach, if you take the same example, if auditor is following rule based approach, whatever the situation might be, he wanted to go on 31st March only. Even it might be the flood or whatever the situation it might be, he wanted to go on 31st March only, and he will go on 31st March only. Even by taking some boat, he will go on 31st March only. That is, he will strictly follow the rule. He will not try to he will not look that I can achieve the same purpose by performing audit procedure on some other day. No, he will not do that. He will try to do exactly what the rule is saying. Understanding? But in principle based approach, what you will do? You will try to achieve underlying purpose by following some different approach. instead of following the same principle. Okay, if you are able to follow that principle as it is well and good, you will follow it. If at all it is not possible to follow that principle, you will try to achieve the underlying purpose by doing it in some different fashion. But in rule based approach, you will follow the same rule exactly as it is. Understanding? Understood? Is this example helpful to you to understand principle based approach and rule based approach? Yes. See, if you have any doubt still with respect to this, you please comment me, I'll explain you. Okay, you comment in the comment section your doubt, I will explain you. So that is principle based approach, rule based approach. Now let's see. So principle based approach versus rule based approach for compliance with the ethical requirements. Under principle based approach, the compliance with spirit of ethics. Spirit means the purpose, the underlying purpose of the rule you will try to achieve, and you will exercise your professional judgment. So to achieve the underlying purpose, how can I achieve it? You have to exercise your skill, knowledge, expertise, right? So in our example, you should exercise judgment for getting that formula for 4th April inventory. You make some addition and deduction and arrive at 31st March na, there you have applied a judgment. Understanding? Yes. Whereas in case of rule based approach, you will strictly follow the rules. You will become balaya. Okay, so balaya will not listen to anyone. He always goes does whatever he wants, right? So you will say, I want to strictly follow the rule. That is rule based approach, and it is having some narrow outlook and it is very rigid. So there is not much flexibility in the rule based approach. In case of principle based approach, the target is to achieve the purpose by whatever means you can achieve it. But rule based approach, you have to achieve the purpose and the same thing you have to follow, the in the same manner you have to achieve it. Understanding? Yes, that is rule based approach and principle based approach. Next, need for professional ethics. I told you, if you apply the same ethical requirements to the profession of chartered accountancy, it becomes professional ethics. Now, why does the chartered accountants follow professional ethics? Why should we have ethics? What happens if we don't have ethics? See, ethics in the profession like chartered accountancy is very much important, because users, in the first chapter we have discussed, stakeholders will believe on our report. Stakeholders will place the confidence on the work that we do. If we ourselves are unethical, how will stakeholders will believe on our work, right? So in order to give utmost assurance to the stakeholders, we should be first of all ethical. Stakeholders should first of all believe us, then they will believe our work. Correct or not? So see, need for professional ethics to uphold trust reposed on CA services. Public has kept a lot of trust on the services that the chartered accountants provides. If we lose that trust, when will we lose that trust? If we don't follow ethics, if we are not integrity enough, if we don't maintain confidentiality, objectivity, if we don't behave professionally, of course public will lose trust on our work. Correct or not? So to keep that trust as it is, we have to follow professional ethics. Next, enhance confidence of intended users. This just now I told you. Code of ethics issued by ICI. So ICI has already issued the code of ethics, and in the code of ethics it has asked the members to follow these ethical requirements. So you have to follow. If you don't follow, what will happen? There will be disciplinary mechanism against you. Disciplinary mechanism means you will be punished. ICI will punish you if you don't follow ethical requirements. What are the ethical requirements? These are the ethical requirements, these 5. Understanding? Clear? Yes. Next, independence. With respect to independence, we have seen meaning of independence in the first chapter. So what is meant by independence? Meaning of independence: judgment of a person is not subordinate to the wishes and will of other person. So chartered accountant, whatever the decisions he makes, whatever the judgments he uses for making the decision, that should not be taken based on the direction, based on the will and wish of management or the other party. You have to take your own decisions in the audit. That is known as being independent, right? Yes. Now, perspectives of independence. There are two perspectives to independence. First one is independence in mind. In mind, being independence means actually the auditor is independent. Okay, in his mind, he knows that he is acting independently only. He has not lost his independence. That is known as being independent in mind. Okay, if you are independent in mind, it means that you are actually independent of the entity. Clear? Next one is independence in appearance. Independence in appearance means, let me tell you. So, this is our auditor. This is the company, client company. Okay, this is the company A Limited that he is auditing. Now, some third party. Okay, this is some third party, outside party. Now, if this third party looks at the relationship between auditor and client, that is A Limited, the third party should feel that there is there is a proper independence between auditor and the client. Okay, auditor is acting objectively only. Auditor is acting auditor is having utmost integrity. Like this, the third party should feel by seeing the relationship between auditor and the client. Then you will call it as independence in appearance. Appearance means for third party, by looking at the situation, by looking at the relationship between client and the auditor, he should feel, the third party should feel that auditor is actually independent. Okay, such a feeling should get. That is known as independence in appearance. Now tell me, is both independence in mind and independence in appearance, is both required, or having any one is sufficient? Of course, both are required. You should be independent in mind, and you should also be independent in appearance. Got it? Yes. So, independence in mind, independence in appearance. Next, threats to independence. Threats to independence means, threat means what? Something that causes the auditor not to follow independence, not to be independent, is known as a threat. Okay, something is causing the auditor not to be independent. You will call it as threat. See, something that prevents the auditor from being independent. Now, what could be these threats? There are 5 threats to independence. We will discuss each threat one by one. First one is self-interest threat. Self-interest threat, generally it will be in monetary terms. Monetary means, best example, auditor has invested in shares of the company. This is a self-interest that he is having interest in the company. Because of such interest, he cannot act independently. Another example, auditor is having some 10 clients. Okay, now see, auditor is having some 10 clients. From these 10 clients, he is receiving some fee of 20 lakh rupees. Okay, and there is one more client auditor is having. Okay, apart from these clients, these 10 clients, he is also having one more huge big client. From this big client, he is receiving 3 crores fees. So, of total 3 crore 20 lakh rupees, 3 crore is being received from one client only. That means auditor is hugely dependent on single client for most of the portion of his income. Here also he is having some interest because he is hugely dependent on one client only. This is also one of the example for self-interest threat. See, you always remember that self-interest threat will always be in monetary terms. Okay, next, self-review threat. Self-review threat means, example, you have prepared the financial statements and you only auditing that financial statements. Now, in this situation, tell me, can you act independently? You cannot. Let's say you have found a misstatement and you told the management that there is a misstatement, then what the management will say? Array auditor, you only prepared that financial statements na, like this management will say, correct or not? So this is known as self review threat. If you review, or if you review the work that is performed by you, then you cannot act independently, right? So this is the second threat to independence. Next, advocacy threat. Advocacy threat means, let me give you an example. There is a company A Limited for which you are doing audit. Now this A Limited is issuing IPO, it is listing its shares on the stock market. Now you, being auditor of A Limited, you have promoted shares of A Limited to the public. You told the public, see public, you invest in A Limited. A Limited is performing very good, its business is very good, like this you have promoted A Limited. Got it? And public believing you, they have invested in A Limited. Now after 2 years or after 3 years, you are only auditor now for A Limited. After 2 years or after 3 years, you have found some frauds in the financial statements of A Limited. Now, will you be able to report those frauds? If you report those frauds, all the public who have invested in A Limited based on your words will turn against you. Correct or not? So, if you advocate the entity to such an extent that you might lose the independence, you should not advocate the entity to such extent. Understanding, this is known as advocacy threat. Advocacy means promoting the client. Got it? So if you promote the client extensively also, you might lose the independence. Next, familiarity threat. Familiarity threat means, let's say you are auditor of A Limited for the past 20 years. So if you are auditing A Limited for the past 20 years, you should have developed a good bonding with the A Limited. A good relationship should be there between you and A Limited. 20 years is not a small time period, right? You should have become very close. Now after 20 years, in the 21st year, you have found some fraud in the financial statements of the entity will say that, auditor, please don't report this fraud. Now you are having a good relationship with the entity, you will listen to the entity, you will agree to the entity, because you are having a relationship with the entity, you don't want to spoil that relation. So this is nothing but familiarity threat. Here also in that example, you haven't acted independently because of the familiarity that you are having. Understood the familiarity threat? Yes. Next, intimidation threat. Intimidation threat means client is threatening you that he will remove you from the position of auditor, or client is having some 20 years experience, and you are recently qualified chartered accountant, you are having just 1 year of experience, and client has uh, made a particular accounting treatment for a particular item which is not as per accounting standards. You are saying that, see client, you have made this accounting treatment which is not as per the accounting standards. Client is saying that, see, you are just 1 year experience having, I am doing the same thing from the last 20 years. Then client is intimidating you with its experience. So there is a possibility that you also might think, okay, client is having 20 years experience, it should have a lot of knowledge. So what the client saying might be correct only, like this you might think, because you are having less experience, right? This is intimidation threat. Understanding? So these are the threats to independence. Now once you have identified these threats to independence, first of all tell me, should the auditor be independent? Yes, he should be independent. Now if he identifies any of these threats to independence means, because of this auditor cannot act independently. Now in such a situation, will you be silent, or will you take any action to remove those threats? Of course you will take the actions. So what actions you will take? First of all, you will try to eliminate that threat completely. Can I completely eliminate that threat? You will see, okay, the first possibility how to deal with the threats. You will first of all see whether I can completely eliminate, that means can I completely remove that situation. If it is not possible to completely eliminate the threat, I will see at least can I put some safeguards, so that the threat can be reduced to acceptable level. Like safeguard means, I'll give an example. Let's say for example, familiarity threat means, let's say I explained you ABC and Co chartered accountants, and there is X Limited is a company, right? X Limited is a company. Now in the ABC and Co chartered accountants, Mr. A is the engagement partner for X Limited. Okay, he is auditing X Limited for the past 20 years. So a familiarity threat could have been developed between this firm and X Limited. So the safeguard here that they can develop they can keep is, from the past 20 years Mr. A only auditing, right? From now onwards, we will appoint Mr. C as engagement partner. So Mr. C might be new. He might not be having any contact with X Limited. Mr. A is having contact because of past 20 years, but Mr. C is new. So we will allot X Limited audit to Mr. C. So this is safeguard. Because of this safeguard, threat can be reduced to an acceptable level. Understanding? Now, if you feel that you cannot reduce the threat to acceptable level even after implementing safeguard also, then only option that you have is not to accept the engagement or to withdraw from the engagement. Understanding? So desist from the task. Desist means not doing that particular task or the engagement, or don't accept that particular engagement. Getting it? So this is how you will deal with the threat to independence. Next, concept of professional skepticism. See, the concept of professional skepticism, I already told you. Professional skepticism involves three things. What are they? Questioning mind, being alert to the possibility of misstatement, and critical assessment of evidences, right? Questioning mind, critical assessment of evidence, and being alert to possibility of misstatement. So what kind of possibilities of misstatements can occur? Some of the examples, such as contradicting evidence. Contradicting evidence means two evidences are not matching. Example, sales invoice. So you are verifying debtors. While verifying the debtors, sale made to the debtor, sale invoice will be there, right? So on the sale invoice, amount is being shown as 10,000 rupees. Okay, this is the first evidence. You have sent external confirmation to the debtor. Debtor has sent a reply that I have to pay some 20,000 to the client, 20,000 to the company that you are auditing. So here one evidence is saying 10,000, another evidence is saying 20,000. Both evidences are related to same debtor only. So both are contradicting. Now auditor should become alert in this situation. Understanding? Yes. Next, question about reliability of documents. So if auditor gets any doubt about reliability of documents, like these documents might be fake, like this, if he gets any doubt, or these documents might be forged, if he gets such doubt, he should become alert. Okay, this happened in case of Satyam scam, right? In Satyam scam, what happened? That Satyam Ramalinga Raju, he has furnished fake fixed deposits. So, if auditors had exercised professional skepticism, there the Satyam scam would not have happened. Correct or not? Next, possible fraud. So, if auditor feels that there is a possibility of fraud, then also he should become alert. Next, circumstances suggesting need for additional audit procedures. So if he feels that the audit procedure that I have performed is not sufficient, I have to perform some more audit procedures to obtain proper audit evidence, then also he should become alert to the situation. Got it? Understood? Yes. So this is the first portion with respect to ethics. Now we will be entering into second part of this chapter, which is the essay 210. Essay 210 deals with agreeing to the terms of audit engagement. Now, if you observe, see, the standards that we will be discussing, that will be in a flow, which will be similar to practically how the audit will be conducted. Understanding? So if you see the flow that the institute has given in its study material, it is very clumsy. Okay, that is not same flow that you will follow in the practical life. in the practical audit. So I have rearranged the flow of auditing standards so that it will follow the flow of the practical audit. Getting it? So before starting the audit, you will first of all accept that audit, correct or not? You will enter into a engagement letter. So this complete scenario will be dealt by SA 210. Right now we will discuss SA 210. So see, SA 210, agreeing to the terms of audit engagement. So this SA 210 deals with three aspects. What are those three aspects? Let us see. First of all, so this standard covers when to accept or continue the engagement. So whenever any new client comes to you, when should you agree to that particular client? This essay will tell you. There should be preconditions. Only preconditions exist. You can agree to the client. So what are the preconditions? We will see. Next, audit engagement letter. Second aspect that will be dealt by this essay is engagement letter. What is engagement letter? It is a contract between the client and the auditor. Okay, we will discuss about that. And a single special case is there, which is recurring audits. These three things will be covered in this particular standard essay 210. Okay, now we will start with the first thing, which is when to accept the audit. You have to accept the audit only if preconditions are present. Preconditions means, pre means before. Before what? Before accepting the audit, there should be certain conditions, only then you can accept. What are those conditions? Let us see. So preconditions to accept the engagement. First of all, the financial reporting framework that is used by the management should be acceptable to the auditor. Financial reporting framework means, I told you in the first chapter, accounting standards, Indian accounting standards, these are the financial reporting framework that should be acceptable to the auditor, it seems. That means, see, let's say for example, in case of listed entity, the financial reporting framework applicable is Indian accounting standards, correct or not? Now, this listed entity, instead of following Indian accounting standards, it has followed accounting standards, and it is asking the auditor to do the audit. Will the financial reporting framework be acceptable to the auditor? No. Auditor will say that, see entity, you are a listed entity. For you, Indian accounting standards is applicable. Please prepare as per Indian accounting standards. Otherwise, I will not accept the engagement. This is the first precondition, wherein the financial reporting framework should be acceptable to the auditor. Got it? Yes. Next, management understands and acknowledges its responsibility. See, the second precondition is management is there. Na? Management should agree to its responsibility. What is its responsibility? It is having three responsibilities. First responsibility is to prepare financial statements as per applicable financial reporting framework. I told you, management has to prepare the financial statements, auditor will not prepare. So this has to be agreed by the management that yes, we will prepare the financial statements. Management. Next, management should also implement internal controls in the organization. To this responsibility also they should agree. And third one, management should agree that, see auditor, we will provide you all the information that we know, and if you ask any additional information, that also we will provide. Next, if you want access to any of the individuals within the organization or outside the organization, we will provide unrestricted access to all those people. So like this, management should agree. This is a precondition. Understanding? See, management understands and acknowledges its responsibility for preparing financial statements, establishing internal controls, provide the auditor with access to all information, additional information requested, and unrestricted access to persons in entity to obtain audit evidence. Clear? Yes. Next. So preconditions is done. Next thing is the terms of audit engagement. Audit engagement terms and conditions will be there na. There should be a common understanding of terms and conditions between auditor and management. So whatever the auditor is saying, that should be understood as it is by the management, and whatever the management is saying, that should be understood as it is by the auditor. So there should not be any misunderstanding between auditor and management. So if these two things are there, then you will accept the engagement. What are they? First one, preconditions should be there, and there should not be any misunderstanding. Clear? Yes. So the first part is done. Next, moving to engagement letter. So in the engagement letter, we will be seeing what will be the content of engagement letter, what will be the form of engagement letter, and if at all there has to be any change in the terms of engagement letter, whether it is possible or not, that we will be seeing, right? So first of all, what is meant by a engagement letter? Engagement letter means, see, whenever you are entering into any contract, you will have an agreement, correct or not? Now, the auditor is providing service to the client. For this service, there should be agreement, correct or not? The technical name that we give for this agreement is nothing but engagement letter. Okay, in this engagement letter, all the terms and conditions will be there. Getting it? So let us see what will be there in this engagement letter. So engagement letter, it is a agreement between auditor and management about the engagement. So terms that will be included in the engagement letter. First of all, objectives and scope. Objective means, I have already told you, objective means the goal. Scope means the area that should be covered by the audit. So what is the objective and scope? It will be clearly mentioned in the engagement letter. Next, responsibilities of the auditor. We will see about responsibilities of auditor in SA 700. There are a lot of responsibilities that the auditor is having. All that responsibilities should be mentioned in the engagement letter. Next, management's responsibility. Management also having some responsibilities. Just now we have discussed, right? Management's responsibility, prepare financial statements, internal controls, all those things, right? Those things will also be clearly mentioned in the engagement letter. Management's responsibilities. Next, identification of applicable financial reporting framework. So in the engagement letter, it should be clearly mentioned as per which framework management is preparing the financial statements, whether they are following accounting standards, Indian accounting standards, or any other framework. Why it should be clearly mentioned? Because at the time of acceptance, management might say that, see auditor, we have prepared financial statements as per accounting standards. After accepting the engagement, when you go and see there, the financial statements have actually been prepared as per Indian accounting standards. Then when you ask the management, you told that financial statements you have prepared as per accounting standards. Now here they are finding, I am finding as per Indian accounting standards. Then management will say that, no auditor, I have told that we have prepared as per Indian accounting standards only. Like this, management can change their words, correct or not? To avoid that, before, be cautious. Mention in the engagement letter which framework is followed for preparation of financial statements. Next, form and content of report to be issued. So after the entire audit is completed, auditor will issue audit report. What will be the format of that report? What will be the content of that audit report? That should be mentioned in the engagement letter. Now a question, this engagement letter, when you are preparing, before doing the audit or after doing the audit? Of course, before doing the audit only you are preparing the engagement letter. In engagement letter, they are asking you to include the format of audit report and content of audit report. The content of audit report, which type of opinion, which format, that all thing you will get to know only after audit is completed. Until and unless audit is not completed, you will not know what will be the format, what will be the paragraphs that will be included in the audit report. But they are asking to provide that in the engagement letter, right? So here what you have to do is, you have to give the basic format and the content that you are going to mention in the audit report, and you need to mention that the format and the content that I am prescribing here in the engagement letter, that is subject to change. Okay, after doing the audit, if I find, based on my findings, the format and the content of audit report can change, like that you have to mention a point in the engagement letter. Getting it? Yes. Next, changes in the terms of audit engagement letter. So in the engagement letter there will be terms and conditions. So you have wrote the terms and conditions, both management and auditor has accepted to those terms and conditions. Auditor started doing the audit. While okay, in middle of the audit you have completed some 20% or 30% of audit, okay, some percentage of audit is done. Now management is coming, see, auditor, we wanted to change the terms of audit engagement letter. Okay, audit engagement letter terms we want to change. Now in this situation, can auditor accept or not? Okay, change to terms, can it be accepted? Auditor has to see whether the reason that the management has given for change in the terms of audit engagement, is it justifiable? Okay, you should ask the management, what is the reason why you are asking me to change the terms of engagement? If that reasons are justifiable, okay, you will, if the reasons are justifiable, then okay, you will change the terms of audit engagement. If the reasons are not justifiable, then you will not agree to change the terms of audit engagement. If at all you have, see, if the answer is yes, the reasons are justifiable and you have agreed for changing the terms of audit engagement, new terms should be written in a engagement letter, new engagement letter, and that has to be signed. If you have not agreed to change the terms of audit engagement letter and management is not allowing you to continue the engagement with existing terms, then the option, the only option that you have is, you have to see whether you can withdraw from the engagement. Understanding? In this situation, option is withdrawal. Understanding? Now I told you, if management asked for change in the terms of audit engagement, you have to see whether reason is justifiable. So standard has given two situations in which the reason should be considered as justifiable. What are the two situations? See, only in these two situations you have to consider the reasons as justifiable. Apart from these two reasons, any other reason you will not consider it as justifiable. So what are the two reasons? First of all, there is a change in the entity's requirements. Okay, so let's say for example, I will give you the example. Entity wanted a loan, it went to the bank. Banker told that entity, you get me audited financial statements. So entity went to the auditor, auditor, I want audited financial statements, please start the audit. Auditor started the audit. In middle, the banker, the bank manager called the entity, management of entity, and said, see management, I told that I wanted audited financial statements. Now audited financial statements are not required, by mistake I told you, just review of the financial statements is sufficient. Review is sufficient, he told. Review means limited assurance. Understanding? So now the requirement of the entity itself has changed, the circumstances itself, the requirement itself has changed. Now entity will go and say the auditor, auditor, we want to change the terms of audit engagement. Auditor will ask why. Entity will say, see auditor, earlier our bank manager told that they wanted audit, but now they are saying that just review is sufficient, limited assurance is sufficient, you please change audit engagement to review engagement. Now this is permitted, this will be treated as a justifiable reason, auditor will accept for the change in the terms of audit engagement. Understanding? This is the first reason. Second reason, misunderstanding of nature of service. So while entering into the terms of audit engagement, entity misunderstood the terms of audit engagement. In such a situation also, that reason can be considered as justifiable reason. Understanding? See, entity doesn't know technicalities of what is the limited assurance, what is the reasonable assurance. Entity wanted the books to be audited, so entity went to the auditor and said that, see auditor, you audit our books of accounts. Okay, audit means reasonable assurance, entity doesn't know that. Understanding? Entity, the management, they haven't learned the audit, correct? They are not expert in that. So they told that we please conduct the audit. Now audit means what the auditor will do? Complete all audit procedures he will perform. Now entity said, auditor is asking for all random documents, all the procedures he is performing. Now management said, see auditor, why you performing all these procedures? I have asked only for uh, small assurance, limited assurance. Now saying, Entity said that now. Now auditor said, see, management, you told me audit. You used the term audit. Audit means reasonable assurance. If you wanted limited assurance, you should have used the term review, but you used the term audit. Now entity came to know about the definition, the difference between audit and review. So entity misunderstood, and now entity is asking, see, please change that terms to review. We don't want audit. Understanding this is also can be considered as a justifiable reason. Getting it? Yes. So in these two situations, you can accept. Yes, accept for change in the terms of audit engagement. If no, if the reasons are not justifiable and management doesn't permit original terms, the only option is you have to withdraw from the engagement. Getting it? Yes. Next, if you have accepted for change in the terms of audit engagement, you have to see, because you have already performed 40-50% of the work. Now you are changing the terms and performing a new engagement, either review, let's say. In this situation, you have to see whether the work that has already been performed by you, can it be used for the new changed engagement. You have to consider it. Okay, work performed till the date, can it be relevant for the changed engagement? Next, legal or contractual implication also you have to see. So if I change the terms of audit engagement, if I accept for change in the terms of audit engagement, should I have to redraft the engagement letter and again sign it? You need to consider it. Of course, you have to redraft the engagement letter, include the new terms in the engagement letter, and get it signed it again. Right? And report shall not refer to original audit engagement. Okay, to the original engagement, the report should not refer. Getting it? Yes. Next, note, if law or regulation prescribes above terms, auditor need not record them in written agreement. See, all these terms and conditions, okay, all these terms and conditions that should be there in the engagement letter are already prescribed in law or regulation. Let's say, for example, you are doing audit of a bank. In case of bank, RBI Act is applicable, right? So RBI Act clearly specifies what are the terms and conditions of engagement. Since Act itself is having the complete clear terms, auditor again need not write those terms in the engagement letter and send the engagement letter. Understanding? Yes. Next, limitation on scope prior to engagement acceptance. Limitation on scope means management is not allowing the auditor to perform some of the procedures. Management is limiting the auditor. Like management is saying that auditor, you don't send the external confirmation to debtor. Auditor, you don't attend physical information. You don't attend physical inventory verification. Like this, management is putting limitations on the scope of auditor. In such a situation, see, limitations on scope of auditor when before accepting the engagement only. Okay, you have not at all accepted the engagement, before only it is putting some limitations. You don't do that, you should not do this, you should not do that, like this it is telling. In such a situation, if auditor feels that with all these limitations having, if I accept the audit engagement, I have to give disclaimer of opinion. Okay, disclaimer of opinion we will see in the reporting chapter, SS 705. So if auditor feels that with these limitations, if I accept the audit, I will have to give a disclaimer of opinion, then better not to accept the engagement. Okay, shall not accept such engagement. Getting it clear? Yes. Next, concept of recurring audit. Recurring audit means, quickly I'll tell you. So financial year 1, in the financial year 1, Mr. A has been appointed as auditor. Financial year 2, in the financial year 2, Mr. B has been appointed as auditor. Financial year 3, again Mr. B only appointed as auditor. Now in the financial year 3, Mr. B is auditor. In the previous financial year also, Mr. B only auditor, right? So the the financial year 3 audit will be recurring audit for Mr. B, and financial year 2 audit will be initial audit engagement for Mr. B, because he is auditing it for the first time, and financial year 3 he is auditing it for the second time. Previously also he only audited, so this will become recurring audit. Okay, now further going, financial year 4, Mr. C got appointed. okay, some other auditor. So, and for financial year 5, again, Mr. B got appointed. Now tell me, will the audit of financial year 5, will it be recurring audit or initial audit for Mr. B? You have to just check. Previous year who audited? Mr. C audited. Current year who auditing? Mr. B auditing. So Mr. B is auditing the first time. Okay. You need not check the previous of the previous year. You have to just check only one previous year. So previous year some other auditor has audited. Mr. B is auditing freshly now. So it will be initial audit engagement. Understanding? Yes. Now my question is, for initial audit engagement, you will send engagement letter, correct or not? With all the terms and conditions, you will send engagement letter. Whether for recurring audit also, should you send new engagement letter, or can you use the same old engagement letter? The answer is it depends. If certain circumstances are present, okay, if certain circumstances are present, then you should consider sending a new engagement letter. Otherwise, you can continue with the old engagement letter. Now, what are those circumstances? Let us see. See, recurring audits means the audit performed by an auditor over the years. Is new engagement letter required for recurring audit? The answer is, if following factors are present, then it may make it appropriate to revise the terms and send a new engagement letter. What are those factors? First of all, indication that entity misunderstood the objective and scope. So, previous year, auditor has issued an engagement letter, and the auditor felt that entity has not properly understood the objective and scope of the audit. Then what the auditor will do? For the current year audit, he will again detailedly draft the scope and objective, and he will again send a new engagement letter to the entity. Understanding? So if you feel that entity not properly understood scope and objective, you should send again new engagement letter. Next, revised or special term. Of course, if there is change in the terms of the engagement itself, you have to send a new engagement letter. There is no option. Next, change of senior management. Okay, in the previous year, the managing director, CEO, those people are not present in the current year. Okay, in the current year, the managing director, CEO, they have changed. Then these new people who have come in the current year itself, they would not have knowledge about the engagement letter that was issued in the previous year. So you have to again issue new engagement letter to these people again, because there is a change in the top management. Similarly, if there is a change in the ownership also, you should give new engagement letter. Next, significant change in the nature or size of the entity's business. So in the previous year, the size of the entity was, its revenue was just 10 crore. In the current year, its revenue increased to 1000 crore. So the way you audit the entity will change. So you have to send a new engagement letter, because the size of the entity or the nature of the entity has changed. Next, change in the legal or regulatory requirements. Okay, if at all there is any change in the law or regulation, if let's say there is change in section 143 subsection 1 or subsection 3, or there is change in CARO requirements, then of course, to implement those changes, you have to send a new engagement letter, right? Next, there is a change in the financial reporting framework. Accounting standards have changed. Indian accounting standards have changed. Then also, you need to consider whether there is a requirement to send new engagement letter. See, if these situations are present, it is not mandatory that you have to send a new engagement letter. You have to consider whether to send a new engagement letter or not. Getting it? Yes. Next, change in other reporting requirements. Other reporting requirements means this only. Okay, apart from the reporting requirements that are required as per the as per the auditing standards, whatever the other reporting requirements are there, like 143 subsection 1, 143 subsection 3 of Companies Act, CARO 2020, all these becomes other reporting requirements, because these reporting requirements are not prescribed under auditing standards. These are some other reporting requirements as per some other law and regulation. If there is change in these other reporting requirements, then also you should consider whether you have to send a new engagement letter. Understanding? Yes. So this is the second chapter. I hope you properly understood this particular chapter. If you feel that this revision has helped you, you have to comment saying the best, because I need to get some motivation, right? Yes. Now we'll go to third chapter. We will revise third chapter. Let me open third chapter chart. Yes, opened third chapter. So third chapter, it deals with planning the audit. If you see, we have completed SA 200, SA 210. Now going to SA 300. In the SA 210, we have dealt with audit engagement letter. That is, before accepting the audit, how you will enter into engagement letter, right? Now, after entering into the engagement letter and after you have accepted the auditor, you will start the audit, right? So while starting the audit, you will first of all plan your audit, right? So basically, there are three stages in the audit. What are those three stages? Firstly, planning stage, which will be of course dealt by SA 300, which we are discussing now in this chapter. So this chapter entirely it covers SA 300, which completely deals with planning the audit. Next, execution stage. There are various standards that cover with this execution of the audit, which is the second stage. Finally, after you have executed the audit, you will obtain audit evidences, and based on that audit evidences, you will give your opinion in the audit report. So which is reporting stage. Reporting stage is the final third stage, which will be dealt by 700 series. So complete 700 series deals with reporting. These are the three stages of audit. Now we are in the planning stage, which is SA 300, planning and audit of financial statements. Now you can get it out, sir, why planning is required for the audit? See, let's say for example you are going for a tour. Will you plan your tour or not? Which places you have to visit, how to travel, how many days, all these things you will travel or not? After all, for a tour you are planning, and audit such a serious job. Will you do the audit without planning? Do you know what will happen if you do the audit without planning? You cannot do effective audit in an efficient and timely manner. Understanding? So when someone asks you why you have to plan the audit, you have to say that we should plan the audit to do effective audit in an efficient and timely manner. Now, sir, what is meant by effectiveness and what is meant by efficiency? See, these two terms, they are very much important. We will be seeing them lot of times. So first of all, let us understand the difference between effectiveness and efficiency. So quickly, I'll give you an example. You are preparing for your CA examinations, right? You are preparing for both the groups. Two groups you are preparing. You wrote the examination and you have cleared only one group, let's say for example. Then it will be said that you are 50% effective. If you have cleared both the groups, then it will be said that you are 100% effective, right? So effective means achieving your objective. How much of your objective have you achieved? That is effectiveness of audit. Understanding? So what is the objective of audit? To obtain reasonable assurance, right, that financial statements as a whole are free from material misstatements. So how much of that objective has been achieved will be measured in terms of effectiveness. So if you don't plan the audit properly, you cannot do the audit effectively. You cannot achieve your objective. Understood what is meant by effectiveness? Now going to efficiency. Let's say for example, the same example, CA exams, there are two students, Mr. A, Mr. B. Mr. A is preparing for two groups. Mr. B is also preparing for two groups. Mr. A has studied for 6 months. Mr. B studied for 3 months. Both of them, they wrote examinations. both of them cleared both the groups. Mr. A cleared both the groups, Mr. B also cleared both the groups. Now here both of them are effective only, but who is efficient? Mr. B is efficient because he used less resource, 3 months only, for clearing the or for achieving the target, but Mr. A used 6 months. So efficiency is comparison between input and output, understanding, that is efficiency. So if you plan the audit, you can do the audit in a efficient manner. That means with less resources you can achieve maximum output. What will be the resources in case of audit? See, the article staff itself will be the resource, the paid assistants, these people will be the resource in case of audit, and also time will is also resource in case of audit, and even money is also resource in case of audit. So all these resource you will utilize less if you properly plan the audit, understanding. So you can efficiently and effectively do the audit in a timely manner if you properly plan the audit. Getting it? Yes. So that is the purpose why you will plan the audit. Now you can say, sir, what are the benefits of planning the audit? See, you will have a lot of benefits because of planning the audit. First of all, you can focus on more important areas. See, you can devote your time on most important areas, and you will also get to know potential problems. Potential problems means the problems which might occur in the future. That problems now only you will get to know if you properly plan the audit, understanding, resolve potential problems. Potential means future problems. Now only you will get to know, and you can prepare proper solutions to resolve those problems. You just think this like preparing a plan for your CA inter examination preparation. So during preparation, you will prepare a schedule. This time, this date, I will go with this subject like this. You will prepare a schedule, correct or not? Now, because of that schedule, what will happen? You can focus on more important areas, and also if there are any potential problems, like you wanted to study at morning 5 o'clock, you want to wake up. The potential problem is you will be sleeping, you might not be able to wake up. So the thing is, you have to sleep early in the night so that you can wake up early in the morning. That is the solution for the potential problem that might occur. Like this, planning will help you identify potential problems. Next, properly organize and manage the audit. So once you have the clear plan, everything will be under your control. Okay, so every situation will be under your control so that you can properly manage everything. That is also one of the benefit. Next, selection of engagement team members. So in the planning stage itself, you will get to know how much difficult to audit this entity, which experience is required to audit this entity. Since you will get to know all these things, in the engagement team you will include those people who are having that experience, understanding. So planning will also help you to decide to select engagement team members. Next, direction and supervision of engagement team. You can give guidance, you can supervise the engagement on the work that they have done with the help of planning, and coordination of work done by others, such as experts. So during the audit, you have to utilize the work of various experts. One of the example, let's say for example, inventory is present beneath the earth, like oil or petroleum is present beneath the earth. Now auditor cannot go beneath the earth to identify the existence of inventory. He will use work of some experts, right? So in such a situation, whether there is any requirement for the expert, that you will get to know in the planning stage itself. So you can properly coordinate with the expert from prior hand itself. We will be covering this in essay 620, but however essay 620 you don't have in your syllabus, but essay 500 you have. In essay 500 we will be dealing with management's expert. Essay 620 deals with auditors expert. Auditors expert concept, CA inter you don't have, but management expert concept you have in essay 500. While discussing management expert, you will get to know. Next, elements of planning process. So what elements are there in the planning process? Firstly, there are certain preliminary engagement activities. Preliminary engagement means, preliminary means before starting the engagement you will perform certain activities known as preliminary engagement activities. What are these preliminary activity engagement activities? If you see in SA 210 we have seen some preconditions, and even in the quality control chapter we will be seeing certain client acceptance and continuance procedures. In SQC1 we will discuss the client acceptance and continuance procedure. That means in order to accept the client or not to accept the client, you will perform certain procedures like verifying integrity of the client, whether your engagement team is having competence, capability to perform the work, and also if you accept the work, will you be able to comply with the ethical requirements? These things you will see while discussing quality control chapter SQC1. So these are nothing but preliminary engagement activities. So planning includes preliminary engagement activities also. See, client acceptance and continuance procedures as per SQC1 standard on quality control. There we will discuss in depth about client acceptance and continuance procedures. So what will these client acceptance and continuance procedure include? First of all, verifying integrity of principal owners. See, here they are speaking not about the integrity of auditor, but integrity of client. Is client having integrity, or client is involved in any money laundering activities? These things you will verify about the client and decide whether to accept him or not. If you find that client is a fraudulent person, client is number one fraudster, there are a lot of cases against him, then you will uh, not accept the engagement, correct or not? So first one is checking the integrity. Next, competence of engagement team. Next, client is fine, client is a good person, but your engagement team is not having experience, expertise to do the work of client, then you will not accept the engagement, correct or not? If your team is not having proper knowledge to discharge the work, that is also preliminary engagement activity, one of the client acceptance and continuance procedure that you will perform. Another client acceptance and continuance procedure, communication with predecessor auditor. Predecessor auditor means previous auditor. Before client has approached you to audit the books of accounts in the last year, someone would have audited, you will call him as predecessor auditor, and you will once communicate with the predecessor auditor. Predecessor auditor, why client is has come to me instead of going coming to you? Is there any issues? Like this you will communicate with the predecessor auditor. This will help you in deciding whether to accept the engagement or not to accept the engagement. Next, implication of current and previous audit engagements. So if the auditor has already performed certain work for the client, the findings that he has found during that work will also be considered by the auditor in deciding whether to accept this engagement or not. This is also one of the client acceptance and continuance procedure. Next one is compliance with ethical requirements including independence. This is also a client acceptance and continuance procedure. So if you accept this client, will you be able to comply with all the ethical requirements? Will you be able to comply with independence? If you feel that if you accept this client, you cannot act independently, you cannot comply with ethical requirements, then you will not accept the client, right? So this, when you are deciding, before accepting, before starting the audit only you are deciding this, so you are calling this as a preliminary engagement activity, understanding? So preliminary engagement activities are also part of planning process, as I told you. Okay, elements of planning process include preliminary engagement activities, and preliminary engagement activities includes all these things. Next, understanding terms of engagement. This we have seen in SA 210, one of the precondition to accept the audit. Clear? Almost all of those things we have already discussed. Next, planning activities. So, in the planning process, see, you should not confuse. Planning process is different from the planning activity. Planning process is broader, and planning activity is one part of planning process. Planning process includes both preliminary engagement activity as well as planning activities. Getting it? Now there are three planning activities that you will perform. First one is preparation of overall audit strategy. Now what is meant by overall audit strategy? See, overall audit strategy is a broader one which will establish what has to be done and when it has to be done. So, sorry, overall audit strategy will give you answers to two questions: what has to be done and when it has to be done. Okay, see, addresses what and when of and sets scope, timing, and direction of audit. So, what and when will be answered by strategy. I will also give you example. Once I discuss plan, also I will give you example. Next one is developing audit plan. So, developing audit plan. Plan covers, see, plan is more detailed in nature. Plan covers how it has to be done. So, in the strategy, see, let's say for example, there is a company. That company wanted to increase sales. So, for increasing sales, first of all, it will prepare a strategy. Strategy will be always prepared first. That you need to remember. So, strategy covers what has to be done, right? Now, to increase the sales, you can either launch new product, correct or not, or you can expand to new location, correct or not, or you can increase the sale price. So all these are the options. So what you wanted to do in order to increase the sales? Let's say you have chosen to launch a new product. So your strategy is to launch a new product, and strategy will also cover when it has to be done. Let's say you wanted to launch new product after 6 months. So what has to be done, when it has to be done, will be answered by strategy. Next, to achieve the objective specified in strategy, you will have to prepare plan. So what will be your plan to launch a new product? First of all, you should identify new product. So you will perform research and development to identify a new product, to develop a new product. Once a new product is developed, that has to be manufactured. So you will spend money on a plant, the factory for manufacturing. After that, you should also market the new product. So marketing expenditure. So this is the plan. So how you want to achieve that, the thing that is specified in strategy will be dealt by the plan, and plan will be more detailed when compared to strategy. Getting it? So these are the things that you need to remember. Strategy is brief, plan is more detailed. Strategy is prepared first, then plan is prepared. Plan is always prepared based on strategy. Strategy answers what has to be done and when it has to be done. Plan answers how it has to be done, which is more detailed. Got it? This is the difference between strategy and plan. See, so that is developing audit plan, which is the second aspect of planning activity. So addresses how and contains the list of audit process. Plan is based on strategy. Got it? See, here you should not confuse. Observe what I am saying. There are three things. First one, planning process, which is broad, which includes the preliminary engagement activities and planning activity. Okay, planning activity is different from planning process. Again, this planning activity includes audit plan. Audit plan is a final document. Getting it? And planning activities include three things: audit strategy, audit plan, and audit program. Now what is audit program? So here audit plan, you have prepared the audit plan for entire company, for entire financial statements you have prepared the audit plan, but audit will be done by article assistants, right? Let's say there are three article assistants. Now you will say article assistant 1, you audit assets. Article assistant 2, you audit liabilities. Article assistant 3, you audit revenue and expenditure. Like this, you will divide the work. Now, you have to give a clear instruction to the article assistant about how they have to execute that work. For giving a clear instruction to the article assistant, you will prepare audit program. Okay, so audit program will be specific to individual audit assistant for guiding him on how to do the activities that are allocated to him. Getting it? This is audit program. So see, audit program is a detailed step-by-step procedure on how to audit an item given to the assistant. This is the three things involved in planning activities. Tell me, what are the three things that are involved in planning activities? First one, strategy, audit plan, and audit program. Once we complete discussion of these three things, our standard gets completed, our chapter gets completed. Let us start with audit strategy, overall audit strategy. Now, what are the benefits of this overall audit strategy? See, overall audit strategy offers you benefits with respect to resources. That is, what quality of resources has to be used for this particular audit. Resources here means, you always remember article assistants, paid assistants, and the employees of the audit firm. They are resources. So, which quality of resources I have to use? How many resources, that is how much quantity of resources I have to use, and at what time I have to deploy those resources, and how to manage these resources. Regarding these four aspects, the audit strategy will help the auditor understanding. So these are the four benefits of the audit strategy. You should remember that audit strategy will always give you the benefits with respect to resources, whereas entire planning process, you see here, there are benefits of audit strategy, and we have also discussed benefits of planning, right? Benefits of planning audit, both are different. For benefits of planning audit, there are six benefits, and for overall audit strategy, there are four benefits which are completely related to resources. So you remember it like that. So employment of qualitative resources, quantity of resources, timing of deployment of resources, and management of the resources. Next, factors while establishing audit strategy. See, this is very important. While you develop the audit strategy, you need to consider five factors. What are those five factors? First one is characteristics of the audit. Characteristics of the audit means, see, if you ask what are the characteristics of a person, what will you say? He is having some white hair, his height is some 6 feet, and he is having huge eyes, he is having spectacles. Like that, you will say characteristics of a person. Similarly, there will be characteristics even for audit also. So examples of those characteristics: which financial reporting framework management has used for preparation of financial statements. That is one of the best example for characteristics of the audit. So you need to consider what are the characteristics of the audit for preparing overall audit strategy. Another example for characteristics is in which industry the entity is operating. This is also one of the characteristic understanding. So identify characteristics of the engagement. That is the first factor. Second factor, you should also identify what are the reporting objectives. Reporting objectives means, see, in case of a normal company, you have to give audit report, which is your reporting objective, and you should also give CARO if it is applicable. Correct or not? Generally these two will be there, but in case of banking company, your reporting objectives will be even more. You have to give audit report. You have CARO is not applicable for banking company. You have to give LFIR, long form audit report. There will be various certifications like certificate on interest subvention, certificate on provisioning norms, NPA norms, like this various certificates will be there. All those reportings you have to give in case of bank. Correct or not? So you should also ascertain what are the reporting objectives for this audit engagement. So first two factors. Next, you should also consider this point. I will tell you. You should also consider result of preliminary engagement activities. Preliminary engagement activities. Just now I told you as per SA 210 preconditions, and also as per quality control, client acceptance and continuance procedures you will perform verifying the integrity. If you remember, just here itself we have discussed preliminary engagement activities: integrity, competence, compliance with ethical requirements, right? So the results of these preliminary engagement activities, that also you need to consider. So what did you do? First of all, you have identified characteristics of entity or characteristics of audit engagement, and you have also identified reporting objectives, right? Next, you have also identified results of preliminary engagement activities. Now, based on these three things, the remaining two factors will depend, that is, in which direction efforts of engagement team has to be focused. So where engagement has to focus more, so this will be decided based on characteristics of entity, reporting objectives of entity. So what are the timelines for reporting and the results of preliminary engagement activities. So characteristics of entity, while understanding characteristics of audit, you found out that there will be high risk of material misstatement in a particular area. Then engagement team's efforts will be focused on that particular area. If you identified a particular area is very material, then engagement team's efforts will be focused on that area. Correct or not? So these three factors will impact the fourth factor, which is efforts of engagement team. Next, the fifth factor will also be impacted by these three things. What is the fifth factor? Nature, timing, extent of resources. Here, resources means you should always remember resources means the audit assistants, article assistants, paid assistants, all these people are the resources for the audit firm. So, how many audit resources are required? That will be determined based on characteristics, reporting objectives, and results of preliminary engagement activities. Okay, those two are the remaining factors. See, factors that are significant in directing engagement teams' efforts. In which direction engagement teams' efforts has to be directed, and nature, timing, extent of resources necessary to perform engagement activities. Got it? So these, okay, this one, this one, on these three factors, the remaining fourth one, fifth one will be depended. Got it? Yes. So while designing the audit strategy, you need to consider these factors. Next, so that is about audit strategy. Now going to the audit plan. I told you audit plan is more detailed when compared to the strategy. Audit plan will be prepared after strategy is prepared, and audit plan is prepared based on the strategy. All these points I told you. Now what will be there in the audit plan? Audit plan contains risk assessment procedures, further audit procedures, and additional audit procedures. These three things will be there. So what are these risk assessment, what are these further audit procedures? We will cover them while discussing SA 315. Getting it? See, contents of audit plan. I told you audit plan will be very much detailed. It will contain planned risk assessment procedures. Risk assessment procedures you will perform as per SA 315. So risk assessment procedures, you will perform them to identify the risk. See, there is a link by performing risk assessment procedures, you will identify in which area there is a risk. Once you have identified the risk, then to respond to this risk, you will design further audit procedures. Understanding? So planned further audit procedures as per SA 330. So by performing the risk assessment procedures, you identified that risk. So in to deal with that risk, you have designed further audit procedures. Now by performing further audit procedures in that area, you have identified actual misstatements. Understanding? So by performing further audit procedures, you will identify actual misstatements. Getting it? See, this one we will see in SA 315 in detail, the interlinking between this risk assessment procedure and further audit procedure. There I will also give you the examples for these procedures. Okay? Yes, sir. Next, other planned audit procedures. So these things will be there in the audit plan. Clear? Yes. Next, documentation. Of course, you have to document overall audit strategy, you have to document audit plan, and you should also document any significant changes that are made to this strategy and plan during the audit, and who have made that change and why that change is made. All these things you need to document, right? Yeah. Next, audit strategy and audit plan. So what is the relationship between audit strategy and audit plan? This I have already told you. Strategy is prepared before the plan, and plan is more detailed than the strategy. All these I have told you. Strategy and plan are interrelated. If you change one, other also will change. Strategy provides guidance for developing the plan. This is a relationship between a plan and strategy. Next, responsibility for strategy and plan. That means who has to prepare strategy and who has to prepare audit plan. Of course, auditor has to prepare audit plan and audit strategy. Management will not prepare. Management's responsibility is to prepare financial statements, not the audit strategy and audit plan. Correct or not? Yes, sir. So see, it is the auditor's responsibility to prepare audit plan and audit strategy. And see, engagement partner and other key members should be involved in planning. So in the planning stage, you should involve the engagement partner, and other key members should also be encouraged to take part in the planning activities. Next, auditor may discuss planning with the entities management. So whatever the plan that you have prepared, can you discuss this with the entities management? See, if you discuss this with the entities management, there is a possibility that entity will get to know what areas auditor is going to audit. So entity will take all the steps to ensure that frauds in that area are not found out by the auditor. Correct? There is this possibility. If prior to performing the procedure itself, auditor tells to the entity that I am going to audit this area. So what auditor will do is, auditor has to communicate about his plan and strategy, but he has to take care that objective of the audit will not be compromised because of such communication. Because if you don't communicate with management about the plan and strategy, they cannot facilitate, they cannot arrange the required documents that are necessary for your audit. So for that purpose, it is very much important to communicate about your plan and strategy to management. But while communicating, you please take care that you don't compromise on the objectivity of the objective, arriving at the objective of the audit. Okay, objective of audit should not be compromised due to that communication. See, care to be taken not to compromise on effectiveness of the audit. Next, effectiveness means achieving the objective goal is nothing but effectiveness. I told you with the example also. Next, can plan or strategy be changed during the audit? Of course you can change. It is not that once you have prepared the plan and strategy and it is final, you can't change it. No, as the audit passes, as you found out new circumstances, as you found out new information, you can continuously keep on changing plan and strategy, right? So some of the situations because of which strategy and plan might have to be changed. See, result of unexpected events or changes in the conditions have changed, because of which you might have to change your plan and strategy. Next, audit evidence obtained, change in law, notification or government policies. So all these things might cause the auditor to change his plan and to change his strategy. Getting it? Yes. Next, so I told you, you have to document audit plan, audit strategy, and any changes that are made to audit plan and audit strategy. Now, what is the benefit of such a documentation? Okay, how it will be useful if you document these things? See, benefits of such documentation. It will act as record of key decisions. So the important decisions that you have taken during the audit, the documentation will help to properly maintain as a record of all those decisions. That is one of the best benefit. Next, record of nature, timing, extent of RAP, risk assessment procedures that you have performed. Next, record of reasons for change in the strategy and plan. If at all you have changed the strategy and plan, why did you change the strategy and plan? You will get to know that if you properly maintain the documentation. Understand? These are the benefits of documentation. Next, moving to the final part. So we have covered audit strategy, audit plan. Now we will discuss audit program. Once audit program is completed, this chapter, the revision of this chapter gets completed. Clear? Yes. See, see, audit program. Now, audit program, what did I tell you? Audit program, it will be prepared specifically to each article assistant with respect to his work, with respect to work allotted to him. That is the audit program, right? So, audit program consists of list of verification procedures, verification that has to be done by the article assistant. That procedures list will be there in the audit program. Now the question is one audit program suitable for all the audits? So you have designed one audit program and you are using the same audit program for audit of all the entities. Can you use it like that? No, because the nature, circumstances of the entities will differ. You cannot prepare one audit program and use it for all of them, right? So one audit program is not practicable for all the businesses. You have to develop custom audit program for each of the business, right? Yes. Now, businesses vary in nature, size, and composition. I told you. So, efficiency and operation of internal controls also will vary. So, the way how internal controls are operating in a particular organization will be different from the way internal controls are operating in another organization. So the way you have to verify internal controls differs from organization to organization. So you cannot use the same audit program for all the organizations. So these are the reasons why you cannot use same audit program for all the organizations. Next, points to be considered in constructing audit program. So while developing a audit program, what points you should consider? You should consider scope and limitation of assignment. So what is the scope of audit? You need to consider it while developing audit program. Next, audit program must be written format. So it should be a written audit program. Next, identify the best evidence available. So in the audit program, what will be there? List of audit procedures will be there. So the list of audit procedures that are there in the audit program should be in such a way that by using that audit procedures you can obtain the best evidence possible. Okay, the audit procedures designed should be in such a way that the best possible evidence can be obtained by performing the audit procedure. Okay. Next, audit objective for each area. So while developing the audit program for each area, you need to decide, you need to know, you need to consider what is the objective behind auditing that particular item. Let's say you are preparing audit program for a fixed asset. Now, what is the objective behind auditing fixed asset? You wanted to know whether fixed asset is actually present. You wanted to know whether depreciation has been properly calculated on fixed asset, right? So, to achieve these objectives, you have to design the audit procedure. Understanding like this for each area, you should know the audit objectives. Next, possibilities of error. So while determining the audit program, designing the audit program, you should also consider what could be the possibility of error occurring in this particular area. So all these things you need to consider before drafting a audit program. Clear? Yes. Next, now there is a possibility that in the audit program you are giving the list of audit procedures, and you are telling the article assistants, you please perform this particular audit procedures, you discharge your duties like this. You are giving a clear set of instruction. Now there is a possibility that audit assistants will perform just whatever is there in the program, and they want to go beyond the program. There is such a possibility, correct or not? If you don't go beyond the program, what will happen? You cannot identify all the audit procedures. See, it is not possible to design audit program for all the situations. As the audit progresses, you have to perform additional procedures also which are not there in the audit program. Audit program will provide a initial stage, initial procedures for performing the audit, but once the audit progresses, you need to suitably alter audit procedures. You should also perform additional audit procedures. You should not just uh, stick to that audit program, correct or not? So you need to instruct to the article assistants, see article assistants, I am giving this audit program, you follow this audit program, but don't just stick to this audit program. You keep open minded during the audit. If you face any areas, if you feel like performing any additional audit procedures, you happily perform additional audit procedures. Like this, you should encourage the article assistants. Getting it? See, assistant to keep open mind. Auditor develops a standard audit program to provide minimum essential work. So how the audit program will be developed? First of all, a standardized audit program will be designed, and for this standardized audit program, see, program may be altered as the experience is gained. Okay, you will take the standardized audit program and you will alter this standardized audit program that is that will be suitable to the entity as you gain the experience. So similarly, unnecessary procedures may be dropped off. So in the standard audit program, if there are any unnecessary audit procedures, those audit procedures you will drop off from the audit program. Next, so because of this reason, assistant should be encouraged to keep open mind beyond the program. Getting it? So you should ask the assistant, see assistant, you follow this audit program, but don't just stick to this audit program, you go beyond the audit program, you keep open minded. Getting it? Yes sir. Next, there are certain disadvantages because of this audit program. One of the disadvantage I already told you, or the article assistant might just stick to the audit program. Let us see. Work may become mechanical. Of course, you have given list of procedures and asked the article assistant to perform this. Then for the first audit it will be okay. For the second audit it will be okay. From third audit, fourth audit onwards, the same procedures he has to keep on performing. So it might become routine and mechanical to the article assistant. So to overcome this, you should ask the article assistant to keep open minded. Clear? Next, rigid and inflexible. So if you just give a list of procedures, it might become rigid and inflexible. Inefficient assistants may take shelter behind the program. So inefficient assistants, what they will do is, the assistants who don't want to perform the work, without performing the work, they will say that if principal has asked, why did you not perform that work? He will simply say that it is not written in the audit program. So inefficient assistants, what they will do is they will not go beyond the program. Just whatever is there in the program, they will do that and they will sit silent, even though there is a necessity to do additional work and additional procedure. Understanding? So these inefficient assistants might take a shelter under this audit program. Getting it? Yes. Next, it may kill the initiative of efficient and enterprising assistants. So assistants who want to explore more, those assistants might feel like their hands are tied up with this audit program, right? So these are some of the disadvantages. Now, to overcome this disadvantage, there should be proper imaginative supervision of the work that is done by the article assistants. Auditor must have a receptive attitude. So whatever the suggestions that the article assistants or the paid assistants are giving, auditor has to happily accept them and act upon them. And assistants should be encouraged to observe matters objectively. Objectively means based on facts. Don't uh, take biased decisions. So you should encourage the article assistants to observe the matters objectively. Getting it? Yes. Next, some of the advantages of the audit program. This is the last concept of this particular chapter. So what advantages the audit program will give? First of all, it will set clear instructions. No confusion will be there. If you have a audit program, clearly instructions you can give to article assistants. Next, total perspective of work to be performed. So you will get an idea of what is the total work that has to be there, and of this how much is done, still how much is pending. So just like if you see this particular chart, in these 3 pages you will get a total perspective of entire chapter number 3. Correct or not? Like this, audit program also will give you total perspective of entire audit that has to be done. Next, avoids overlooking of certain books and records. So you will not take verification of certain books and records negligently if you have a detailed program, since you will be going as per that program. If the verification of that records is covered in the program, you will verify them, right? Next, responsibility for the work carried out by putting the signature. So in the audit program, you will give audit program to a particular article assistant, asking him to do this work. So how the audit program will be there is, it will contain list of procedure and findings, list of procedure to be performed and findings. Like this entire list will be there, and at the end, the signature of the person who have performed this procedure should be there. Sometimes be, beside this only will be there, okay, list of procedure, remarks, and who performed this procedure. Like this it will be there. So if this is clearly written down in the audit program, who executed this particular work, you can fix accountability on that particular article assistant, you can fix responsibility on that particular person who have done the work. Clear or not? This is also one of the advantage. Next, control the progress of audits. So the principal auditor is there now, he will he will be generally carrying out lot of audits simultaneously. His engagement teams will be doing them. He has to oversee lot of audits, 10 to 15 audits will be there, let's say, for example. Now, by seeing the audit program of each article assistant, the principal auditor, engagement auditor, will get to know how much work has been done by this person, still how much work is pending. So you can track the progress with the help of audit program. Next, guide for audits to be carried out. It will act as a guide for the audit that has to be done by the article assistant. Got it? So these are the advantages of a audit program, and this is complete revision of chapter number 3. I hope you enjoyed this revision. I hope this revision helped you a lot. If you feel this revision helped you, you know what to do. You have to give me motivation by commenting the best lecture. Got it? Yes. So now I'll open chart for the 4th chapter. Yes, I have opened chapter number 4. Now, chapter number 4, it deals with risk assessment and internal control. Two aspects will be dealt. Basically, if you see, till now we have discussed SA 200, SA 210, and we have also discussed SA 300, right? These standards we have discussed till planning stage. Now we will be moving into the next stage, which is part of execution stage. So here in this chapter we will be covering 5 standards. So the standards that we will be covering here are, firstly, SA 315. Now if you remember, I told you that the audit that the auditor conducts is a risk based audit. In the risk based audit, what will happen? Auditor will first of all identify the risk by performing RAP, risk assessment procedures. These risk assessment procedures will be discussed in this SA 315. Risk means what? Risk means the term risk you will use to specify something negative, right? So in case of audit, risk means the risk of occurring misstatement, right? So let me tell you the linking between the standards that we are covering. Okay, so here now I will be telling you the linking, how each of the standard is linked with the other standard. So as per SA 315, you have identified the risk, not actual misstatement you have identified. Okay, you have not identified actual misstatement, you have just identified the risk. Now once you have identified the risk, by seeing this risk, will you be just silent? No, you will design procedures, you will design a further audit procedure to respond to this risk, correct or not? So the next stage is that only, respond to the risk. How you will respond? By performing further audit procedures, which we will discuss in SA 330. So 315 is covered here, 330 is covered here. Now by performing these further audit procedures, you will identify actual misstatement. Once you have identified the actual misstatement, you will evaluate that misstatement, correct or not? So is this misstatement small, is this misstatement big, will this misstatement have impact on the entire financial statements, or is this isolated? Like this you will evaluate that misstatement, correct or not? So evaluate the misstatement. So evaluation of misstatement will be dealt by SA 450. Understanding? So did you understood how 315, 330 and 450 are interrelated to each other? Now there is also SA 320. Now you have identified this misstatement in SA 330 by performing further audit procedure. You always remember that auditor is concerned only with the material misstatements. He is not concerned with the immaterial misstatements. Now how to identify which misstatement is material, which misstatement is immaterial? SA 320 deals with materiality. Understanding? So even SA 320 is also related to this SA 315, 330 and 450. Understanding? Now as part of this SA 315, apart from assessing the risk, we will also be verifying internal controls. Now in this internal controls, if you find any deficiency in the internal control, you will communicate that deficiency to those charged with governance and management. Do you know what is difference between those charged with governance and management? We will also be discussing that. Okay, so internal controls deficiencies you will communicate to those charged with governance and management, which will be dealt by SA 265. Understanding? So this way we will be discussing 315, 330, 450, 320, 265. All the 5 standards which are linked to each other will be covered in the single chapter. Clear? Yes. So I gave you the brief idea of the chapter that we are going to cover and how each of these standard is linked to each other. Now starting with the chapter. So just now I told you the standards covered here are SA 315, which is identifying and assessing the risk of material misstatement through understanding the entity and its environment, right? Next, SA 320, which deals with materiality. Next, SA 330, auditor's responses. SA 450, evaluation of the misstatements, and SA 265. So these are the standards that we will be covering. let us start with the first standard, SA 315. Now, what is the name of SA 315? See, by seeing the name of SA 315 itself, you can get to know a lot of things. See, what it says, identifying and assessing ROMM. ROMM means risk of material misstatement. So, you will be able to identify and assess the risk. How you will be able to identify and assess the risk? By understanding the entity and its environment. Okay, so if you properly observe, if you properly understand the entity and its environment, you will get to know what are all the risks that are there in the entity. Understanding, see, not only the entity, whatever the area you are going to audit. Let's say you are going to audit sales. Will you directly audit the sales? No. First of all, you will understand what risks are there in the sales. How you will understand what risks are there in the sales? By understanding the item of sales, you will get to know risks involved in the sales. Getting it? So the risk assessment of any item you can perform through understanding that item. Getting it? Yes. So that is the name of the standard and the content that we are going to discuss. So before starting the standard, let us understand a particular term, which is assertion. So what is meant by the what is meaning of the term assertion? So assertions are representations made by management to the auditor. So how management will make the representations? Let me tell you. Management, they will prepare the financial statements. So financial statements means balance sheet, P&L. So in the balance sheet, management shown assets value 2 crore rupees and given to the auditor. That means management is asserting to the auditor, see auditor, the entity is having assets worth 2 crore rupees. This is nothing but a assertion. So assertion means telling to the auditor that something is true, is known as assertion. So if in the balance sheet entity shown liability is worth 5 crore, means what? It means that entity is having obligation to pay that liability. So entity is saying the auditor, see auditor, we are having obligation to pay 5 crore rupees. That 5 crore rupees is correct only. Like that you are asserting to the auditor. Now auditor duty becomes to verify whether that assertion made by the management is correct or wrong. That is nothing but the audit that the auditor will do. Getting it? Yes. So understanding the term assertion. Assertions are the representations by management, either explicit or otherwise, that are embodied in the financial statements. Where these assertions will be present? In the financial statements will be present. Understanding? Now these assertions, you can classify them into three categories. Assertions with respect to class of transactions. Where the class of transactions will be there? In the profit and loss statement. Correct or not? So other assertions with respect to class of transactions, assertions with respect to account balances means balance sheet, and assertions with respect to presentation and disclosure. So into these three categories you can categorize the assertion. Now each category is further having certain assertions. Let us see. So assertions with respect to class of transaction. Class of transaction means you should always remember P&L items. So with respect to P&L items, that is sales, purchases, expenditure, what assertions you will have? Occurrence assertion. So sales have actually occurred. Like this you are asserting to the auditor by showing sales in the profit and loss statement. Next, completeness. Whatever the sales that we have shown in the P&L, that are complete. We haven't missed any sales from entering into the P&L. Like that the management will assert to the auditor. Next, accuracy assertion. Accuracy assertion means during the year 1 crore worth of sales has taken place and we have shown 1 crore rupees in the P&L. That is accurately we have shown the amount in the P&L. This is accuracy assertion. Next, cut off assertion. Cut off means, see, you will prepare the financial statements for one particular year, correct? So the transactions that have occurred in the current year should be shown in the current year financial statements. Transactions which are related to the previous year, you should not show in the current year, and transactions that are related to next year should not be shown in the current year. That is nothing but cut off assertion. So you are asserting to the auditor, only transactions that occur during the current year we have shown in the P&L statement. Getting it? Yes. Next, assertion related to classification. Classification means revenue items should be shown in the P&L, capital items should be shown in the balance sheet. This is the classification of the items, correct or not? So you are asserting the auditor, we have properly classified these transactions into revenue and capital. Getting it? So in the P&L statement, by giving a P&L statement to the auditor, management is making all these 5 assertions. Similarly, while giving a balance sheet also, management will make these assertions. Existence assertion. So in the balance sheet, assets will be there. So you are telling to the auditor, whatever the assets that we have shown in the balance sheet that are actually present, that are actually in existence. Clear? Yes. Next, rights and obligation assertion. Rights and obligation assertion means the auditor, whatever the assets we have shown in the balance sheet, entity is having right over that asset. Whatever the liabilities we have shown in the balance sheet, entity is having obligation to pay off those liabilities. Like that you are making the assertion. Next, completeness assertion. Completeness assertion means, see, in the balance sheet we have shown assets worth 5 crore, so that is complete, we haven't missed any assets. Similarly, with respect to liabilities, clear? See, next, valuation and allocation. Valuation means the value of asset you have shown as 5 crore rupees. So we have correctly valued that asset as 5 crore rupees after reducing the depreciation. So all these assertions you are making to the auditor in the form of balance sheet. Getting it? Yes. Next, similarly, assertions with respect to presentation and disclosure. So presentation and disclosure can be with respect to both balance sheet items and P&L items. So the mix of both assertions will be there here. See, occurrence assertion I have explained you, completeness assertion, classification and understandability, accuracy and valuation. So these are the assertions with respect to presentation and disclosure. Clear? I guess you understood the concept of assertion. Next, moving to the concept of audit risk. So this term risk means, see, the term risk you will use to specify something negative, right? So risk of getting heart attack, risk of, you know, occurring a accident if you drive fastly, so risk of getting killed if you smoke. So the term risk you will use to signify something negative, right? Now they are saying audit risk. What is meant by audit risk? See, audit risk, it is basically of two types. First of all, when there are misstatements in the financial statements, then which type of opinion you have to give? You have to give modified opinion. But risk that if there are misstatement in the financial statements, you might give unmodified opinion, is the audit risk. Understanding? So audit risk means nothing but risk of giving inappropriate audit opinion. See, risk of expressing inappropriate audit opinion, and this inappropriate audit opinion can be of two types. First one is, as I told you, you will if there are misstatements. See, when financial statements are materially misstated, you have to give modified opinion, but you are giving unmodified opinion, so you have given inappropriate opinion, wrong opinion. This is one type. Second type is, see, If financial statements express an opinion that financial statements are materially misstated when they are not. That means in the financial statements, actually there are no misstatements. But you are saying that, see, if there are no misstatements, which type of opinion you have to give? Unmodified, clean opinion you have to give. But you are giving a modified opinion. This is also giving a wrong opinion, correct or not? So this is a second type of inappropriate opinion. Now you remember that only first type of inappropriate opinion will be called as audit risk. Second type of inappropriate audit opinion will not be called as audit risk, because here in the financial statements, actually there are no misstatements. So if there are no misstatements, that's fine. But by mistake you gave modified opinion. In this situation, what will happen? You will have to perform some more audit procedures to prove that actually there are no misstatements, correct or not? This is very insignificant, and this will affect efficiency of the audit. Why efficiency will be affected? Because you have to spend more resources to prove that actually there are no misstatements in the financial statements. Understanding? See, I'll explain you in depth because this is very much basic. So, inappropriate audit opinion, you can give it in two ways. So, if there are there are misstatements in the financial statements, then actually you have to give modified opinion, correct? But instead of giving modified opinion, you have given unmodified opinion, correct? So this will affect effectiveness of audit. Why it is affecting effectiveness of audit? Because you are not able to achieve your goal. If you are not able to achieve your goal, you are not effective, correct or not? So what is your goal? If at all there are misstatements, you have to identify them and give a modified opinion. But in this situation there are misstatements, but instead of giving modified opinion, you are giving unmodified opinion. That means you haven't achieved your goal, so you are not effective. This will affect the effectiveness, correct or not? Which is more serious, correct or not? This is more serious. This should never happen. Second situation, there are no misstatements in the financial statements. If there are no misstatements in the financial statements, which type of opinion you have to give? Unmodified opinion you have to give, correct or not? But instead of giving unmodified opinion, you have given modified opinion. So in this situation, if you give modified opinion, will management be silent? Management will say, see auditor, there are no misstatements in the financial statements, because actually there are no misstatements. Management know that. So management will ask you again, do the audit properly and verify. So what auditor has to do here? Here he has to again do the audit, spend more time, spend more resources to do the audit, to prove that yes, there are no misstatements. So this is affecting efficiency of the audit, correct or not? So this is insignificant. This can be rectified once you perform more work. Since this is insignificant, this will not be treated as a audit risk. Okay, so this entire second scenario is not audit risk. Only this first scenario is the audit risk. Getting it? Yes. So that's what this will say. So this will affect effectiveness. First scenario will affect effectiveness, second scenario will affect efficiency, and this second scenario is not considered as audit risk because this is insignificant. Only first scenario will be considered as audit risk. Next, audit risk, it can occur because of error or fraud. What is the difference between error and fraud? Error means unintentional mistake, fraud means intentional misstatement, right? Yes, that is the concept of audit risk. Now moving to risk of material misstatement, romum. Let us see. So first of all, what is meant by misstatement? In the first introduction chapter itself, I told you what is meant by misstatement, right? If there is a difference between ACPD that is required by the applicable financial reporting framework and ACPD that is followed by the management for preparation of financial statements, then you will call such a situation as misstatement. I have explained this concept in the revision of first chapter, right? You can go to the first chapter and check this. I have explained this, right? The same thing will be the definition. The definition, it will not change, right? Yes. Next, components of audit risk. This is also the important concept. So this audit risk is there na. Audit risk is combination of inherent risk. I will tell you with the example. So you know cash. So if there is a cash, then cash is having inherent risk of theft. Cash is subjected to theft. There is an inherent risk by birth. The quality of cash is such that everyone wanted to steal the cash, correct or not? So this is a inherent risk. So audit risk is combination of inherent risk. So let's say for example, see, inherent risk means risk that is present by birth is known as inherent risk. Now let's say inherent risk of cash being subjected to theft is 50%. So there is a 50% chance that cash will be subjected to theft. Now, knowing that the cash or any item will be subjected to theft, that is knowing the risk, will you be silent? No, you will try to reduce that risk, correct or not? For reducing that risk, what you will do? You will implement internal controls, correct or not? Now, if you implement the internal controls, is it 100% guarantee that internal controls will detect all the misstatements? If you have internal control, is it 100% guarantee that the item will not be subjected to theft? No, right? Internal controls have inherent weaknesses. So internal controls cannot reduce the inherent risk completely. They can reduce the inherent risk to some extent, correct or not? So in the area of cash, you have kept CC cameras as the internal control, but CC cameras were able to detect only 75% of risk. Remaining 25% still it is as it is there. So the risk that internal controls will not be able to detect, prevent, correct misstatements is known as control risk. So the second component of audit risk is control risk. Now, in our example, how much is the control risk percentage? 25%, right? Of the total inherent risk, 75% is reduced. Still balance 25%, controls also were not able to reduce. So, inherent risk multiplied by 25%. So, how much you will get? 50% multiplied by 25%. I guess it is 12.5%. So, 50% inherent risk is reduced to 12.5% with the help of controls, correct or not? Yes. So controls reduced 50% of the inherent risk to 12.5%. Now you will call this as this 12.5% as risk of material misstatement, nothing but romum. Got it? So this is how you will calculate the romum. So romum is combination of inherent risk and control risk. Now, this inherent risk and control risk, these are not in the hands of auditor. Auditor cannot see, by the time auditor came to the audit, these risks are present already. Correct? Now, auditor has to reduce this risk of material misstatement in order to maintain his audit risk to lower level. So this audit risk is there na. While starting the audit, auditor would have kept acceptable level of audit risk. That means if audit risk is this much, it is okay, I will be happy. Like that, auditor will fix a acceptable level of audit risk. Let's say for example, in this example, auditor has fixed acceptable level of audit risk as 2%. That means auditor can accept maximum of 2% audit risk. Getting it? That means now the task of auditor is to reduce this 12.5% of risk of material misstatement to just 2%. How you will reduce it? By performing audit procedures. You will perform audit procedures and identify the misstatements and ask the management to correct the misstatements. So this way you will reduce 12.5% risk of material misstatement till 2%. Getting it? Now your audit procedures also cannot detect complete misstatements. Correct or not? So the risk that audit procedures cannot detect complete misstatements is known as detection risk. Getting it? So final component is detection risk. Now this detection risk is in the hands of auditor because audit procedures are performed by auditor only. So detection risk, he will keep it in such a way that okay, the total audit risk reduces to 2%. Now tell me, how much should be the detection risk? 12.5% multiplied by detection risk, it should get reduced to 2%. That means detection risk is equal to 2% by 12.5%. That means how much you will get? You will get it 1.6%. So detection risk should be 1.6%. That means 98.4% of the risk of material misstatement should be identified by performing procedures. Just to balance 1.6% detection risk he can accept. So if detection risk is 1.6%, his overall audit risk becomes 2%. Getting it? Yes sir. I'm just cross verifying it whether it tallies or not. You also once cross verify. Yes, it is getting. So this is the concept of audit risk. So see, components of audit risk. I guess now you got a clarity of what is audit risk and the components. It is inherent risk, control risk, detection risk. So inherent risk means susceptibility of an assertion to misstatement that could be material either individually or when aggregated with other misstatements before consideration of any related controls. That means if there are no controls, the chance that the item can be subjected to misstatement is known as inherent risk, which is present by birth. Next, control risk. Control risk means risk that misstatements will not be prevented, detected, corrected on timely basis by the entity's internal control is known as control risk. Now, combination of inherent risk and control risk is the risk of material misstatement. Correct or not? Yes. Next, finally, detection risk. So risk that procedures performed by auditor to reduce audit risk to an acceptably low level will not detect the misstatements is known as detection risk. So these are the components of audit risk. And you need to assess the risk of material misstatement at two levels. First of all, at the assertion level. At the assertion level means we have seen the assertions. You will take the fixed asset and you will check what is the risk that the amount of fixed asset might be wrong. What is the risk that the fixed asset might not be in existence? What is the risk that the entity doesn't have right over the fixed asset? Like this, assertion wise you have to calculate the risk. Similarly, you should also calculate the risk at the entire financial statement level. Got it? Yes. Next, steps in identifying and assessing the risk of material misstatements. Basically, there are 4 steps in identifying and assessing the risk, which are very simple. First of all, you will identify the risk through understanding the entity. Once you have identified the risk, you will assess that risk, whether that risk is material, whether that risk will impact many items. Like this, you will assess it, right? Assess the identified risk. Once you have assessed the risk, you will relate the identified risk to what can go wrong at the assertion level, which is a third step. And finally, you will consider likelihood of that risk turning into the actual misstatement. These are the 4 steps that you will perform in risk assessment. So these 4 steps will be performed by whom? By auditor. Auditor will perform these steps for risk assessment. Next, audit procedures. See, this concept of audit procedures we will see in SA 330 also. In this chapter only, in the coming chart we will see. So while seeing 330, we will discuss these audit procedures. Again, why? But however, yes, we need to discuss audit procedures here only, because there is risk assessment procedure. Risk assessment procedure is covered in 315 only. Okay, we'll discuss it here only. That's the reason why I gave it here. Okay, we can't skip it now. So audit procedures. Audit procedure means, see, the procedures that the auditor perform: external confirmation, vouching, inspection, all these are some of the examples for audit procedures, correct or not? Now, these audit procedures are of 2 types, broadly 2 types. You can further classify them. Firstly, risk assessment procedure. I told you this concept just now as per SA 315. So risk assessment procedures, the procedures that you will perform for identifying and assessing the risk are known as risk assessment procedures. So basically, the risk assessment procedures that you will perform are inquiry, analytical procedures, and inspection and observation. These are the 3 risk assessment procedures that you will perform. We will see those 3 risk assessment procedures. Next, further audit procedures. So by performing risk assessment procedures, you have identified the risk. Once you identify the risk, you will provide your response by designing further audit procedures. These further audit procedures, they are again of 2 types. Firstly, test of controls. Test of controls means the procedures that you will perform to verify whether controls are operating effectively or not is known as a test of controls. And next one is substantive procedures. Substantive procedures means detailed procedures. See, these substantive procedures, you can again further classify them into 2. First one is test of details. Test of details means, best example for test of details is vouching and verification. These test of details, they can again further be classified into 2. Test of balances, nothing but vouching, which is verification of balance sheet items. Next, test of transaction, nothing but verification, understanding. So test of details can further be classified into test of balances and test of transactions. And substantive analytical procedures. What are these analytical procedures? See, in SA 520, we will see what are these analytical procedures. As of now, you have to remember a important point, that is, analytical procedure you can use as both further audit procedure as well as risk assessment procedure. If I told you, if you remember, I told you risk assessment procedures are three. What are those? I told you, firstly inquiry, next one is analytical procedure, right, and the final one is observation and inspection. So if you see analytical procedure repeated two times here, analytical procedure is risk assessment procedure, and analytical procedure can also be used as a further audit procedure. In SA 520, I will tell you how you can use analytical procedure as both risk assessment procedure as well as the further audit procedure. Getting it? Yes. And one important point you need to remember that understanding the entity is a continuous and dynamic process. See, under this SA 315, your entire job is to identify the risk. For identifying risk, what you will do? You will perform risk assessment procedures. One of the risk assessment procedure is main one is understanding the entity. Okay, so you will understand the entity. By understanding the entity, you will get to know what risks are there in that entity, correct or not. So understanding the entity is a continuous process which you will perform for identifying the risks that are there in the entity. Getting it? So apart from understanding the entity, you will also perform, see, the following risk assessment procedures. So perform to obtain understanding of entity and its environment. These will include three procedures. I told you these procedures. First one is inquiry. Now, what is meant by inquiry, sir? Inquiry means asking questions and getting answers to those questions. To whom you will ask questions? You will ask questions to management. You will ask questions to those charged with governance. You will ask questions to employees. You will ask questions to creditors. So, to whomever people you wanted who are related to the management, who are related to the entity, you can ask questions, you can discuss with them, and you will get answers. So through that answers, you will identify the risks that are there in this particular entity. So inquiry is the first risk assessment procedure. Next, analytical procedure. So what is this analytical procedure? Tell me, should I tell you here or should I tell you in SA 520? Okay, since here we are discussing SA 315, I will tell you how you can use analytical procedure as a risk assessment procedure. How you can use analytical procedure as further audit procedure, I will tell you in SA 520. Okay, yes. Now, analytical procedure. Analytical procedure means you are analyzing. What you can analyze? You can analyze profit trend, correct or not. So in the past 5 years, the profit of the entity is increasing at a rate of 5%, but in the current year profit has increased at 30% or 50%. Now will you get a doubt or not? Will there be a risk or not? Yes, because in the past 5 years the trend is a 5% increase, but current year suddenly 50% it increased. So you have identified risk by analyzing the situation, correct or not. This is the analytical procedure performed as risk assessment procedure. Understanding? Yes. Now only I will tell you how to use analytical procedure as substantive procedure so that it will be clear. So let's say for example, you wanted to verify salaries expenditure that is shown in the profit and loss statement. Generally, how you will verify? You will take the salary vouchers, you will take the bank statement, you will take the entries that are shown, all those things you will take and you will match, you will vouch. This is regular procedure. Another option available is you can use analytical procedure. How? You can ask the management, give me list of complete employees. Let's say they are having 10 employees. You will ask the management, on an average how much salary you are paying to them. Management might say we are paying on an average 15,000 per month. For some employees it might be 10,000, for some employees it might be 20 or 25,000, but if you average it, it gets to 15,000 per employee. Okay, per month. So multiplied by 12 months, how much you will get? 15,000 into 10 into 12, so 18 lakhs, right? Now 18 lakhs should be the salary expenditure that should be shown in the P&L as per your analysis. Now, if let's say in the P&L exactly 18 lakhs only shown, then fine, you got audit evidence about salary expenditure without detailedly verifying it. Correct or not? If let's say salary expenditure that is shown in the P&L is 19 lakh, which is different from the analysis that you made, then what you will do, you will identify the reasons why 19 lakh is coming in the P&L, but for me it is 18 lakh. There might be a possibility that some employees have worked only for 10 months. Understanding, if they have worked only for 10 months, then what will happen, they will not be at the end of year, management might not have included them in this 10 number. So for them also, the management has paid salary, that will be included in the P&L. So this difference might be because of that, like that you will analyze. Getting it? So this is how you will use analytical procedure as further audit procedure. Clear? Yes. Next one is observation and inspection. Simple observation means, let's say the entity's employees are performing physical verification of inventory. You will stand and you will observe whether they are properly counting or not. That is nothing but observation. Inspection means you yourself will inspect the boxes of the inventory, whether actually goods are present in that boxes or not. That is known as inspection. So observation and inspection, through observation and inspection also you can identify the risk. Understanding? So these are the three risk assessment procedures that you can use. Next, so now, risk assessment procedures you will perform for obtaining understanding of the entity. So, what are some of the examples of items of which you will obtain understanding? Let's see. Obtain understanding of the following items. So, relevant industry in which entity is obtained. See, I told you that for identifying the risk, you have to obtain understanding of the entity. How will you understand the entity? By understanding the following factors, you will get a understanding of complete entity. So you should understand, you should know in which industry entity is operating. Is it banking industry? Is it automobile industry? Is it hospital industry? Is it some manufacturing industry? Like that you need to understand the nature of industry, regulatory and other external factors, including the applicable financial reporting framework, whether accounting standards is applicable or Indian accounting standards is applicable. So all these forms part of understanding the entity. Next, you should also understand nature of entity. Is it a company? Is it a partnership? Is it a individual? Is it a cooperative society? So what is the nature of entity? Next, entity selection and application of accounting policies. How entity is selecting and applying accounting policies, that also you need to understand. Next, entities objectives and strategies and those related business risks. So entities objectives means what are the goals of entity, to achieve those goals what strategies the entity is using, and what business risks it might face in achieving that particular goals or the objectives. So you need to understand this aspect also. Clear? Yes. Next, measurement and review of entities financial performance. So you should also measure and review financial performance, means P&L statement. Got it? So by understanding these things, you will be able to understand the entity, complete entity. Next, significant risk. What is meant by significant risk, sir? Significant means some important risk which you need to focus more on. Correct? So significant risk is having two characteristics. If these two characteristics are there, you will call it as significant risk. Let us see what are those two characteristics. First of all, higher magnitude of potential misstatement. Higher magnitude means if that misstatement occurs, its impact will be very huge. it will affect a lot of amount, that is known as magnitude. Magnitude means impact. You might be seeing in the televisions, if the earthquake occurs, they'll say the magnitude of earthquake is huge. That means impact earthquake has created is huge. Understanding like that. If the magnitude of the risk is huge, and there is higher likelihood of occurrence, that means the chance of that risk occurring is very high. So the chance of risk occurring is high, and if that risk occurs, the magnitude it creates is also very high. If these two characteristics are there for any risk, you will call it as a significant risk. Clear? Yes. So, significant risk means risk that require special audit considerations. So, while identifying whether the risk is a significant risk or it is not a significant risk, you have to consider certain factors. What are those factors? We will see. So, see, this significant risk is important. Significant risk is having two characteristics, and in order to identify whether the risk is significant or not, you need to see the following factors also. So first of all, whether it is a risk of fraud. If it is a risk of fraud, then there is a high chance that it might become significant risk. Correct or not? Next, whether risk is related to recent significant economic accounting or other developments. Okay, the risk that has, if the risk is related to the recent economic developments, let's say for example, entity has, not entity, the company, sorry, the government has issued new accounting standard. Now this is a new accounting standard, and entity has to comply it. Since it is the first time entity is complying, while complying with that accounting standard, entity might wrongly interpret it, and entity might wrongly calculate the values. So this, there is a risk of misstatement here. This risk is because of new changes in law or regulation. So this risk can become a significant risk. Correct or not? Yes. Next, complexity of transactions. So if the transactions are highly complex, then the risk that is there in that transaction can also be a significant risk. See, it is not that if these factors are there, for sure it is a significant risk. No, you have to verify. Okay, you have to consider these factors are there. Will it be a significant risk? You have to consider. Understanding? Yes. Next, whether risk involves significant transactions with related parties. So, does the risk involves any significant transactions with related parties? So, if the transaction is with related party and there is a risk in that transaction, then that can become a significant risk. This is also one of the factor. Next, degree of subjectivity in measurement of the financial information. Subjectivity means the measurement of a particular item is based on your emotions. Then if at all there is a risk in that measurement, that risk can become significant risk, because you are not making that estimation based on facts and figures. Instead you are making that estimation based on your emotions only. Clear? Next, transactions that are outside the normal course of business. Normal course of business means entity, let's say, is dealing in the sale of cars. So, selling the cars and purchasing the cars is a normal course of business. Let's say suddenly entity has sold a land which is not in the normal course of business. Entity's business is not to sell the land. So, if at all there is any risk in that particular transaction of selling the land, then that might become a significant risk, because that transaction is not in the normal course of business and there is a risk in that transaction, then that risk can become significant risk. Getting it? So, these factors you need to consider in determining whether the risk can be a significant risk or not. Clear? Yeah. Now, standard has told that, see auditor, these risks, first of all, risk of fraud and transaction with related party which is outside the normal course of business, both together. Okay, a transaction which is outside the normal course of business has taken place with the related party. So these two, first one and this one, will always be treated as a significant risk. Clear? See, always treated as a significant risk. What are they? Risk of fraud and transactions with related parties that are outside the normal course of business. These two risks will be always treated as significant risk. So this second transaction is combination of this one and this one. Clear? Yes. I guess by this we have completed essay 315. No, not yet completed. Still there is discussion of internal controls. Now, what is meant by internal control? The simple example for internal control, CC cameras is a simple example for internal control. There is a technical definition also for internal control. Let us see the meaning of internal control. See, it is very easy to remember and understand this meaning. Let me tell you. So, internal control means it is a process, correct or not? Internal control is a process which is designed, implemented, and maintained. Who will design, implement, and maintain the internal control? Whose responsibility it is? By those charged with governance or the management and other personnel, right? And the purpose is why? What is the purpose of internal control? To provide reasonable assurance about the achievement of entities' objectives with regard to following four things. What are the four things? Achieving reliability of financial reporting. That means in the financial statements there are no misstatements to achieve that reliability. Next, effectiveness and efficiency of operations, safeguarding of assets, compliance with applicable laws and regulations. That means to comply with the requirements of laws and regulations, to keep the assets safely, and to achieve utmost efficiency and effectiveness in the operations. I told you what is meant by effectiveness and efficiency. I told you now while explaining it, we will be using this term effectiveness and efficiency lot of times, right? Yes. So to achieve these four objectives, the process that will be maintained, implemented, designed by management to those charge governance in the organization is known as internal control. Clear? Yes, sir. Now, I will ask you a question. Think. Is auditor having any responsibility to provide opinion on internal controls? Answer is no. Auditor is not having any responsibility to provide opinion on the internal controls, because if you see SA 200, the objective of auditor, it doesn't speak a single word about the internal control. What does the objective says? To obtain reasonable assurance about whether the financial statements as a whole are free from material misstatements, whether due to fraud or error, thereby enabling the auditor to obtain thereby enabling the auditor to express an opinion on whether financial statements in all material respects are prepared in accordance with applicable financial reporting framework, and to report thereon. This is the objective. Now, in this objective, did you find internal control anywhere? No, right? So, auditor is not having any responsibility to report on the internal controls. Then, why auditor is verifying the internal controls? See, by verifying the internal controls, the duty, the job of auditor becomes easy. How? I guess I told you this. So, let's say sales transaction. Before verifying the sales transactions, auditor will not directly perform audit procedures on sales. What will he do? He will first of all verify internal controls that are operating around the sales. By verifying the internal controls that are operating around the sales, if auditor feels that these internal controls are operating effectively, then the audit procedures that the auditor can perform on sales will be less. Correct or not? If auditor finds that internal controls around sales are not operating effectively, then audit procedures that the auditor has to perform on sales will be more. Correct or not? So to help the auditor to decide how much audit procedures he has to perform, he will first of all verify the internal controls. So to make his job easy, he is verifying the internal controls, correct? Yes. Now you can ask me a doubt, sir, then why SA 265 is asking the auditor to communicate deficiencies in the internal control to management and those charged with governance? SA 265 is that only, communicating deficiencies in internal control with management and those charged with governance. If you see, SA 265 communicating deficiencies in internal control and those charged with internal control to those charged with governance and management. Why 265 is asking the auditor to communicate deficiencies in internal control? See, SA 265 says that, see, auditor, however you are verifying internal controls, I have not put any responsibility on you to verify internal controls, but to make your job, however you are verifying internal controls, right? So during such verification, in case you find any deficiencies, you just bring them to the notice of management. Okay, only those deficiencies you find, you bring. I am not asking you to bring all the deficiencies. I am also not asking you to verify all the internal controls. I am not putting any responsibility, but however you are verifying for making your work easy, so if in case you find any deficiencies, just bring them to the notice of management or those started with governance, so that they will correct, they will improve the internal controls, correct or not? Yes. But however, there is an exception to this. Internal controls over financial reporting. Internal controls over financial reporting means in the process of preparation of financial statements, some controls will be established. Auditor has to give opinion only on these controls. Apart from these controls, auditor need not give opinion on any other controls. This requirement is also applicable only in the listed companies. Okay, listed companies and some other companies. So apart from that listed companies, in other companies, auditor need not give opinion even on this also. Getting it? Yes. So internal control over financial reporting means controls that are established over the process of preparation of financial statements is known as internal control over financial reporting. This we will be learning in the 6th chapter. Okay, we will be revising this concept next. So what benefits you will get because of understanding the internal control? See, you will be able to identify types of potential misstatements. So if, let's say for example, you identified that internal control in this area is not working properly, then the chance that misstatements will be there in this area will be there, right? So you have identified the potential misstatements that can occur. So internal control is helping you to identify that. Next, identifying factors that affect risk of material misstatements. So what factors will affect Romam? I told you, inherent risk, control risk. These two are these two, if you combine, you will get Romam. So by understanding the internal control, you can identify inherent risk and control risk. Clear understanding? Yes. Next, designing the nature, timing, extent of further audit procedure. Of course, based on risk assessment procedures only, your further audit procedures will depend. In the risk assessment procedures, you identified that risk is low, then your further audit procedures will also be less. If you identified that risk is more, then your further audit procedures will also be more detailed, right? So this understanding the internal control will help you to design the nature, timing, extent of further audit procedures. Yes. Next, see, I told you already in the introduction chapter, these internal controls, they are having certain inherent limitations. So what are the inherent limitations of internal control? See, internal controls can provide only reasonable assurance that there are no misstatements. It cannot provide absolute assurance. It cannot detect 100% frauds, 100% errors. Next, human judgment in decision making. See, in some situations, internal controls can be manually implemented, like some segregation of duty. can be manually implemented. Segregation of duty is an internal control. So you have divided the duty among three people. So in this situation, there is a possibility of human error, human judgment in decision making. So in case of manual internal control, the limitation is human judgment, human decision making is involved. Each person will take the decision in a different manner. Correct. Next, lack of understanding the purpose. So there is a high possibility that internal control can be established or performed without actually understanding why this is established, right? Next, collusion among employees. So collusion, when it can occur in case of segregation of duties, collusion can occur. So you have divided the work to three employees. Now the three employees, they might collude together and do the fraud. Correct or not? So this is also the limitation of internal control, collusion of employees. Next, judgments by management and limitations in case of small entities. See, for the small entities, the resources they will be having is very much limited. With the limited resources, they might not be able to afford to the internal control systems, right? These are the limitations of internal control system. Next, components of internal control. So there are five components to this internal control. So basically, if you see the vehicle you drive, the car you drive, it will be having certain components. This example I used to say even in the regular class also. So for the car to work properly, the wheels, the steering, the engine, right, the brakes, all these components should work properly. Only if all these components work properly, the entire car together will work properly. Correct or not? Yes. Similarly, for the internal control system to work properly, there are five components. If all these five components work properly, only then the internal control system will work properly. Getting it? So what are those five components? Firstly, control environment. Control environment means the environment in the organization should be feasible for the internal control system. So the environment in the organization should be internal control friendly. Clear? So communication and enforcement of integrity. So some of the components of control environment. So in the organization, at most important has to be given to the integrity. All the employees should be communicated that you have to maintain at most integrity. This will improve the environment of the organization. See, environment of the organization depends on how the employees of that organization are getting it. So environment of the organization will be impacted to a large extent by the people of that organization, by the employees of that organization. So you have to enforce utmost integrity on the employees. Next, participation by those charged with governance. So the top level people should show much interest for the internal controls to flourish in the organization. And management's philosophy and operating style. So management philosophy should be in such a way that they encourage internal controls in the organization. So all these will decide the environment of the organization or not. Control environment. Next, organizational structure. That means who is the top level management, under them who is working, under them who is working, okay, under middle level who is the lower level. That is nothing but a organizational structure. Next, assignment of authority and responsibility. See, you have to assign both authority and responsibility to same person. You should not give authority, power to one person and responsibility to another person. That should not happen. Both should be given to same person, responsibility and the authority. And human resource policies and practices. See, human resource policies and practices will also have a large impact on the control environment. I told you, control environment will be impacted by employees of the organization. So how the employees of organization will be there, like that only the environment of the organization will be there. So while hiring the employees, if you hire correct people, then the environment will be correct or not. So human resource policies are nothing but policies related to hiring the employees, training the employees, and their compensation policy. All these comes under human resource policy and practices. So all these things will impact the control environment of the organization, right? Next, coming to the entities risk assessment process. This is the second component of control environment. See, now we are discussing the components of control environment. First, components of internal control system. So the first component is control environment in the organization. So control environment should be good for the internal control system to work properly. Second one is entities risk assessment process. Sir, we have discussed about auditors risk assessment process, right? See, risk assessment means identifying the risk and taking steps about that risk. So who will identify and assess the risk? As per our discussion, auditor will assess the risk, right, for the purpose of designing his procedures. Here they are saying entities risk assessment. Why? See, not only auditor, even entity will also assess the risk, because in the organization entity has to establish internal controls. For establishing the internal controls, entity will assess the risk in the organization. Just like there are four steps, if you remember, there are four steps, okay? Steps in identifying and assessing the risk. This is about auditors risk, I told you here, right? Auditors risk assessment. Just there are these, just like there are four steps in this auditors risk assessment process, there are also same steps in the entities risk assessment process also. So only if entity properly identifies and assess the risk, it will be able to establish proper control activities, correct or not? So entities risk assessment is also one of the component of internal control system which should work properly. So based on entities risk assessment process, entity establishes the actual control activities. Control activity means actual controls that are there in the organization, like policies and procedures related to performance, information processing controls, physical controls. Physical controls means like security guard you are keeping, and segregation of duties. These are some of the control activities. So control activity also should be working properly for the internal control system to work properly, right? So what are the first three components of internal control system? First one is control environment, second one is entities risk assessment process, and the third one is control activities, right? Next one, information system and communication. See, to implement the internal controls in the organization, you should have proper information about each and every item where you want to implement the internal controls, correct? So that information, where from you will get the information? From the information system of the organization you will get the information, right? So information system should be working properly. And also that information, if you just have the information, that is not sufficient. That information should be properly communicated to the relevant people. So information system and communication should also be working properly in the organization for the entire internal control system to work properly. And finally, the final element is monitoring of the controls. So whatever the controls that you have established, that you need to continuously monitor. So in the monitoring, what will you do? You will check whether the internal control that I have designed, is it working properly? Should I update it? Are there any loopholes in the internal controls? Like this you will monitor the internal control. Clear? Yes, these are the five components of a system of internal control. So for the entire internal control system to work properly, all these five components should work properly. Clear? Yes, sir. Next, my next question to you is, are all the controls relevant to the auditor? So during the audit, will you verify all the controls? The answer is of course no, you will not verify all the controls. Only those controls that are relevant for the purpose of audit, that will have impact on the financial statements, only those controls you will verify, correct or not? See, There is a direct relationship between entities objectives and the controls it implements. See, whatever the controls the organization implements, those controls will be for the purpose of achieving its goals, right, objectives. So based on what objectives entities want to achieve, that type of controls it will implement. Generally the objectives of entities will be with respect to financial reporting, operations and compliance. Got it? So auditor mostly he will be concerned with financial reporting related controls, and operation controls and compliance controls, if at all they have any impact on the financial reporting process, only then he will be concerned with those controls. Clear? Yes. Next, see, next concept, controls over completeness and accuracy of information. What information? See, for doing the audit, management will give information to you, because you will not have the information. Management has to provide the information. Whether controls over that information will be useful for the auditor, whether auditor is concerned with the controls over that information. See, if auditor uses that information for the purpose of audit, then auditor will be concerned with the controls over that information. If auditor does not uses that information, then auditor is not concerned about the controls over that information. Clear? That is with respect to controls over completeness and accuracy of information. Next, internal control over safeguarding of assets. So the controls around safeguarding of assets, if it is related to administrative aspect, auditor is not concerned with them. If it is related to financial aspect, then auditor is concerned with it. Next, controls relating to objectives that are not relevant to the audit. You only saying objectives that are not relevant to the audit. If it is not relevant to the audit, why will I be concerned with that? Correct? Yes. Next, conclusion. The conclusion that you have to come is, not all controls are relevant to the audit. Only those controls that affect financial reporting are related to the audit. Clear? Yes. Next, for verification of these controls, you want certain information, correct or not? So to gather that information, certain four methods are available. So to gather information about the internal controls, four methods are available. What are those four methods? Let us see. First one is narrative record. What is meant by narrative record? Do you remember the essay competition in your school? So narrative record means nothing but writing paragraph about the controls that are operating in the organization. So you will observe the controls and you will describe about how the controls are operating. That is a narrative record. So through narrative record you can get information about the internal controls. Next one is checklist. What is meant by checklist? See, checklist will contain some questions that has to be answered by article assistant. Okay, see, members of the auditing staff should answer the questions of checklist. Next, internal control questionnaire. See, internal control questionnaire also contains questions only, but these questions should be answered by management people. See, issued to client, and client is requested to get it filled, getting it. And the questions in checklist will not be that much comprehensive, but questions of internal control questionnaire will be very detailed, very much comprehensive. The basic difference is checklist will be answered by audit staff, internal control questionnaire will be answered by management. Next is flowchart. You can also use flowchart to get information about the internal controls. Example of flowchart, the one that we are learning. Okay, all this is nothing but a flowchart. So flowchart will give you a bird's eye view of entire content. Correct or not? This is the best example of flowchart, right? So if you like these charts that we are using, you comment in the comment section saying excellent audit charts. So if you feel that these charts are useful to you, communicate with me by saying in the comments that yes sir, These charts are excellent charts. Okay, yes. So flow chart. So flow chart is a graphical presentation of each part of the company system of internal control. Now one linking, you can use narrative record for preparing flow chart, correct or not? So by paragraphs that are there, narrative record is nothing but a complete description. You can say narrative record is our audit concise book. In audit concise book, we will have the content in the form of paragraphs. Now from that audit concise book, I have prepared flowchart. So you can use narrative record to prepare flowchart. Simple. Wow, what an example, sir. Yeah. Next, essay 320. Next, this we left, right? Extent of understanding of the controls. So see, to obtain understanding of the controls, you will understand how those controls are designed and how those controls are implemented, and after implementation, are those controls working effectively, properly? These things you will understand as part of obtaining understanding of the controls. Clear? Yes. Next, starting with essay 3. See, now we have completed complete essay 315. See how much big the essay 315 is. It almost took us 1 hour 15 minutes, right? Yes. So materiality in planning and performing the audit. Materiality, what is this materiality? See, materiality means a important item. Auditor has to determine materiality for each and every audit. Understanding? In fact, auditor will determine materiality at the entire financial statement level, and also for each and every item also he will determine the materiality if he wants. Understanding? This materiality, there is a formula for the materiality. We will see that formula and all those things we will see. So first of all, materiality can be determined at financial statement level and transaction or account balance level. This documentation we'll see, starting with materiality. So in case of audit, we will use the term materiality along with misstatement. Okay, most of the times you will find the word materiality attached to misstatement. Okay, so material misstatement means that misstatement is very important. Auditor is concerned with that misstatement. Immaterial misstatement means very small misstatement. Auditor will not consider that misstatement for his opinion. Understanding? So you should remember, auditor is always concerned only with material misstatements. He is not concerned with immaterial misstatements. So to determine with which misstatements I have to be concerned, with which misstatements I need not be concerned, first of all I have to identify what is meant by materiality. I have to fix a materiality limit, correct or not? So materiality, how to calculate materiality? There is a formula. Materiality is calculated as benchmark multiplied by a percentage. So benchmark means, I will give some of the examples of benchmark. Sales, gross profit, net profit, right? These kind of things you can take as benchmark. So let's say you have taken benchmark as sales. Sales is 2 crore rupees. Okay, 2 crore rupees. And okay, sales is 2 crore rupees, and for this you will apply a percentage. How much percentage you have to apply? That depends on your professional judgment. Generally, percentage that you will use for materiality will be single digit percentage, like let's say some 2%, 3%, like that it will be there. Let's say it is 2%. So 2 crore multiply 2%, how much it will become? 1 crore means 1 lakh. 2% means 2 lakh. So materiality limit auditor has determined is 2 lakh rupees. That means auditor will be concerned only if the misstatement crosses 2 lakh rupees. If misstatement doesn't cross 2 lakh rupees, auditor is not concerned with that particular misstatement. Got it? Yes, sir. Now you can ask me a doubt, sir. If at all misstatement is 1,90,000, just 10,000 less than 2 lakh rupees. Will you be concerned with this misstatement? See, here comes the concept of performance materiality. What is this performance materiality? See, I already told you, audit cannot detect complete misstatements. By performing audit, you have detected misstatements worth 1,90,000 rupees. There is a possibility that detected misstatement of 1,90,000, if you combine it with undetected misstatements. So, can there be undetected misstatements? Of course, auditor cannot detect complete misstatements. So, there is a possibility that detected misstatement together with undetected misstatement might cross materiality of 2 lakh rupees. Such a possibility is there or not? To reduce that possibility, there is the concept of performance materiality. Now, what is this performance materiality? First of all, I will tell you how to calculate performance materiality. Formula for performance materiality is see, what is the formula for materiality? You have applied a percentage on the benchmark, that is materiality. For performance materiality, you will apply formula on materiality. Okay, so materiality, let me write correct spelling. Materiality multiplied by a percentage. Now, how much percentage you have to take? Again, this depends on your professional judgment. Generally, see, for materiality, the percentage will be single digit, 1%, 2%, right? But for performance materiality, the percentage will range. It will be two digits. It will be more, around 75% to 90%. It will vary. Let's say you have taken it as some 70%. Okay, 70%, our materiality is 2 lakh, right? So how much you will get performance materiality? 1,40,000. Yes. So 1,40,000 is a performance materiality. Now, what is the meaning of this performance materiality? That means once the misstatement reaches this performance materiality, auditor becomes alert. Auditor asks the management to correct that misstatement because it has reached the performance materiality. Even though it has not reached the materiality level, there is a chance that the detected misstatement plus undetected misstatement might cross a materiality level. So once the performance materiality is reached, auditor will not take any chance. He will become alert and he will ask the management to correct the misstatement. This is the concept of performance materiality and materiality. Clear? Yes. So materiality. Misstatements are considered to be material if they individually or in aggregate influence the economic decisions of the users. That means if there is a misstatement of 2 rupees in the financial statements, will the users, let's say users or shareholders, okay, shareholders. Now, shareholders wanted to invest in this company and they got to know that there is a 2 rupees misstatement in this company. Will the decision of the shareholders will get impacted? No, right? Let's say same shareholders got to know that there is a misstatement worth 2 crore rupees. Will this impact the decision of shareholders? Yes, they will not invest in the company. Their economic decision has got impacted, right? So, materiality means the level of misstatement that will impact the economic decision making of the users. That is the theoretical definition for misstatement, and the formula based definition we have seen already. Next, it is a matter of professional judgment. Why materiality is a matter of professional judgment? Because the percentage, how much percentage you have to select, you have to apply, right? This is completely based on your judgment. Since percentage is based on judgment, the entire materiality that you derive thereby is also subject to professional judgment. Understanding? Next. Determination of materiality, of course, responsibility of auditor. Materiality is to be applied both in planning and performing the audit, right? Next, while determining the materiality, auditor will take certain assumptions about the users. So, what assumptions auditor will take about the users while determining the materiality? Let us see. So, auditor will assume that users are having reasonable knowledge about the business. Users know about the business, and auditor will also assume that users can understand that financial statements are prepared and audited only to the levels of materiality. That means auditor will not say to the users, we have audited to the level of materiality only. No, he will assume that users already know. Auditor will not audit completely, he will just audit only to the level of materiality. Like that, the auditor will assume. Next, auditor will also assume that recognize the uncertainties inherent in the measurement of amounts. So users already know that there is uncertainty involved in measurement of some of the amounts which are related to the future, right? So future, if there is a estimation itself means related to future. Future itself means uncertain. You don't know whether actually the same amount will actually arrive or not, you don't know, right? So users already know this. Like that, auditor will assume. Next, make reasonable economic decisions. So auditor will also assume that users are very intelligent people, they can make their own economic decisions. Like this, auditor will assume. Getting it? Yes. So, materiality formula we have discussed. While selecting the benchmark, I have also told you some of the examples of benchmark, right? So, profit before tax, total revenue, gross profit, all these are the examples of benchmark. Now, while selecting the benchmark, what factors has to be considered? This is very important. Okay, so you need to consider what are the elements of financial statements. So, from the elements of financial statements only, you will select a single element as the benchmark. Correct or not? So what are the elements are there in the financial statements? Sales, purchases, gross profit, net profit, loans, asset. So all the elements you need to consider, okay, for selecting a benchmark. Next, items on which attention of users tend to be focused. So in the financial statements, are there any items on which the attention of the users will be focused? Like in case of banks, users will be more focused on npas, on loans given. So if you are auditing a banking company, you can take benchmark as loans given, because your users are focusing more on loans. Correct or not? So you should also consider this point while selecting the benchmark. Next, nature of entity. You should also consider what is the nature of entity, and ownership structure. So whether it is financed more by debt or more by uh, shareholders fund. So if it is financed more by shareholders fund, shareholders wanted more profits to be generated. Correct or not? Only if profits are there, they will get dividends. So shareholders will focus more on more on profits. So if entity is financed more by the funds of shareholders, auditor can take benchmark as profit. If debtors, that means if by the loan funds, if entity is financed more by the loan funds, then the people who have given loan will focus more on sales, because if more sales are there means more cash inflow will be there. If more cash inflow is there means every time cash will be available with the entity to pay off to the debtor. Correct or not? So that's why they will focus on sales. So in such a situation, auditor will consider benchmark as sales. Next, volatility of benchmark. See, the benchmark that you chooses should not be fluctuating. It should be normal, standard. Okay, if there is a high volatility in the benchmark, you should avoid selecting it. Okay, yes. Next, performance materiality. I told you about performance materiality. So amounts set by the auditor at less than materiality level. See, performance materiality should always be less than materiality, because what is the formula of performance materiality? Materiality multiplied by a percentage. So of course, always performance materiality will be less than the materiality level, right? To reduce it to an appropriate low level, the probability that aggregate of uncorrected and undetected misstatements exceeds materiality level. So to reduce the probability of uncorrected misstatements and the detected misstatements, both combining together might cross the materiality level. To reduce that possibility, you will calculate the performance materiality. Clear? Yes. And of course, as the audit progresses, auditor can and auditor shall revise the materiality. It is not that once you have determined the materiality during the audit at the initial stage, it should be fixed like that only. No, as the audit progresses, you can revise it, you can increase it, or you can reduce it. That is freely available. Okay, that is up to you. Getting it? Yes. This is SA 320. Next, SA 265, right? So it deals with communicating deficiencies in internal control to those charged with governance and management. About this, I told you, auditor is not having any responsibility to verify internal controls. But however, during the audit, to make his work easy, he is verifying internal controls. So during such verification, if at all he finds any misstatements, if at all he finds any deviations, communicate them to management or those charged with governance. Okay, so first of all, what is meant by a deficiency in the internal control? In the two situations, you will call it as deficient. So what are the two situations? First of all, internal control is unable to prevent, correct, detect the misstatements, then you will call it as deficiency. That means deviation in the mistake, deviation in the internal control, you will call it as a deficiency. Or required internal control is not at all present, then also you will call it as deficiency. Getting it? So internal control is not preventing detecting mistake, not preventing detecting correcting misstatements, or internal control required is not at all present. In both the situations, you will call it as deficiency, right? So control necessary is not present, is unable to detect to prevent correct misstatements. Now once it is a significant deficiency, you have to communicate it with those charged with governance. So what is the communication process? See, communication process determine whether one or more deficiencies are identified. Okay, whether there is one or more deficiency in the internal control, you will identify. Once you have identified some deficiencies, you will see whether that deficiency is significant deficiency, because you will communicate only significant deficiencies with those charged with governance. Understanding? See, whether they constitute significant deficiency, you have to see what will be a significant deficiency, we will see that also. When you will call a deficiency as a significant deficiency, we will see that also. Okay, so you will determine whether they constitute a significant deficiency. Once if it is a significant deficiency you feel, then communicate in writing significant deficiencies to those charged with governance on a timely basis. See, why you are communicating significant deficiencies in internal control with those charged with governance? So that those charged with governance might take steps and improve those internal controls. For that purpose, you are communicating significant deficiencies in internal control to those charged with governance. Clear? Yes. Now, when you will call a deficiency in the internal control as significant deficiency, see here you need to apply your professional judgment. Okay, see, deficiency or combination of deficiencies in internal control that in the auditor's professional judgment is of sufficient importance that to merit the attention of those charged with governance. So in the professional judgment of auditor, if he feels that this deficiency has to be brought to the notice of those charged with governance, then it becomes a significant deficiency. Understanding? So to determine whether deficiency is significant or not, you have to apply your PJ, professional judgment. Next, in determining whether deficiency is significant or not, some of the factors are given by the standard. Let us see what are the factors that you have to consider for determining whether a deficiency is a significant deficiency or not. First factor, see, factors to be considered. First factor, likelihood of deficiencies leading to material misstatement. Okay, so this is internal control. There is a deficiency in the internal control. If this deficiency leads to material misstatements, then there is a high possibility that this deficiency can become significant deficiency. Okay, next, susceptibility to loss or fraud. So if this deficiency leads to fraud or error to occur, then also there is a high chance that this deficiency will be treated as significant deficiency. Next, subjectivity and complexity of determining estimated amounts. So, if lot of subjectivity is involved in determining the estimated amounts and the controls around such estimation are not proper, or there is a deficiency in the controls around such estimation, then also you will call such a deficiency as significant deficiency. Clear? Next, financial statements amounts exposed to deficiency. So if let's say sales is very important, correct or not, because it will be of huge volume. Miscellaneous expenditure is not that much important, correct? So if there is a deficiency in controls around the sale, then that might become a significant deficiency because underlying item is important. On the other hand, if there is a deficiency in controls around miscellaneous item, then that might not be treated as a significant deficiency, correct? Yes. Next, volume of activity. So if the volume of activity in a particular item is more transactions are occurring and there is a deficiency in the controls around such a transaction, then also such a deficiency can become significant deficiency. See, all these are the factors that you have to consider to determine whether whether the deficiency can become significant or not. It doesn't mean that if these factors are there, that a deficiency is always a significant deficiency. No. Okay, next, interaction of deficiency with other deficiencies. Okay, so individually a deficiency might be insignificant, but this deficiency might interact with other deficiency and both of them combined can become significant, correct or not? So this also you need to consider. Got it? To determine whether the deficiency is significant or not. Next, I told you, once you identify the significant deficiencies, you have to communicate the significant deficiencies to those charged with governance in writing. So in that written communication, what will be there? See, description of the deficiencies will be there. Description means you have to clearly describe why this will become significant deficiency. Such a clear description has to be given, and you should also give sufficient information to enable those charged with governance and management to understand context and explain the following things. So you should not say that there is a deficiency in so and so area. No, you have to give clear description. You have to give context so that the management and those charged with governance will understand actually where the deficiency is there, why that has become significant deficiency. These things should be properly understood by them. In such a manner you have to describe it clearly, you have to describe it in the written communication. Okay, so you need to explain that purpose of the audit was to express a opinion on financial statements. So in the written communication you need to mention, see, management and those charged with governance, the purpose of our audit was to express opinion on financial statements. Our purpose is not to express opinion on the internal controls, but see, audit included consideration of internal controls relevant to the audit. However, for the purpose of making our work easy, our audit included consideration of some of the internal controls also, and matters being reported are limited to those deficiencies that the auditor has identified during the audit. So you will say that during the audit I have verified some of the internal controls for the benefit of my audit. So whatever the deficiencies I am communicating, they are limited only to those deficiencies that I have identified. That means there can be some more deficiencies in the internal control which I might not have identified. You should not think that I have identified all the deficiencies and communicating to you. No, these are only the deficiencies that I have identified. There can be some unidentified deficiencies also. Clear? Such a clear communication you need to give to the those charged with governance in the communication. Okay. Next, internal financial controls. Internal financial controls means those controls that are established over the financial aspects to achieve the objectives of same. Reliability of financial reporting, effectiveness and efficiency of operations, compliance with laws and regulations, safeguarding of assets and prevention and detection of frauds and errors. Simple, similar to that of internal control definition, right? Yes. So this is SA 265. Now we will move to SA 330. I told you the link between SA 315 and SA 330. As per SA 315, you have identified the risk. Once you have identified that risk, for that risk, you will design audit procedures as per SA 330. So SA 330 deals with further audit procedures. SA 330 deals with responses of the auditor to assess the risk of material misstatements as per SA 315. Correct or not? So, if you see the name of SA 330, it clearly says auditors' responses to what? To assess the risks. Where you have assessed the risk? In SA 315, you have assessed the risk. What is meant by auditors' responses? Auditors' responses are nothing but audit procedures. Clear? Audit procedures are the responses that the auditor is giving. See, so this standard deals with auditors' responsibilities to design and implement responses to the ROMM. Responses means you should always remember that response of the auditor as per SA 330 is the audit procedure that you will perform. Okay, further audit procedure that you will perform. See, matters to be considered in determining extent of test of controls. So, as a part of SA 330, you will perform further audit procedures, right? Further audit procedures also includes this test of control. If you see this chart, we have already seen in SA 350, right? In SA 315, we have already seen this chart. So, further audit procedures also include test of controls. Test of controls means those procedures that you perform for the purpose of testing the controls, verification of the controls, right? So, what matters you have to consider in determining the extent of test of controls? Let us see. Frequency of performance of the control. So how frequently the control is being performed? Let's say, for example, control over sales will be more frequently performed than control over rental expenditure, because rent expenditure there will be one transaction for each and every month, but sales transactions it will be throughout the year. Every day you will have. So controls over sales are working throughout the year, right? They are being performed many times. So if control is being performed more times, you have to check that control very detailedly. Correct? So your extent of testing of control depends on how frequently that performance, how frequently that control is being performed. Got it? Yes. Next, length of time during the audit period auditor is relying on the control. So controls over entire financial reporting process will be relied by the auditor throughout the audit, right? Whereas controls over inventory will be relied by the auditor only while auditing the inventory, right? So controls over inventory auditor is relying for less period, whereas controls over entire financial reporting he is relying for more period. So if he is relying on any control for the more period, he will test that control more. Got it? Yes. Next, expected rate of deviation from the control. Deviation means, I told you, deviation or deficiency same. So if the control fails to detect, prevent, correct the error as required, then you will call it as deviation. If such a deviation in the control is more, then also you will test that control more, right? Next, relevance and reliability of audit evidence. So if the audit evidence that has to be obtained is more reliable and more relevant for the purpose of auditor, then controls around that obtaining of audit evidence you will test more, because that audit evidence is more important for the purpose of audit. Next, extent to which audit evidence is obtained from test of other controls. Got it? So all these factors will impact the extent of testing of the controls. Next, nature and extent of test of controls. So in determining the nature and extent of test of controls, you will consider other audit procedures in combination with inquiry. So what type of audit procedure you have to perform as a test of control? Nature of test of control means what audit procedure you have to perform for testing the control. Nature of procedure. So the first one you can use is other audit procedure in combination with inquiry. Inquiry means asking questions. You can ask questions to the employees or anyone in the organization about controls, and you can get information. So this is the first procedure that you can perform. Next, determine whether controls to be tested are dependent upon other controls. So if control 1 that you are testing is dependent on control 2, that means only if control 2 works properly, control 1 can work properly. In such a situation, if you are verifying the control 1, of course you should also verify control 2 also, because both of them are interrelated, right? Let's say for example, verification of BRS. Okay, verification verification of BRS, is this a control? Yes. Preparation of BRS, this is also a control. Preparing a BRS is also a control. Now, verification of BRS is the BRS means bank reconciliation statement. So, verification of BRS is dependent on preparation of BRS. If first control itself is not working properly, how can you do the second control? Correct. So, in this situation, you have to see whether the control that you are going to test is it dependent on other control. Next, inquiry combined with inspection or reperformance. So you have to prefer doing inquiry, asking questions combined with inspection and reperformance. See, by inquiry you will get what? Information, right? They are saying you perform inquiry along with reperformance. So reperformance means already entity has performed a particular activity, you are again performing it. So by reperforming it, you are checking whether the information that I have obtained through inquiry, is it correct only or not. By reperforming the activity, you are cross verifying it. Another thing that they are saying is inquiry along with inspection. Inspection means you will inspect the documents, you will inspect the inventory, right? Physically verifying them, inspection. So the information that you have obtained through inquiry, you can cross verify it through inspection, correct or not. That's the reason why they are telling you to perform inquiry along with reperformance or inspection. See, you will not perform inquiry alone. Always you will perform inquiry along with other audit procedures like reperformance or inspection. Okay. Next, nature of particular control. So all these factors will impact the nature and extent of test of controls. Got it? We are almost completing this revision. Still one more page left. Okay, yes. This audit procedures we have already discussed, right? Next, considerations in designing further audit procedures. So, in designing further audit procedures, what considerations you will take into account? See, reasons for the assessment given at Romum. So, as per SA 315, you have identified Romum, correct or not? So, you will consider that Romum for designing further audit procedures. I have explained I have explained this. FAP will be dependent on the results of your RAP, right? Next, likelihood of material misstatement. This also you will consider for designing FAP. FAP means further audit procedures. Next, relevant controls also you will consider. If controls are working properly, then your FAP will be less. If controls are not working properly, then your FAP will be more. FAP means further audit procedures will be more. Next, more persuasive audit evidence, the higher the auditor's assessment risk. So, if auditor has assessed that Romum is high, then he will obtain more persuasive audit evidence. Persuasive means believable. Okay, the one on which you can believe more is persuasive. Got it? Yes. Next, timing of test of control. See, it depends whether you can test the controls at a particular point of time or during the period. Got it? Let's say you are verifying controls around inventory. You wanted to obtain evidence about inventory as on 31st March, correct or not? So you will verify controls around inventory at the point, right, at the point of time as on 31st March. Whereas sales will be during the entire period. You wanted to obtain audit evidence about the sales during the entire period, so here you will verify the controls during the period, over a period of time, correct? So it depends based on the item you are verifying, the period of verification of the control around it depends, right? Yes. Next, specific inquiries by auditor when deviations from the controls are detected. So when auditor actually identifies that this control is not working properly, there is a deviation in this control, then what are the specific inquiries that the auditor will ask? Let us see. So test of control provide appropriate basis for reliance on controls. I have performed test of controls. Did my test of controls provide me appropriate basis for arriving at the conclusion? That auditor will consider. Okay, that specific question he will ask himself, because he has identified some deviations, right? So since you have identified some deviations in the control, you will ask yourself, I have performed this test of controls now. Are these test of controls sufficient? Did this test of controls identify all the deviations? Like this you will ask the question yourself. Okay, next, additional test of controls are necessary. I have performed this test of controls, are these sufficient? Should I perform some more test of controls? This question also you will ask yourself. See, you are inquiring yourself. Next, potential Romum need to be addressed using a substantive procedure. So, if at all there is any potential Romum, potential means as of now it is not there, it will occur in the future. So, to address that Romum in the future, should I perform any substantive procedures? So, these inquiries auditor will make himself if he identifies any deviations in the control. Okay, deviation means I told you already. Next, using audit evidence obtained in previous audits. So, auditor, he would have obtained audit evidences in the previous audit, in the last year audit. Same items he might be auditing in the current year also. So, the question is, can he use the same evidences that he obtained in the previous year audit for the current year audit also, or should he obtain new evidences again? Tell me. It depends on certain factors. Let us see. So, effectiveness of other elements of internal control. So, if other elements of internal control are working properly, then you can rely on the same audit evidence that you have obtained in the previous year for the current year also, because the controls, they are same as it is, no change of controls has happened, so you can rely on the same evidence. Next, risks arising from characteristics of control. So the characteristic of control is such that it continuously changes, and new risks will arise from that control. Then better to test the control again, better to obtain new evidence again in the current period also, instead of depending on the old audit evidence. Okay. Next, effectiveness of general IT controls. See, about this general IT controls, we will see in a separate chapter. There is a separate chapter which deals with this information technology. There we will understand the general IT controls. Okay. Next, whether lack of change in particular control poses a risk. So you should also consider this. If this control doesn't change frequently, doesn't update frequently, will this result into a risk? If this results into a risk, if the change of control is not made properly, that will result into a risk, then better to test that control again, better to obtain new evidence with respect to that control again, instead of depending on the same previous year's audit evidence, because this control has to be changed continuously. The nature of that control is such that, understanding. Next, romum. If you have identified that romum of the particular area is high, then better to test that area again, better to obtain evidence again, instead of depending on the previous year's audit evidence. Next, establish continuing relevance of that evidence. So all these factors you should consider before deciding whether to rely on the previous year's audit evidence, or should I obtain again a new audit evidence for that item. Clear? Yes. By this we have completed yesterday 330 also. So we have discussed 4 standards, right? 315 is done, 265 is done, 330 is done, and another one 320 is also done, right? Now one more standard is left, which is 450, a very small standard and very easy standard. Let us see. So the link I have established. SA 315 you have identified risk. SA 330 you have responded to risk and identified the misstatements. Now you will evaluate these misstatements as per SA 450. Let us see. So SA 450, evaluation of misstatements identified during the audit. How will you evaluate the misstatements? So first of all, what is meant by misstatement? I have already told you. If there is a difference between ACPD that is required by applicable financial reporting framework and ACPD that is followed by the management, you will call it as misstatement. I have discussed this in the first chapter, right? First chapter discussion. Next, uncorrected misstatement. Uncorrected misstatement means misstatement which is not corrected. This can be either detected or undetected, right? Yes. Next, factual misstatement means actually it is a misstatement. No one can deny, no one can argue that it is not a misstatement. Such a misstatement is known as factual misstatement. Okay. Next, judgmental misstatements means, see, management, while preparing the financial statements, they will take a lot of judgments, like for providing a provision for doubtful debts, they will exercise a judgment. So now these judgments are subjected to misstatement. Correct or not? You are making judgments about future, and the amount that will occur in the future you cannot predict accurately. So judgments are always subjected to misstatement, nothing but judgmental misstatement. Clear? Next, projected misstatement. What is this projected misstatement? This is related to SA 530. 530 deals with audit sampling. So in case of sampling, what you will do, if the population, total population is 1000, and you are not able to verify complete population, so you have selected sample of 100 items and performed audit procedures on that sample, and you have identified that there is one misstatement in the sample. So now you will project this one misstatement to the entire population. That is, if in 100 items one misstatement is there, means in 1000 items how many misstatements will be there? You will cross multiply 1000 multiplied by 1 divided by 100. How many will be there? 10. Like this you will project the misstatement to the population. This is known as projected misstatement. Getting it? Yes. Next, clearly trivial misstatement. Clearly trivial misstatement means very small misstatement which is insignificant, inconsequential, like rounding off error. Because of rounding, a misstatement of 1 rupee occurred. This is clearly trivial. By just seeing it, you can tell that that is inconsequential, immaterial. Got it? That is clearly trivial misstatement. Right. So now we understood the meaning of all the misstatements. Now we'll go into the standard. So consideration of identified misstatements as the audit progresses. So as the audit progresses, how should you deal with these misstatements? Okay. See, misstatements, they can be of types. Misstatements, firstly, detected misstatements and undetected misstatements. Undetected means you haven't identified them yet. Now detected misstatements, they can again further be of two. Once you have identified, detected the misstatement, you can either correct them, corrected and uncorrected, right? And these undetected misstatements, they will always be uncorrected only. They cannot be corrected, because if you have not at all detected the misstatement, how can you correct them? Correct or not? So misstatements, you can classify them like this. Now in this background, we will study the remaining concept. See what they are saying. Consideration of identified misstatements. Identified means detected misstatements as the audit progresses. Now identified misstatement indicate that other misstatement might exist. So the identified misstatement gives you a proof that there is a other misstatement exists, or aggregate of misstatements approach materiality. Okay, in such a situation, determine whether overall audit strategy and audit plan need to be revised. So you have identified the misstatements, and you are feeling that not only these identified misstatements, there can be some more misstatements in the financial statements, and that undetected misstatements and the identified misstatements, both of them together might cross the materiality level. Like this you are feeling. In such a situation, you have to determine whether you have to change, alter your overall audit strategy and audit plan. I told you while discussing SA 300, audit strategy and audit plan are subject to change. They can be altered during the audit. This point I told you, correct or not? So in this situation, you have to decide whether you have to alter the audit plan and strategy. Next, evaluating the effect of uncorrected misstatements. So the misstatements which you have identified and uncorrected, misstatements which you have not identified and uncorrected. Understanding? So they are telling about uncorrected misstatements. How will you evaluate the effect of uncorrected misstatements? First of all, you have evaluated about identified misstatements. Now uncorrected misstatements. See, reassess the materiality. Once reassess whether the materiality level that I have fixed, is it okay for this situation, or should I change the materiality level? Should I increase or decrease the materiality level? Next, in determining materiality of uncorrected misstatements, auditor shall consider the following things. See, they are saying you need to clearly observe the terms uncorrected. That's the reason why I have given you this chart. You note down this chart and read this, and go through this concept. Only then you can relate. Okay, so determining materiality of uncorrected. Uncorrected means it can be either this or this. Okay, so in determining materiality of uncorrected misstatements, auditor shall consider size and nature of misstatements. So misstatement is uncorrected, management has not corrected it. What is the size of such misstatement? What is the nature of that misstatement? If the size of uncorrected misstatement is small, you can leave it. If the size of uncorrected misstatement is huge, you should consider it in your opinion, right? Next, circumstances of their occurrence. How did they occur? And effect of uncorrected misstatements. What effect uncorrected misstatements will have on the financial statements? So you should consider these 3 points in assessing, in evaluating the effect of uncorrected misstatements. Then you will communicate with those charged with governance. Following things: uncorrected misstatements and their effect. See, those charged with governance, during the audit, I have identified some misstatements and told to management. They have corrected some misstatements and some are uncorrected. These are uncorrected misstatements. These uncorrected misstatements will have this much effect on the financial statements. Like this, you will communicate with those charged with governance. Next, effect of uncorrected misstatements related to prior periods. So, in the prior period, in the last year, if you have identified any uncorrected misstatements, what effect that uncorrected misstatements will have, that also you will have to communicate with those charged with governance. Next, request. So by communicating that these are the uncorrected misstatements, finally you have to request those charged with governance, please correct these uncorrected misstatements. Got it? Like this, you will communicate with those charged with governance. Next, misstatements identified during the audit. Communicate with management on a timely basis and request them to correct. So, first of all, before going to those charged with governance, the first one to whom you have to go is management, right? Whatever the misstatements you identify, you will tell to management and correct them. If management doesn't correct, then you will take them to those charged with governance, right? Yes. If management refuses, understand reasons and consider while framing the opinion. Got it? Yes. Now, I forgot to tell you the difference between management and those charged with governance. We will also discuss this. See, this standard got completed. SA 265 is completed. I'll just discuss with you difference between management, those charged with governance. So, management is having responsibility with respect to executory functions. Okay. Whereas those charged with governance will have responsibility with respect to decision making. They are always involved in a decision making activity. Okay, some of the examples of management: CEO, managing director, whole time director. These are the examples of management who will be involved in day to day operations. Some of the examples of those charged with governance: best example is board of directors, audit committee. Understanding? So, board of directors means there will be managing director in the board of directors. There will also be whole time director in the board of directors. There will be normal directors. There will also be independent directors, right? So, all these people together you will call board of directors. So, this board of directors, all these people together will be those charged with governance, because any decision that has to be taken in the company should be taken together by all these people. Got it? Now, if you see, I have given that managing director will be management, whole time director will be management. If you observe here, managing director is part of board of directors, whole time director is also part of board of directors. So, by this, you should understand that there can be common people, there can be common people between management and those charged with governance. It is not that management and those charged with governance are completely separate. In some companies, some people can be both in management and also those charged with governance. Do you know what? In some companies, both management and those charged with governance will be one and the same. There will not be any differentiation. Understanding? So in some companies, board of directors together will be both management and also those charged with governance, because in that company executory function is being done by board of directors and decision making also being done by board of directors only. So in that company, board of directors are both management as well as those charged with governance. Getting it? So in determining management and those charged with governance, you have to see what function they are doing. If they are doing both the functions, they will be both management and those charged with governance. Clear? Yes. So this is discussion of chapter number 4. I guess you understood completely the chapter number 4. If you have any doubts with respect to this chapter, you can ask me in the comment section, okay, or you can message in our telegram group also. I will be replying you your doubts. Got it? And you know what to do. If you feel that this revision class is useful to you, you have to comment saying the best, right? Yes. Now I'll open the chart for fifth chapter. Okay. Yes. Yes, guys. Now I have opened chapter number 5, which is reporting, audit reporting. Yes, audit reporting. So what was the flow? What were the three stages of auditing that we have discussed? Firstly, it was planning stage, which we have discussed in SA 300. Next one is execution stage. Execution still we have not yet covered. And finally, reporting stage, right? So now this reporting stage, we are going to see the complete 700 series standards. They will deal with reporting. Sir, why we are discussing reporting without discussing execution? Because there are certain concepts under reporting which should be understood by you. Only then you will be able to properly understand the execution phase. Getting it? Yes. So as I already told you, the complete 700 series deals with reporting aspect. What are the standards that are there in this particular chapter? There are 5 standards. Firstly, SA 500. So SA 500 deals with format of audit report. If auditor wants to give unmodified opinion, right? If in case auditor wants to give modified opinion, then the format will be dealt by SA 705, right? Next, if auditor wants to give key audit matter paragraph, then there is SA 701. We will be discussing it, communicating key audit matters. Next, if auditor wants to give emphasis of matter or other matter paragraph, then SA 706. And finally, with respect to comparative information, what is the responsibility of the auditor? That will be dealt in SA 710. These are the 5 standards that we are going to cover in this particular chapter. So let us start with the first standard, which is SA 700. So SA 700 will give you the format of audit report. What should be the format of audit report? If auditor wants to give unmodified opinion, that will be dealt in this particular standard. Got it? Yes. So see, SA 700, forming an opinion and reporting on the financial statements. So this standard deals with the format and content of audit report in case auditor wants to give unmodified opinion. If auditor wants to give modified opinion, then the format will be as per SA 705. Clear? Yes. Now, before starting the standard, let us see the basic difference between report and certificate. What is the difference between report and certificate? See, in case of report, auditor expresses an opinion based on the underlying facts. Whereas in case of certificate, auditor will certify correctness of the facts. He will say that yes, this is the fact. That will be done in case of certificate. So in case of audit, the auditor issues certificate or report. Of course, he will issue report expressing his opinion, right? See, report involves expression of opinion, whereas certificate involves written confirmation of accuracy of the facts, and report is responsible to ensure that report is based on factual data. So auditor, when he issues a report, it is a responsibility of the auditor to ensure that whatever the report that he has issued, that is based on the factual data only. Next, in case of certificate, it is responsibility of the auditor for factual accuracy. He needs to state that whatever is present in this certificate, it is fact only, like this he needs to say. Whereas in case of report, he will say that I am giving my opinion based on the facts. Whereas in certificate, you will say that these are the facts. Understanding the difference? Yes. Next, types of opinions. So what are the various types of opinions? Broadly speaking, there are two types of opinions. First one is unmodified opinion. Second one is modified opinion. When will you give unmodified opinion? If you got a confidence that there are no misstatements in the financial statements, then you will give unmodified opinion, clean opinion. Correct? If you got to know that there are misstatements in the financial statements are not prepared as per applicable financial reporting framework, then you will give unmodified opinion. These unmodified opinions, they are again of three types: qualified, adverse, and disclaimer. About this entire concept of modified opinion, we will see in the SA 705. Got it? Unmodified opinion we will cover here. Modified opinion, which is of three types, we will see in SA 705. I guess you understood when you will give modified opinion, when you will give unmodified opinion, right? See, unmodified opinion: if auditor concludes that financial statements are prepared as per applicable financial reporting framework. Next, modified opinion: if financial statements are not free from material misstatements or unable to obtain sufficient appropriate audit evidence about the financial statements. In these two situations, we will give modified opinion. Clear? Yes. Now, so, format of audit report means what? I told you SS 700 deals with format of audit report. Now, what is meant by format of audit report? See, what contents will be there in the audit report? What paragraphs will be there in the audit report? That is the format of audit report, correct or not? So, now we will see what are the basic elements that will be there in the audit report. So, first of all, there will be title, correct or not? So, what will be the title of audit report? It will be Independent Auditor's Report. See, title of the audit report will be Independent Auditor's Report. Next, addressee. Addressee means to whom you are addressing this audit report. Tell me, to whom will you address the audit report? Of course, to the members of so and so company you will address the audit report, right? So next one will be addressee. Addressee is the person to whom you are addressing the audit report. Generally it will be shareholders or the members, right? Yes. Next paragraph will be opinion paragraph. Now in this opinion paragraph, you will give your opinion, whether it is modified opinion or it is unmodified opinion. The actual opinion will be given in the opinion paragraph. Now, along with this opinion, there should be mandatorily 5 things should be present in the opinion paragraph. Opinion, your opinion, however, you will mention in the opinion paragraph. Apart from opinion, following 5 things should be present in the opinion paragraph. Let us see what are those 5 things. See, auditor's opinion will contain the opinion. Of course, apart from opinion, you need to identify name of entity, saying that if you are auditing Reliance Industries, in your opinion paragraph, you need to identify name of that company. We have audited so and so of Reliance Industries Limited, like this. The name of the company you should mention in the opinion paragraph. Okay. Next, state that financial statements have been audited. So in the opinion paragraph, you have to clearly mention that we have audited the financial statements. So how will mention? We have audited the financial statements of Reliance Industries Limited. See, you should also identify the name of each statement containing that financial statement, forming part of that financial statement. See, identify title of each statement. What will be there in the financial statements? Balance sheet, profit and loss, cash flow, right? Statement of changes in equity, notes to accounts, all these are financial statements. You need to identify each item like this. See, we have audited balance sheet for so and so year end, profit and loss for the period end like this of Reliance Industries Limited, like this. Name of that item forming part of a financial statement you need to identify, and you should also identify period covered by that statement. So P&L will be for certain period, right, from 1st April to 31st March, like that the period you need to identify. Balance sheet will be as at the end, as on particular date, right, as on 31st March, like that you need to identify the period also. See, specify the date of or period covered by each financial statements, and you should also make a reference to the notes to accounts. So these five things should be present in the opinion paragraph. Clear? Yes. So opinion paragraph is done. Next one you will find in the audit report is basis for opinion paragraph. So the opinion that you have mentioned in the opinion paragraph, it should be based on something, right? So on which basis you have given that opinion, you will mention it in the basis for opinion paragraph. Now let us see what should be present in the basis for opinion paragraph. So, see, basis for opinion paragraph. Basis for opinion paragraph should clearly state that audit was conducted in accordance with standards on auditing. So, the basis for our opinion is standards on auditing. We have conducted our audit in accordance with standards on auditing. Next, you should also make a reference to the auditor's responsibility paragraph. If you see in the audit report itself, there will be auditor's responsibility paragraph. See, auditor's responsibility paragraph. So in the basis for opinion paragraph, you have to make a reference to the auditor's responsibility paragraph. So our basis is based on our responsibility. The basis for the opinion that we have given is our responsibility. You can once check our responsibility also, like this you will mention in the basis for opinion paragraph. Next, you should also state that auditor is independent and has fulfilled auditor's ethical requirements. What are the ethical requirements? We have seen in SA 200, we have also seen in ethics chapter, right? Integrity, objectivity, confidentiality, professional competence and due care, and professional behavior. So I have complied with all these ethical requirements including independence. So the basis for my opinion is these things also, like this you will mention. Next, state whether auditor believes that the audit evidence obtained is sufficient and appropriate or not. See, the opinion that you give will be based on the evidence that you obtain. I told you this already. First of all, you will perform audit procedures. By performing audit procedures, you will get audit evidence. Based on the audit evidence, you will give your opinion. So you should state that the audit evidence that I have obtained is sufficient and appropriate for me for providing the opinion. So these four things you should mention in the basis for opinion paragraph. Clear? Yes, sir. Next, the opinion that gives, okay, the opinion that you gives, there should be certain wordings that you have to use in your opinion paragraph. So whatever the wordings of that opinion, let us see, it depends on which financial reporting framework you have used. See, if you have used fair presentation framework, I told you the difference between fair presentation framework and compliance framework in the introduction chapter, if you remember. right? So if you are using fair presentation framework and you wanted to give unmodified opinion, that is clean opinion, then your wordings will be, see, fair presentation framework, wordings of unmodified opinion. In our opinion, upon accompanying financial statements present fairly. So you can use the term either present fairly, or you can say that in our opinion accompanying financial statements give true and fair view. So if you wanted to give unmodified opinion and you are using fair presentation framework, you can use either of these two terms. First one is present fairly or shows a true and fair view. Okay, from these two paragraph you can select any one paragraph, meaning of both the things is same. Clear? Yes. Next, if at all you are using compliance framework, then the wordings of your unmodified opinion should be like this: the financial statements have been prepared in all material respects as per applicable financial reporting framework. Like this, you will say, you will not use the terms true and fair view or present fairly if you are using if the management has used the compliance framework. Got it? Yes. See, accompanying financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. Clear? Yes, sir. Next. Next. So, after basis for opinion paragraph, there will be material uncertainty related to going concern paragraph. See, about this paragraph, we will discuss in essay 570. Essay 570 deals with going concern, right? So, while discussing essay 570, we will discuss in depth about this particular material uncertainty related to going concern paragraph. Okay? Yes. Next, emphasis of matter paragraph. Emphasis of matter paragraph will be dealt by essay 706. In this chapter only we will discuss essay 706. While going through the 706, we will cover it. Next, key audit matter will be dealt by essay 701. Here in this chapter itself, we will cover 701. At that time, we will discuss key audit matter. Next, other information. Other information will be dealt by essay 720. Essay 720 is not there in your syllabus, right? I will just tell you what is meant by other information. You know, annual report. So every year companies have to furnish a annual report. So you can search in the Google annual report of so and so company. You will get some document, some 300 or 400 pages of document. Now that annual report contains various things like management discussion and board's report, right? Chairman message, like this lot of things will be there, along various ratios, various analysis. Along with this, there will also be audit report and audited financial statements that will be included in this annual report. Okay, so whatever the information is included in the annual report, apart from this audit report and financial statements, remaining all other information will be known as other information. Getting it? Which will be dealt by SS 720, which you will see in the CA final. For CA intermediate level, this is not applicable. Okay. Yeah. Next one is management responsibility. So, what are the responsibilities of management? Let us see. You already know responsibilities of management. Tell me. Prepare financial statements, establish internal control, provide auditor with access to all the information, right? And also to assess going concern ability of the entity, correct or not. All these are the responsibilities of management which you will mention in the audit report. See, management's responsibility paragraph: preparing financial statements, establishing internal controls, assessing entities' ability to continue as a going concern. So, it is the responsibility of management to assess whether my entity will continue as a going concern or not. and the auditor's responsibility is to verify whether the assessment made by the management is correct or not. Okay, that verification of management's assessment we will see in the auditor's responsibility paragraph. Just like there is the management responsibilities paragraph, there is also auditor's responsibility paragraph. There we will cover that point. Getting it? Next, identify those responsible for the oversight of financial reporting process. So the people who are responsible for overseeing the entire process of financial statements preparation, you need to identify the name of such person in the management responsibility paragraph. Name means if it is board of directors, you will tell board of directors. If it is audit committee, you will mention audit committee, like that. Name means not the individual name. Got it? Yes. So just a second. Sorry for the disturbance. I forgot to switch off my mobile phone. Yes. So after management's responsibility paragraph, there is also auditor's responsibility paragraph, right? So now we'll see what will be there in the auditor's responsibility paragraph. So if you see in essay 200, we have discussed auditor's objective is to obtain reasonable assurance that financial statements as a whole are free from material misstatements, whether due to fraud or error. This point we have discussed, right? So the same point you will mention here. Got it? See, state auditors' objectives as obtain reasonable assurance about whether financial statements are free from material misstatements and issue auditors report. This is the objective of auditor. In fact, we have discussed even a big objective, right? That entire line you should mention in the auditor's responsibility paragraph. Now here you have mentioned the reasonable assurance. You need to explain in your paragraph that reasonable assurance is a high level of assurance but not absolute assurance. Like this, you should give the definition of reasonable assurance also in your responsibility paragraph. And you have mentioned the term misstatement, right? You have to say that misstatements can occur either because of fraud or because of error, and you have used the term material misstatements. So in the responsibility paragraph you should also explain what is meant by materiality as per SA 320 we have discussed in the previous chapter only, right? So describe materiality as that influences the economic decisions of the users. The same definition we have discussed, right? So all these things you should mention in the auditor's responsibility paragraph, right? Yes. Next, in the same auditor's responsibility paragraph, you should also state that auditor exercises PJ. PJ means professional judgment, right? And maintains professional skepticism throughout the audit. I have explained you the difference between professional judgment and professional skepticism in the first chapter, if you remember, in the introduction chapter, right? So auditor needs to state that I have complied with professional judgment and also professional skepticism. Clear? Yeah. So all these things where you should mention in the auditor's responsibility paragraph, you should mention. Next, you should also describe audit by stating auditor's responsibilities or to identify and assess ROMM. This is responsibility of auditor, and to obtain understanding of internal control that are relevant to the audit. This is also responsibility of auditor. Next, evaluate appropriateness of accounting policies and conclude on appropriateness of use of going concern. So if you remember in the management responsibility paragraph, management has assessed whether entity will be able to continue as a going concern or not. Now in the auditor's responsibility paragraph, auditor will evaluate that, conclude on appropriateness of use of going concern by the management. Clear? Next, evaluate overall presentation structure and content of financial statements. So you should describe that these are my responsibilities, and in the same responsibility paragraph itself you need to state that auditor will communicate following things with those charged with governance. So I will communicate my planned scope and timing. I will also communicate significant audit findings during the audit. If I find any significant audit findings, I will communicate them also with those charged with governance. Next, complied with ethical requirements. So I will also communicate with those charged with governance whether I have complied with all the ethical requirements or not. Okay. Yes. Next, communicate all the relationships that I am having that might cause threat to the independence. This also I will communicate, and other matters regarding the independence. So all these matters I will communicate with those charged with governance. That is my responsibility. Like that, you have to say in the auditor's responsibility paragraph. So if you see, all these things should be mentioned by you in the auditor's responsibility paragraph. Clear? Next, so once the auditor's responsibility paragraph is done, next will be the other matter paragraph as per SA 706. See, you should remember, other information and other matter, both of these are different. Other information is as per SA 720, which is not there for you, and other matter is as per SA 706, which is there for you. Okay, they might give these two options in the MCQs and they might confuse you. Getting it? You should remember that both are not same, both are different. Okay, both are not same, right? Yes. Next, signature. So finally you will have signature of the auditor. So these are the contents of auditor's report. If you see, auditor's responsibility paragraph we have seen now. Where should the auditor's responsibility paragraph has to be kept? What should be the location of auditor's responsibility paragraph? There are three options available. You can include auditor's responsibility paragraph within the audit report itself. Okay, within the body of the audit report itself, you can include auditor's responsibility paragraph, or within an appendix to the auditor's report. That means as an annexure to the auditor's report, you can give auditor's responsibility paragraph. Or if at all the auditor's responsibilities are already described in any website, like in case of bank audit, let's say for example, all the auditor's responsibilities are already described by RBI in the RBI's website. In such a situation, auditor in his audit report under auditor's responsibility paragraph, he can make a reference to that website instead of listing all these things again. Clear? So by specific reference within auditor's report to location of such a description on a website. Next, final concept is UDIN. What is meant by UDIN? Unique document identification number. From when it is mandatory? From 1st of February 2019, this UDIN is mandatory. So why UDIN has been introduced? To curb the malpractices of fake CS. There is a possibility that people who are not chartered accountants might sign as if they are chartered accountant. To avoid that fake reports circulating in the market, Institute of Chartered Accountants of India has come up with this concept of UDIN. Got it? So on all certificates and reports that are signed by chartered accountant, UDIN has to be mentioned. Clear? And this UDIN is basically a 18-digit unique alphanumeric number. Got it? So there will be 18 digits in this UDIN. So this is about SA 700. Next, before moving to SA 701, let us discuss SA 705. Next, come to SA 701, because SA 705 is also about format of audit report in case of modified opinion, right? So let us discuss that first. See, SA 705, modifications to opinion in the independent auditor's report. So first of all, in which situations you will modify your opinion? If based on audit there are material misstatements in the financial statements, then you will have to modify your opinion. You cannot give unmodified opinion, correct? Next, if at all auditor is unable to obtain sufficient appropriate audit evidence, in such a situation also you have to modify your opinion. Now, modified opinions are of three types, right? What are they? Firstly, audit opinions are of unmodified and modified. Unmodified we have covered in SA 700. Modified opinions, they are of qualified opinion, adverse opinion, and disclaimer of opinion. Now, what are these three types of opinions, sir? When should we give these three types of opinions? Let us see. See, when you have to give adverse, when you have to give qualified, when you have to give disclaimer, that it depends on certain three factors. Okay, in making this decision, you should focus on three factors. What are those three factors? First one is whether audit evidence is available or not available. You need to check that. Next, if there are misstatements, is that misstatement material or immaterial? That is the second factor you need to check. First factor is availability of audit evidence. Next one is it material? Is the misstatement material or immaterial? Third one is a misstatement pervasive or not pervasive? Now, materiality you already know. In SA 320 we discussed. What is meant by pervasive, sir? I will explain you. See, this is financial statements. Now, misstatements are present in lot of items. Okay, there is misstatement in fixed asset, there is misstatement in inventory, there is misstatement in liabilities, there is misstatement in sales, there is misstatement in purchases. Like this, in lot of items, misstatements are there. That means misstatements are present across the financial statements. You will call this situation as misstatements are present pervasively. Understanding? Yes. So if misstatements are present in many items, you will call such a situation as a pervasive. Another one. So this is the first understanding for pervasive. Next understanding. This is financial statements, and in these financial statements, misstatement is there only in the inventory. Okay, only in the item of inventory there is misstatement. There is no misstatement in any other item. That means only one item is misstated, but that item represents a significant portion of financial statements. Around 60%, 70% of a financial statement is comprised by this item only, inventory only, and such an item got misstated. Then also you will call misstatement as pervasive. Understanding? So the two definitions for pervasive is misstatements are present in many items, or misstatement is present only in one item, but that item represents significant portion of financial statements. Got it? Yes, sir. See, meaning of the term pervasiveness describes the effect of misstatement or possible misstatement on the financial statements. There are two meanings to it. In relation to amounts, they are they means misstatements. Misstatements are not confined to specific element, account, or item. That means misstatements are present in many items, or see, or if so confined, that means misstatement is there in only one item, but it represents substantial portion of financial statements. Then you will call such misstatements as pervasive misstatement. Hope the concept is clear. Next, in relation to disclosures, if that disclosures are fundamental, very much important to the user's understanding of financial statements, then you will call such disclosures as pervasive. Okay, then you will call misstatements in such disclosures as pervasive. Getting it? Yes. So now you understood what is meant by pervasiveness. Now we will see how to decide qualified, adverse, and disclaimer of opinion. I told you three things you need to check, right? See, determining the type of modified opinion. So first factor you need to check is availability of audit evidence. Next one is misstatement material? Next one is misstatement pervasive? So let us start one by one. So audit evidence is available, yes, and misstatement is material, yes, but not pervasive. Then you will give qualified opinion. Next situation, audit evidence is not available, but misstatement is material but not pervasive. In this situation also you will give qualified opinion. So to give qualified opinion, whether audit evidence is present or not present, misstatement should not be pervasive. Getting it? Yes. Once misstatement is pervasive, you have to shift either to adverse or disclaimer of opinion. Getting it? Yes. Next, third situation. Audit evidence is available and misstatement is material and also pervasive. If all the things are yes, you will give adverse opinion, which is very much serious. Understanding? Yes. Next, if audit evidence is not available and the misstatement is material and also pervasive, since it is also pervasive, you cannot go for qualified opinion, you will give disclaimer of opinion, which is even more serious. Understanding? Because audit evidence is not there but misstatements are present across many items. Understanding? Then you will give disclaimer of opinion. Disclaimer means disclaim, that means you are not claiming any opinion, that means you are not giving any opinion because you don't have any evidence. Getting it? If you not at all have any evidence on which will on which you will base your opinion, so you are not giving any opinion, you are giving disclaimer. Getting it? Yes. Next, so I told you format of audit report in case of modified opinion will be dealt by SS 705, right? Now, is it different from the format that we have discussed in SA 700? The answer is no. See, all the paragraphs that we have discussed in SA 700 will be applicable as it is, except that only 3 paragraphs will change. So what are those paragraphs that will change? We will see now. Okay. See, the first paragraph that gets affected is opinion paragraph. Of course, since your opinion is changing from unmodified to modified, the opinion paragraph of course has to be changed. Correct or not? As the opinion paragraph changes, basis for opinion paragraph also changes. Correct or not? So basis for opinion paragraph also changes. So these 2 paragraph changes in all the 3 modified opinion cases. Next, auditor's responsibility paragraph will change if you are giving a disclaimer of opinion only. Okay, if you are giving qualified opinion or adverse opinion, this auditor's responsibility paragraph will not change, only these 2 paragraphs will change. But if you are giving a disclaimer of opinion, then along with opinion paragraph and basis for opinion paragraph, even the auditor's responsibility paragraph will also change. Clear? Yes. Another important point that you need to remember is, unless required by law or regulation, when auditor disclaims an opinion on the financial statements, auditor's report shall not include a key audit matter. So, okay, since this is related to key audit matter, we will see in SS 701. But what they are saying is, if auditor is giving disclaimer of opinion, in such a situation, audit report should not contain key audit matter paragraph. Getting it? So if you are giving disclaimer, then your audit report should not contain key audit matter paragraph, and also your audit report should not contain other information paragraph, other info. As per which standard? I told you, SA 720, which is not there for you. Okay, but since they have told this point, you need to remember this. So what is it? If you wanted to give disclaimer of opinion, then your audit report should not contain key audit matter paragraph and also other information matter paragraph. Yes, sir. Next, so if you see, if you wanted to give unmodified opinion, we have seen what will be the wordings of your paragraph, right? If in case you wanted to give modified opinion, what will be the wordings? We will see. So if you wanted to give qualified opinion, when will you give? If misstatements are there only in less items. If the misstatements are not pervasive. So misstatements are not present across the financial statements. Then what will be your opinion paragraph? You will say that financial statements are showing, see, when you are giving as per fair presentation framework, you will say that except for the effects of matter described in basis for qualified opinion paragraph, the remaining financial statements are showing true and fair view. That means except matters I have specified in basis for qualified opinion paragraph, with respect to remaining all other financial statements, they are showing true and fair view, like that you will say, because misstatements are not pervasive. And if in case you are following compliance framework, you will say that except for the matters described in the basis for qualified opinion, remaining financial statements are prepared as per applicable financial reporting framework. Okay, wordings will be same, the true and fair view, these things you will use, but you will say that except for the effects of matter. Getting it? Yes. Next, if you wanted to give adverse opinion, adverse opinion means misstatements are present in many items. Since the misstatements are present in many items, you will not use the term except for the matters. You will say that complete financial statements are not showing true and fair view. Complete financial statements are not prepared as per applicable financial reporting framework. Got it? See, in the auditor's opinion, because of significance of, that means importance of matters described in basis for adverse opinion section, if you are using fair presentation, the financial statements do not present fairly or does not show true and fair view. Here you are not restricting your opinion, adverse opinion, to just some items like qualified. In qualified, what did you say? Except for some items, financial statements are good. But here you will say that financial statements, complete financial statements are not showing true and fair view. Got it? Compliance framework means complete financial statements are not prepared as per applicable financial reporting framework. Got it? Next, disclaimer of opinion. If you are giving disclaimer of opinion means you are not claiming any opinion, so you need to mention the following things in the disclaimer of opinion paragraph. Let us see what are those things. When auditor disclaims an opinion due to inability to obtain sufficient appropriate audit evidence, then you shall state that auditor does not express opinion on these financial statements. Why? State that because of the matter described in basis for disclaimer of opinion section, auditor has not been able to obtain sufficient appropriate audit evidence. Because of this, I am not able to express the opinion. This point you need to mention. And you should also amend the statement required by SA 700, which indicates that financial statements have been audited. If you see in the opinion paragraph of SA 700, I told you that you have to state clearly that we have audited financial statements, like this you need to mention. But since in this disclaimer you are not giving any opinion, you should not use that term that we have audited. You have not audited, that's why you are not, that's why you are giving a disclaimer. So you should say that instead of saying we have audited, you should mention that financial state, instead of saying that, state that auditor was engaged to audit financial statements. Okay, you should not say that we have audited financial statements. Instead of saying that, you should say that auditor was engaged to audit financial statements. Clear? Yes. Next, basis for modification of opinion. So we have completed how opinion paragraph will change, right? Now we will see how basis for opinion paragraph will change. First of all, the heading will change, right? Instead of just using basis for opinion, you will use like this: basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion, like this. Okay, the heading will change. Okay, basis for disclaimer, basis for adverse, basis for qualified. Next, you should also include a description of why you are giving a qualified opinion, why you are giving adverse opinion, why you are giving a disclaimer of opinion. You need to describe the misstatement. See, include a description of matter giving rise to modification. Sir, how will we describe, sir? See, You need to describe like this. Based on the cause of modification. Are you able to see this? Okay, this is a maximum zoom I can do. I'll just do one thing. I just increased it a little bit. Yes. So now it will be somewhat better. So causes of modification. If the cause of modification is there is a misstatement in a particular amount, then how you need to describe it? You need to quantify how much misstatement is there. You need to quantify it to effect of misstatement on financial statements. If at all it is impracticable to determine and quantify, you need to state the fact. If at all it is not possible to quantify the misstatement, you need to state why it is not possible to quantify the misstatement. Getting it? Yes. Next, if cause of modification is because there is a material misstatement in the narrative disclosures, then you should explain how narrative disclosures are misstated. Understanding? Next, if material misstatement related to non-disclosure of information, certain information has to be disclosed but it is not disclosed, because of that you wanted to give modified opinion, then in the basis for modification of opinion you need to describe. Okay, you need to discuss that non-disclosure with the those charged with governance and describe the nature of omitted information in the audit report. In your basis for opinion paragraph, you need to describe what is such a disclosure that is missing in the financial statements, and unless prohibited by law or regulation, include the omitted disclosure if it is practicable to do so and the auditor has obtained sufficient appropriate audit evidence about the omitted disclosure. That means in the financial statements certain disclosure should be there but it is not there. That's why you wanted to give modified opinion. In such a situation, if it is possible, whatever the disclosure that you feel should be there in the financial statements, you give that disclosure in the audit report in basis for modification paragraph. Getting it? Yes. Next, if at all there is a inability to obtain sufficient appropriate audit evidence, then state the reasons for that inability. State the reasons why you are not able to obtain audit evidence. Clear? Yes, sir. Next, management has imposed certain limitations after you have accepted the engagement. So if management imposes a limitation before accepting the engagement, then as per SA 210 you will not agree to that engagement. We have discussed this point in SA 210, correct or not? If at all after accepting the audit, management comes and say, see auditor, you should not get external confirmation, you should not visit physical inventory verification, you should not verify cash book, like this all sorts of limitations management is putting on the auditor after he has accepted the audit. In such a situation, what the auditor has to do? See, if the limitation leads the auditor to express qualified disclaimer of opinion, request the management to remove the limitation. See management, because of this limitation I might have to give disclaimer or some modified opinion I might have to give. So please remove this limitation. If management refuses to remove the limitation, then communicate the same with those charged with governance. See, those charged with governance, they have put this limitation on me. Because of this limitation, I cannot give unmodified opinion. I might have to give modified opinion. Like this, you will tell to those charged with governance. After that, if those charged with governance also doesn't agree to remove the limitation, then you will see what is happening. Because of the limitation put by the management, example, they said not to attend the physical inventory verification. Because of this, what is happening? You are not able to obtain audit evidence. Now you will see whether you can perform any alternate audit procedure to obtain that audit evidence. If through alternate audit procedure you are able to obtain audit evidence, means problem is solved. Correct or not? The ultimate purpose is you have to obtain audit evidence. For that you wanted to physically verify. Management has told you not to physically verify. Then you will see whether you can uh, perform any other procedure to obtain audit evidence. Understanding? Yes, that you need to see. So whether it is possible to obtain sufficient appropriate audit evidence through alternate audit procedure. Next, if you feel that through alternate audit procedure also I cannot obtain sufficient appropriate audit evidence, see, unable to obtain sufficient appropriate audit evidence through alternate audit procedure also, then what will you do? You will see, I am not able to obtain audit evidence. So, if at all there are any misstatements, what will be the effect of that misstatements? If that misstatements are material but not pervasive, you will give qualified opinion. If you feel that if at all there are any misstatements and that misstatements are material and also pervasive, and you are not having audit evidence because management restricted you, in this situation you might have to give disclaimer of opinion. If that is the situation, you will first of all see whether it is possible to withdraw from the engagement. Okay, instead of giving a disclaimer of opinion, better to withdraw from the engagement. So you will check that option first. Okay, possible effects of undetected misstatements could be both material and pervasive. Then you will see whether you can withdraw from the engagement. If it is not possible to withdraw from the engagement, then you will give disclaimer of opinion. Clear? Yes, sir. Still, we need to discuss some things, right? Next, if auditor wants to give disclaimer of opinion, see, till now we have covered how opinion paragraph gets changed, how basis for opinion paragraph gets changed. But I told you that if you want to give modified opinion, three paragraphs will get changed. Correct. What is the third paragraph? Auditor's responsibility paragraph. But this auditor's responsibility paragraph will not change if you give qualified and disclaimer of qualified and adverse opinion. This auditor's responsibility paragraph will change only if you give disclaimer of opinion paragraph, right? So only in case of disclaimer of opinion paragraph, what should be excluded from the auditor's, sorry, not auditor's responsibility, basis for opinion paragraph. So what should be excluded? Let's see. Reference to auditor's responsibility paragraph you need to exclude. Okay, so in the basis for opinion paragraph, four things will be there. One of such a thing is you will refer to the auditor's responsibility paragraph. If you see the four things that will be included in the basis for opinion paragraph, see, basis for opinion paragraph, the four things that will be included. Of these four things, you will not include this one, reference to auditor's responsibility paragraph you will not give, and also you will not state that audit evidence obtained is sufficient and appropriate for my purpose. These two points, you will remove from the basis for opinion paragraph if you wanted to give disclaimer of opinion. Okay, if you wanted to give disclaimer of opinion, only the first point and the third point will be mentioned. Clear? Yes, sir. So the third point is here. Next, changes in auditor's responsibility paragraph. So in case you wanted to give disclaimer of opinion, how the auditor's responsibility paragraph will change? See, these exclusions from the basis for opinion paragraph are only if you want to give disclaimer of opinion. Similarly, change in the auditor's responsibility paragraph is also only when you wanted to give disclaimer of opinion. Clear? So first of all, the opinion paragraph, it will change in all the three cases, and basis for opinion paragraph will also change in all the cases, but exclusions, only these two things should be excluded and the remaining two things should be mentioned in the basis for opinion paragraph in case of disclaimer of opinion Okay, and finally the third paragraph, auditor's responsibility paragraph, it will be also changed if you want to give disclaimer of opinion. Okay, if you want to give qualified or adverse, then auditor's responsibility paragraph will not change. See, Here, what things you need to mention? Statement that auditor's responsibility is to conduct an audit. You need to mention this point that my responsibility is to do the audit, but because of matter described in basis for disclaimer of opinion, I was not able to obtain sufficient appropriate audit evidence. You will mention these 2 points. And finally, the statement about auditor's independence and other ethical responsibilities. Okay, so you will mention only these 3 points in the auditor's responsibility paragraph if you wanted to give disclaimer of opinion. Clear? Yes, sir. So this is essay 705. Now we will move to essay 701. Yeah. So essay 701 deals with communicating key audit matters in the auditor's report, right? See, communicating key audit matters in the independent auditor's report. First of all, what is this key audit matter, sir? I'll explain you meaning of key audit matters. See, those matters that in the auditor's professional judgment are of very much significant for the current period audit will be known as key audit matters. And another important point is these key audit matters are selected from the matters that you communicate with those charged with governance. Clear? See, so meaning is those matters that in the auditor's professional judgment are significant for the current period's audit. Now, SA 701 is applicable to whom? Basically, key audit matter paragraph is there na, that is not applicable for all the companies, only for listed company audit. Only in the audit report of a listed company, key audit matter should be there. It is mandatory for listed companies. So, SA 701 is applicable for audit of listed entities. However, auditor, if he wants, voluntarily he can give key audit matter paragraph in private companies also, in the remaining unlisted companies also. If in case voluntarily he wants to give key audit matter paragraph, then also he needs to comply with SA 701C. Circumstances when auditor otherwise decides to communicate CAM, then also he needs to comply with the requirements of SA 701. If at all law or regulation requires the auditor to communicate key audit matter paragraph, then also he needs to comply with SA 701. Next, purpose of key audit matter. Why this key audit matter is required? See, just to increase the communicative value of the audit report, auditor will include this key audit matter paragraph in his audit report. Okay, see, it is to enhance the communicative value of auditor's report and assist users in understanding most significant matters. Now we will see how these key audit matters are determined. There are 3 steps in determining key audit matters. We will see what are those 3 key steps. So first one, all the matters that you have communicated to those charged with governance as per SA 265, as per SA 216, and as per remaining all other standards, during the audit you would have communicated certain matters with those charged with governance, right? All that matters you need to take. This is the first step. Now, from that matters, determine the matters that require significant auditor's attention. So, from these matters, on which matters my attention is required, you will pick up that matters. So second step is picking the matters that require my attention. Now from these matters, in making this determination, auditor shall take into account, okay, in determining which matters will require my attention, you can consider some of these following factors. Okay, areas that require, that are assessed as high Romum. Okay, so from the matters communicated to those charged with governance, if any matter, in any matter, the Romum is high, your attention might be required for that area, right? So you need to consider which items require more attention, which items have more Romum. Next, areas that require significant auditor's judgment. So from these matters, which of matters require my significant judgment, and significant events or transactions. Okay, of these matters which I have communicated to those charged with governance, which are very significant event and transactions, you need to consider these factors. Okay, see, all these are the matters you have communicated to those charged with governance. From those matters you communicated to those charged with governance, you need to pick the matters which require your significant attention. Okay, let's say all these blue dots require your significant attention. So in determining these blue dots, you have to consider these factors. Understanding? So in determining these blue dots, you have to consider these factors. Understanding? Now all these blue dots you will make them aside. Okay, so all this contains now the matters that require your significant attention. From this, the third step is determine which of the matters so determined above were of most significance in the audit of financial statements of current period in current period and therefore key audit matter. Okay, so from these things you will determine which matters. Okay, from all the blue dots, which matters are significant for the current period audit. All the blue dots might not be significant for current period audit, only some might be significant. So you will again identify the green dots. Understanding? Clear? Yes, so that green dots you will communicate as key audit matter. So first one, pick all the matters communicated to those charged with governance. From that, determine the matters that require significant attention. Now from this, again filter out the matters which are significant for the current period audit. Understanding? Yes. So like that you will determine key audit matters. Once you have determined the key audit matters, next step is to communicate those key audit matters. Correct or not? To whom will you communicate? To those charged with governance you will communicate those key audit matters. What is the process for communicating with those charged with governance? Let's see communication with those charged with governance. First of all, sorry, you will not communicate key audit matters to those charged with governance. You will include that key audit matters in the audit report under key audit matter paragraph. Correct? So communication of key audit matters in the audit report. So the heading that you will use for this paragraph is key audit matters. Under this heading you will communicate all the key audit matters. Next, describe each key audit matter in appropriate subheading. That means, see, first of all, you have used the main heading as key audit matter. Now, during the audit, you might have identified some key audit matters in the area of fixed assets, some key audit matters in liabilities, some key audit matters in inventory. Like this, in various areas, you might have identified key audit matters, right? So, you should, under the main heading, include subheading. If you are communicating about key audit matters in fixed assets, you need to use the appropriate subheading. Under this you need to communicate key audit matters of fixed assets. Next, if you want to communicate again in another item, then write inventory subheading. Okay, these are the subheadings. So under the main heading you should give subheadings. Under the subheading you need to describe. Clear? Yes sir. Where is it? Yeah, so you need to describe each key audit matter. Next, introductory language shall state the following things. So the introductory language of key audit matter paragraph should contain these paragraphs. What are they? Key audit matters are those matter which are more significant in the current year audit. So this is nothing but the definition of key audit matter, right? So you need to give the introductory language of key audit matter paragraph should contain definition of key audit matter, and that these matters were addressed in the context of audit and auditor does not provide separate opinion on these key audit matters. So these things you should write as part of introductory paragraph. So your key audit matter paragraph should start with this introductory paragraph. Next, the subheadings. Clear? Yes. Next, Now, under each subheading, you need to describe key audit matter paragraph in these three things. What are they? So, description of each key audit matter paragraph shall contain the following three things. You need to describe, so understanding. So, first of all, there will be heading as key audit matter paragraph. Under this heading, there will be introductory paragraph. The introductory paragraph contains the 2 points. After that, there will be subheadings of fixed asset, inventory, like this. Now, under each of these subheading, it should be described in three parts. So, what are those three parts? We will see. Firstly, why the matter was considered to be most significant. See, auditor, you are telling this matter is key audit matter. Why that matter only selected as key audit matter? Why you felt it as very significant for the current period audit? You need to mention it. Next, how the matter was addressed in the audit. See, auditor, you are telling this is key audit matter. If this is a key audit matter, then how did you address this matter during the audit? You need to give it, and a reference to related disclosure, if any, in the financial statements. If at all that key audit matter is already properly disclosed in the financial statements, then in the audit report, in this key audit matter paragraph, you will give a reference. See, users, you can find this clear explanation in so and so note number of the financial statements. Clear? So, if the key audit matter is already disclosed properly in the financial statements, you should make a reference in the audit report in the key audit matter paragraph to that point where it is present in the financial statements. Clear? Yes. So, this is how you will communicate key audit matter paragraph. Next, another important point. Key audit matter should not be communicated if auditor disclaims the opinion. This is very important. So, we have already seen this point in SS 705, if you remember. If auditor is giving disclaimer of opinion, means you have not at all conducted the audit. That's why you are not claiming any opinion. If you have not at all conducted the audit, how will you identify key audit matters? Correct or not? So, if you are giving a disclaimer of opinion, then in your audit report, key audit matter paragraph should not be there. Clear? Yes, sir. Next, note. Determining matters which are most significant in the audit is a matter of PJ. Okay, in the third step of the items that require my attention, which are significant for the purpose of current period audit. In determining that, you need to apply your PJ, you need to apply your professional judgment. Clear? Yes. Next, what if there are no key audit matters? Okay, in case of listed entity, auditor has audited and he has not found any key audit matters. Then what should you do? You should not skip key audit matter paragraph. You should include key audit matter paragraph, and in that you need to describe that there are no key audit matters in the audit. Understanding? But you should not completely remove the key audit matter paragraph itself. You need to give heading key audit matter paragraph, and in that you need to say that there are no key audit matters. Because giving a key audit matter paragraph is mandatory for the listed entities. Okay. Next, circumstances where matter determined as key audit matter is not communicated. Okay, you have determined a particular matter as key audit matter, but you need not communicate it. Why? Two situations. Firstly, law or regulation tells you not to communicate. If law or regulation is itself is telling not to communicate the key audit matter, then you will not communicate, even though you have identified it as a key audit matter. Okay. Next situation, the benefit that you will get because of community, the benefit that users will get because of communicating the key audit matter is less when compared to the disadvantage of communicating the key audit matter. Understand? So, loss to the users because of communicating key audit matters is more when compared to the benefit that they will get because of that key audit matter. In such a situation, better not to communicate key audit matter in the key audit matter paragraph. Understanding? Yes, sir. So this is essay 701. Now we will go to 706, a small standard. 706 is a little standard, very easy standard also. Here 706 deals with emphasis of matter and other matter paragraph. See, the standard gets completed once you understand what is the emphasis of matter paragraph, what is other matter paragraph. Let us understand that first of all. So, starting with emphasis of matter paragraph. If auditor wants to communicate users about something that is already present in the financial statements, okay, in the financial statements, a item has already been disclosed and that item is very much important for the user's understanding of the financial statements. Okay, without this item, okay, without reading these disclosures, this disclosure, users cannot understand the financial statement. It is very much significant. In such a situation, there is a possibility that users might miss reading that point, correct or not, because financial statements, they will be of 50 pages or 60 pages including the notes. So in that many pages users might miss it, but it is very much important for the users to understand the financial statements. In such a situation, what the auditor will do is, auditor in his audit report, in this emphasis of matter paragraph, he will emphasize this matter. Okay, this matter will be emphasized by the auditor in his audit report, because audit report will be just 3 or 4 pages. So in the emphasis of matter paragraph, auditor will say, see users, in the financial statements in so and so note number, there is a particular disclosure, you please go and read it. Like this he will emphasize. Understanding? Emphasize means stressing on something that is already there, already disclosed in the financial statements. Clear? That is emphasis of matter paragraph. You will use emphasis of matter paragraph for this purpose. Clear? Yes. Next, coming to other matter paragraph. Now, when will you use other matter paragraph? If you see, if auditor wants to communicate something about financial statements, auditor use emphasis of matter paragraph, correct or not? If auditor wants to communicate something about the audit that the auditor has done, or something about the audit report, or something about auditor's responsibilities. Okay, if auditor wants to communicate to the users something about these three things, then auditor will communicate it in other matter paragraph. This is the difference between emphasis of matter and other matter paragraph. So emphasis of matter paragraph you will use to communicate something about the financial statements which is already disclosed in the financial statements, whereas other matter paragraph you will use to communicate something about your audit or the audit report or the auditor's responsibilities. These things, they need not be disclosed already in the financial statements. Getting it? Yes. Now let's see the emphasis of matter paragraph. See the definition, the same thing I have told you, the same thing you will find it as a definition. Next, auditor would not be required to modify the opinion because of the matter. See, if because of a particular matter, okay, because of a item 1, you have given modified opinion. Okay, because of this reason you have given modified opinion. Now the same item, the same reason, okay, the same item number 1, it should not be again given in the emphasis of matter paragraph, because to avoid dual reporting, already because of this item you are giving modified opinion, then why again to emphasize it in the emphasis of matter paragraph? Clear? This point you need to remember. Next, matter has not been determined as scam. Again, to avoid dual reporting, If any item you have communicated as a key audit matter, the same item again you don't mention in emphasis of matter paragraph, because already you have communicated it in key audit matter. Clear? Yes. Again, this is also to avoid dual communication. Next, use the heading that includes the term emphasis of matter. Okay, so the heading for this paragraph should have these words, emphasis of matter. Clear? Yes. Next, include a clear reference to the matter being emphasized. See, emphasis of matter paragraph means, what did I tell you already? That is present in the financial statements. You are emphasizing it in the audit report. So, you need to clearly make a reference. That means, in which note number, in which page number of the financial statements you can find this matter. Like this, you need to clearly make a reference to the financial statements. Getting it? Yes. Next, refer only to information presented or disclosed in the financial statements. Let's say, for example, if a particular matter is not at all disclosed or not at all present in the financial statements, then you cannot emphasize in the audit report in the emphasis of matter paragraph. Only if the matter is already disclosed in the financial statements, you can emphasize it in the emphasis of matter paragraph. If the matter is not there in the financial statements, not disclosed in the financial statements, then you cannot emphasize it in the emphasis of matter paragraph. Clear? This is one more important point that you need to remember. Next, indicate that auditor's opinion is not modified in respect of matter that has been emphasized. See, you should clearly say that. Users might misunderstand that auditor has included this item in the emphasis of matter paragraph. That means, is auditor modifying his opinion with respect to this matter? No, 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 no. Including the matter in emphasis of matter paragraph doesn't mean that auditor is giving a modified opinion. It is just auditor bringing this matter to the attention of users. Clear? Yes, sir. Next, coming to other matter paragraph. So, other matter paragraph, I have explained you the same thing you will find in the definition. Next, if you want to give any matter in the other matter paragraph, that should not be prohibited by law or regulation. Okay, law or regulation should not prohibit you from giving that matter in the other matter paragraph. Only then you can give it in the other matter paragraph. Next, the same thing, if you have already given this matter in the key audit matter paragraph, then again you need not give in the other matter paragraph. Avoid dual communication. Okay, so matter has not been determined as cap. Next, you have to use the heading as other matter. So in the heading of this paragraph, the term other matter should be present. Clear? Yes, sir. Next. So we are also done with essay 706. Still only one standard is left. Essay 710. Essay 710, it deals with comparative information. Comparative information means, see, in the current year financial statements, you will also give previous year figures in the side column. Okay, there will be two columns, current year column and previous year column. That is nothing but a comparative information. So for the purpose of comparison, you are giving that information. Now the question is, see, this is the financial statements, right? Particulars, current current year figures and last year figures, previous year figures, right? Now auditor is signing these financial statements, right? He will sign these financial statements. That means he is signing the financial statements that is containing the previous year figure. So is he having any responsibility with respect to previous year figure? The answer is yes. He is having some responsibility with respect to previous year figure, because he is signing the financial statements that is containing the previous year figure. So he needs to verify certain factors, certain items, certain things with respect to previous year figures. So what should be verified with respect to previous year items? We will see in essay 710. Understood the context of the standard? Yes. See, Firstly, comparative information, it can be of two types. One is corresponding figures, another one is comparative financial statements. Sir, what is the difference between corresponding figures and comparative financial statements? See, the thing that I have told you here is corresponding figures. Okay, this is corresponding figure wherein the previous year figures are integral part of current year figures. That means together with the current year figures you are giving previous year figures also. That means without current year figures you cannot read previous year figures. This is corresponding figures. Now coming to comparative financial statements, observe comparative financial statements. That means you will give current year financial statements like this. Okay, so particulars and current year figures, and you will also give complete previous year financial statements like this, particulars and again previous year figures. Understanding? So if you present to separate financial statements completely all together for the comparison purpose in the current year also, then you will call it as comparative financial statements. Now in this situation, comparative financial statement is not integral part of current year figures. That means even though you don't have this current year figures, you can read these comparative financial statements individually. Understanding? This is comparative financial statements. I hope you understood the difference between corresponding figures and comparative financial statements. Now, sir. So the definition of comparative information. See, the information that you give for the purpose of comparison is comparative information. Simple definition. This is of two types. These two types are important. First one is corresponding figures. So observe whatever the things that I have told you, all those things you will find in the definition. See, corresponding figures. Comparative information. Corresponding figure is a type of comparative information. Yes, where amounts and other disclosures for prior period, that means last year, are included as integral part of current period financial statements and are intended to be read only in relation to the amounts and other disclosures relating to the current period figures. That means if current period figures you remove, you cannot read the previous year figures individually, then you will call it as corresponding figures. If you present the comparative information in this fashion, you will call it as corresponding figures. Getting it? Yes. Next, comparative financial statement. See, comparative information where amounts and other disclosures for prior period are included for comparison with the financial statements of current period, but if audited or referred to in the auditor's report. Another thing you need to remember is auditor, see, if management has given corresponding figures, then auditor in his audit report he will never refer to these corresponding figures. Okay, his opinion will be only on the current year figures. He will not give opinion on the previous year figures. But if management has given comparative financial statements, then the audit report of the auditor will give opinion both on current year financial statements and also previous year financial statement. That is nothing but the comparative financial statement. Understanding? Clear? So on this is related to last year. Correct? Last year financial statements for comparison purpose you are giving in the current year. So in the last year, already last year's auditor would have given audit report for this. Okay, in that audit report there would have already been a opinion on these financial statements. Now again in the current year also, current year auditor will give opinion on these last year's which are presented in the current year as compared to financial statements and also current year financial statements. Getting it? Yes. Now the question is it possible that in the last year, that is in this audit report, the previous year auditor has given unmodified opinion? Okay, unmodified opinion is given by the last year auditor on these financial statements, but the same financial statements you are including in the current year as a comparative financial statements, so you are giving opinion here. So in the current year, on the same last year financial statements, you wanted to give modified opinion. Is it possible? Of course you can give. Okay, the opinion that has already been given in the last year can be different from the opinion that you give in the current year on the same financial statements. Understanding? Yes. So this point we will see in the reporting point. Now before going to this reporting, there is one more point. So on this comparative information, what audit procedures you should perform? Let us see what audit procedures you should perform. First of all, ensure comparative information agrees with amounts and disclosures presented in the prior period. So whatever the amounts that you have shown as the comparative information in the current year, that should be same as that of previous year, right? Previous year the fixed asset is showing as 20,000, and in the current year in the comparative financial statement or comparative financial information you are presenting it as 15,000. It should not be like that. Both should match because both are the same figures. This should be checked by the auditor whether both are matching or not. Next, whether accounting policies are consistent. So the same accounting policies that you have followed in the previous year, same policies have you followed in the current year also. And if at all there is a change in the accounting policy, whether that change have been properly accounted for, you need to see that. Got it? These procedures you need to perform. Now moving to the reporting aspect. So this reporting, we can bifurcate this reporting into three parts. First of all, reporting that is exclusively applicable for corresponding figures. See, you should remember what is meant by corresponding figure because we will be using these terms in this standard. I told you the difference between corresponding and comparative. You need to remember it. Okay. Next, reporting that is exclusively applicable for comparative financial statements. And finally, reporting that is common to both comparative financial statements and corresponding figures. Got it? In this fashion, we will be studying this. First of all, reporting that is exclusively applicable for corresponding figures. What did I tell? In case management has presented corresponding figures, auditor's report should never refer to the corresponding figures. Auditor's opinion should only be on the current year figures, right? But this is a general rule. But in certain two special situations, auditor's report can refer to the corresponding figures. What are those two situations? We will see here. See, auditor's opinion shall not refer to corresponding figures except in the following cases. What are the following two cases? See, prior period included a modified opinion and matter which has given to that which has given rise to that modified opinion is not yet resolved, still it is continuing in the current year also, then you will give your opinion modified referring to the corresponding figure. Understood? When you will refer the corresponding figure, if in the previous year modified opinion has been given, matter which gave rise to modified opinion is continuing in the current period also, then you will refer to the corresponding figure stating that because of this corresponding figure I am giving modified opinion. Second situation, if auditor has sufficient evidence that material misstatement exists in the financial statements of prior period which was not addressed earlier. Okay, the previous auditor did not find out a misstatement in the financial statements of previous year, but current year auditor, while verifying the corresponding figures, he found a misstatement. In this situation also, you will refer to the corresponding figures. Okay, these two are the only situations where you will refer to the corresponding figures. Got it? Yes. Next, reporting that is exclusively applicable to comparative financial statements. See, the basic rule here is, if management has given comparative financial statements, always your report should give opinion on comparative financial statements also. Always your report should refer to the comparative financial statements also, not like corresponding figures. Okay, so auditor's opinion shall refer to each period for which financial statements are presented. Clear? Yes. If auditor's opinion on prior period financial statements in the current period financial statements differ from the opinion previously expressed, disclose the reasons for the same in other matter paragraph. What is this, sir? I told you now here. So in this report, auditor has given one type of opinion on the same financial statements. In this report, auditor is arriving at different type of opinion. In this situation, you have to give other matter paragraph in this report and mention the reasons of why you are arriving at a different type of opinion on the same financial statements. In the previous year, you have given unmodified opinion. The same financial statements, if it is given in the current year as comparative financial statements, you are changing your opinion. Why? What are the reasons? You should mention them in the other matter paragraph. Understood? Yes. Finally, material misstatements in the prior period financial statements, but predecessor auditor has not reported. Okay, so there are misstatements in the last year financial statements, but the last year predecessor auditor has reported without identifying that misstatements. Now you, current year auditor, has identified that misstatements. Now what you will do? You will tell the management, there are these misstatements, you please ask the predecessor auditor to correct them. If predecessor auditor corrects and new audit opinion is given, it is fine. If not, you will have to modify your opinion with respect to that aspect. Got it? Yes, the same thing you will find here. Next, reporting that is common to both corresponding figures and also comparative financial statements. First one, if prior period financial statements are audited by predecessor auditor, that means last year's audit is done by some other auditor, you have not done. In that situation, in the current year audit report, under other matter paragraph, you should mention that the last year audit is done by predecessor auditor and the type of opinion that he has expressed in that audit report and what is the date of that audit report. These things you need to mention. If let's say prior period financial statements are not at all audited, last year financial statements are not at all audited, in such a situation you will mention in the other matter paragraph, okay, other matter paragraph, that comparative financial statements are not at all audited. Got it? Yes, sir. So this is complete revision of fifth chapter. I hope you enjoyed this revision. If you enjoyed the revision, you know what to do. What should you do? You need to comment the best lecture, right? This will give me motivation to record more and more content for you people, right? Yes. Now I will open sixth chapter, which is CARO. Let me open that. Yes, guys, here I am with chapter number 6, nothing but CARO 2020. So, CARO 2020, it is not applicable to all the companies, right? So, first of all, we will start with applicability of CARO 2020. Then we will discuss all the 21 clauses of this CARO 2020. Got it? Yes. So, let us start our discussion. So to which companies CARO 2020 is applicable? There are certain companies which can claim exemption from applicability of CARO. Let us see them. So if you see, CARO is applicable to every company including a foreign company. So for a foreign company also CARO is applicable except the following companies. So for the following companies CARO is not applicable. What are they? Banking company. So for banking company, why CARO is not applicable? Because the reporting requirements in case of a banking company are even more stricter than CARO. So CARO is not applicable to banking company. Similarly, with respect to insurance company, Section 8 company, see, Section 8 company, the purpose is not to make the profits, but the purpose is to make charity, right? So, exemption from CARO has been given to Section 8 company. Next, one person company is a very small company where only one director is there. So, to reduce the reporting burden, CARO has been exempted. And small company means a company whose share capital is less than or equal to 4 crores and the turnover is also less than or equal to 40 crores, then you will call such a company as small company, and for small company CARO is not applicable. Clear? Next, coming to the private companies. Private companies can claim exemption from the applicability of CARO if they satisfy all the following criteria. What is that criteria? We will see. First of all, for a private company, in order to claim exemption from CARO, it should not be either subsidiary nor a holding of another public company. If at all private company is holding another public company or private company is a subsidiary of another public company, then private company cannot claim exemption from CARO. Understanding? So apart from this, the private companies paid up share capital and reserves and surplus should be less than or equal to 1 crore rupees, and borrowings should be less than or equal to 1 crore rupees, and turnover should also be less than or equal to 10 crore rupees. If all these conditions are satisfied, then private limited company can claim exemption from the applicability of CARO. Got it? Yes. Next. Now we will start discussion of all the clauses. Before starting discussion of clauses, see, CARO 2020 is applicable for audit of standalone financial statements except clause 21. Okay, clause 21 of CARO 2020 is not applicable to the audit of standalone financial statements because clause 21 is applicable only to the audit of consolidated financial statements. Okay, so if you see in case of audit of consolidated financial statements, CARO, entire CARO is not applicable except clause 21. So only clause 21 is applicable to audit of consolidated financial statements. Except clause 21, remaining clauses are applicable to audit of standalone financial statements. Clear? Yes. Now, so clause number 1. Clause number 1, it deals with property, plant and equipment. So with respect to property, plant and equipment, what points has to be reported by the auditor? Let's see. See, auditor needs to report whether the company is maintaining proper records of PPE including intangible assets. Getting it? So whether company is maintaining proper records of all the assets or not, auditor needs to report. Next, company's management should also physically verify the inventory, physically verify the PPE at regular intervals. So whether such verification of fixed asset, that is PPE, has been carried out properly or not, that should also be reported by the auditor. If at all during such verification any discrepancies are found, then such discrepancies or the differences should be properly accounted for in the books of accounts by the company. Next, in case of immovable properties like land, building, in case of such assets, in the title deeds, name of the company should be there. If the name of the company is not there in the title deeds of the immovable property, auditor has to report here. Getting it? Yes. Next, if at all during the year the property, plant and equipment has been revalued, then auditor needs to ensure that whether such a revaluation is based on the certificate given by registered valuer. See, registered valuer is a professional whose profession is to value the assets. So if you are revaluing your assets, then it's mandatory to make such a revaluation only based on the certificate, valuation certificate given by the registered valuer. If in case, see, if in case change is 10% or more of each class of PPE, you need to specify the amount. That means original original value is some 100 crore and revalued value is some 120 crore, which is more than 10% of the original value. In such a situation, auditor needs to disclose how much amount of revaluation has been done. See, this has to be checked, not entire assets. Okay, not for the entire assets. You have to check class wise. Class wise means, see, there will be different classes of assets in the entity, like furniture and fixtures, plant and machinery, computers, right? Land and building. Like this, different classes of assets will be there. You have to check whether more than 10% change has occurred class wise. So in this class is more than 10% change occurred. In this class is more than 10% change occurred. If at all class wise for any class more than 10% change has occurred, that you need to report. Not total amount. Okay, you should not add up all the classes, and if the total is more than 10%, then you report. No, that is not the understanding. You have to check class wise. Getting it? Yes. See, they would have mentioned here each class of PPE. Got it? Yes. Next, whether, see, I'll once again explain this point. If at all during the year you have revalued the PPE, then first condition is you have to make such revaluation based on the registered valuer's certificate. Got it? Next, class wise, if revaluation, after revaluation the value of asset has increased more than 10%, then you need to disclose how much amount of increase has occurred. This increase of 10% has to be seen class wise, not the total assets combined together. Clear? Yes. See, the similar kind of point we will see even in the inventory also. For inventory also, discrepancy more than 10% class wise we will say. Okay, in clause 2 we will see it. Next thing that you need to see is whether any proceedings have been initiated or pending against the company under Binomy Property Transactions Act. So if the company is holding any property as a binomy, or if company has held any property as a binomy in others name, in both the situations binomy proceedings will be initiated against the entity. So if at all any binomy proceedings under prohibition of binomy property transaction act are initiated against the company, this point has to be reported by the auditor under this first clause. Got it? So this is clause number 1, which is reporting with respect to property, plant and equipment. Yes. Yeah. Next, moving to clause number 2, which is inventory. So, of course, physical inventory verification, it has to be done, right? So, auditor needs to report whether physical verification of inventory has been conducted at reasonable intervals by whom? By management. And during such physical verification, if at all there is any discrepancy of more than 10%, the two class wise, auditor needs to report it. See, whether any discrepancy of 10% or more in aggregate of each class of inventory was noticed, whether they have been properly dealt in the books of accounts. See, what can be the classes of inventory? Tell me different classes of inventory. Raw material, right? Work in progress, finished goods. These can be different classes of inventory. So in the books of accounts, the value of raw material is 10 crore, value of work in progress is some 20 crore, value of finished goods is some 30 crore. Total will become 10, 20, 30, 60 crore. Right? Now, on physical verification, you found that value of raw material. Okay. On physical verification, you found that value of raw material is 8 crores only, and value of work in progress is some 23 crore, and value of finished goods is some 31 crore. Now you have to check whether discrepancy between books of accounts and physical inventory is 10% or more. Here you need to observe, you need to remember certain points. Discrepancy can be either plus or minus. So plus more than 10% or minus 10 more than 10%, both needs to be considered. So 10% on which you need to calculate, on value that is present in the books of accounts you need to calculate. So 10% of 10 crore is 1 crore. Correct or not? See, here also you need to see class wise. Okay, so 10 crore, 10% means it becomes 1 crore, but actual physical inventory is 8 crores. The difference is 2 crore, which is more than 10%. Correct or not? So you will report it. Next, work in progress is 20 crore. 10% of 20 crore becomes 2 crore. Actual physical verification you found it to be 23 crore. That means difference how much? 20 crore and 23 crore. 3 crore. 3 crore plus above is 2 crore minus. So both minus and plus you need to consider. Understanding. Next, finished goods. It is 30 crore. 30 crore multiplied by 10%, it becomes 3 crore. But actual difference is 30 crore, 31 crore. It is 1 crore plus or minus? Plus. Correct. So this third one, this one you will not report. Only the first two you will report. So you need to check class wise. Clear? Yeah. So that you will report under clause number 2. Next, under clause number 2 only, there is subclause B. So as per subclause B, if during the year company has been granted working capital loan of 5 crore or more, so company has been sanctioned working capital limits in excess of 5 crore, not equal to 5 crore, more than 5 crore, in excess of 5 crore, then auditor needs to report whether quarterly returns or statements filed by company with such banks are in agreement with the books of accounts or not. So what is this quarterly statements? Let me tell you quickly. See, the type of loans that the banks give to businessmen are term loan and working capital loan. So term loan is a long term loan, working capital loan is a short term loan. For term loan, security offered will be the fixed assets, but for the working capital loan, the security offered will be inventory and the debtors. So this inventory and debtors value that are there in the books of accounts, they will keep on changing on a everyday. Correct or not? So in case of working capital, there will be two concepts. One is sanctioned limit and another one is drawing power. Okay, sanctioned limit means the total amount of working capital loan that has been sanctioned. Let's say it is 10 crore. Now 10 crore sanctioned means company cannot withdraw complete 10 crore. It can withdraw maximum up to drawing power limit. Now how to calculate this drawing power limit? Drawing power limit will be calculated based on the value of inventory and debtors. See, once in every 3 months, drawing power will be calculated based on the amount of debtors available with the entity, based on the amount of inventory available with the entity. Now bank will calculate the drawing power. To calculate drawing power, you need to know how much inventory is there, how much debtors is there with the entity, and this debtors and inventory will be changing continuously every day on a day-to-day basis. So company has to submit once in every 3 months stock statement and debtors statement. To whom? To bank, saying that this much stock we are having, this much debtors we are having. Based on that working capital limit, the drawing power limit will be calculated. Now the duty of the auditor is these stock statements are submitted to the bank na, whether the the stock shown in the stock statement, debtors shown in the debtor statement, are they matching with the books of accounts, or did the entity shown more stock, more debtors for the purpose of getting more drawing power limit? This has to be verified by the auditor and has to be reported. Getting it? See, this concept of sanction limit and drawing power we will also be seeing in bank audit chapter. There in the bank audit chapter we will also learn how to calculate this drawing power. Getting it? We will reduce some margin and we will calculate. There we will see it, calculation of drawing power. I guess now you understood clause number 2, which is inventory. Yes. Next, moving to clause number 3, investments, loans, guarantee and security given by the company. Okay, given by company. Investments made by the company, loans given by the company, guarantee given by the company, security given by the company. Not loans taken by the company. Taken by the company will be dealt in clause number 9. Clause 3, clause 4 deals with loans given by the company. So with respect to this, what points auditor needs to report? See, whether during the year company has provided any loans, guarantee or security to any other entity. If so, indicate the following: aggregate amount during the year. So during this year, how much total amount of loan or guarantee given by the company, and how much is outstanding? There can be a possibility that during the year company has given 100 crore loan, but during the year only 50 crore has been repaid, so outstanding will be only 50 crores, balance 50 crores, right? So you should also report as on the balance sheet date how much is the outstanding amount with respect to such loans or advances and guarantees or securities to subsidiary, joint venture, associate and others. This is the first point you will report. Next, whether investments made, guarantees provided, security given or not prejudicial to the interest of the entity. So the terms and conditions of investment guarantee should not cause loss to the interest of the entity. Prejudicial means against, creating loss to the entity. Got it? So the terms and conditions of those loans, advances, investments, guarantees should not be prejudicial to the interest of the entity. Got it? Yes. Next, in respect of loans and advances, whether schedule of repayment of principal and payment of interest has been stipulated and whether the repayment on receipts are regular. See, when you take a loan from the bank, there will be schedule of repayment, on which date how much amount you have to pay, like this for entire tenure. Schedule of repayment will be there. Similarly, if the company has given loan to any third party, is there such a schedule of repayment available, and are the receipts of repayment regular? This has to be reported by the auditor. Next, state the total amount overdue for more than 90 days and whether reasonable steps taken by the company to recover the amount. If at all any loan amount given by the company is not repaid by that third party for more than 90 days, auditor need to report that amount, and whether company has taken reasonable steps to recover that amount. These things has to be reported by the auditor. Clear? Yes. Next, whether loans or advance which has fallen due during the year has been renewed or extended or fresh loan granted to settle the overdues of existing loans given to the same parties. What is this? This is called as evergreening of loans. So company has, see, in the first year company has given a loan of 2 crore rupees to Mr. A, saying that Mr. A will repay it in the second year. Now second year has come. In the second year, what happened is company again given another 2 crore rupees to Mr. A, so that Mr. A will repay the old loan and the second loan is continuing. Now they told in the second year that this new loan will be repaid in the third year. Again third year has occurred. Third year also what the company has done, it has again given a fresh loan of 2 crore rupees to repay the old loan, and this 2 crore is as it is there. So this is known as evergreening of loan. First you will give one loan, to repay that loan another loan you will give, and to repay that loan another loan you will give. This will continue forever. So whether such a scenario is taking place in the company, you need to report. Okay, yes. If yes, if at all such a scenario is taking place, you need to report the following things: aggregate amount of such dues renewed or extended or settled by fresh loans. So how much of the fresh loans which are of this type you have granted, and percentage of aggregate to the total loans. You would have given normal loans also, right? Let's say during the year you have given total loans of 100 crore. Of these 100 crore, how much percentage is of that nature? I told you, evergreening of loans. How much percentage constitutes evergreening of loans? Got it? Yes. Next, auditor should also report whether the company has granted any loans or advances repayable on demand or without specifying any terms or period of repayment. If so, specify the aggregate amount, percentage thereof to the total loans granted, aggregate amount of loans granted to promoters and related parties. So, what is meant by uh, loans repayable on demand? That means whenever company asks the third party, the borrower has to repay the amount. There is no fixed tenure for that loan. If the company asks now, he has to repay. That is known as loan repayable on demand. Whenever you demand, he has to repay. So if the company has given such loans, auditor needs to report the following: total amount of such loans given, percentage thereof of the total loans granted. So in the year, total loans granted are 100 crores. Of this 100 crores, how much percentage is of demand loans? You need to report. And aggregate amount of loans granted to promoter and related party. If at all you have given any loans to promoters and the related party, you should also disclose or the report aggregate amount of such loan given to promoters and the related parties. Got it? Yes. So that is clause number 3, loans, advances, investments, guarantees given by the company. Next, clause number 4 is also with respect to loans given by the company. See, clause number 4 is simple. There is section number 185, 186 in the Companies Act. Whenever company gives any loan, it needs to comply with the requirements of 185 and 186. So auditor needs to see for whatever the loan, investment, guarantee and the security given by the company, does the provisions of 185 and 186 are complied or not. See, what is there in the 185, 186, you need not read it. Understanding that is not there in the syllabus. Yes. Next, clause 5, deposits. Deposits means deposits taken by the company. Or these deposits liability to the company? Yes, of course, deposits has to be again repaid by the company to the deposit holders. So these are the liabilities. With respect to deposits accepted by the company, it needs to comply with the directions given by RBI. And in the Companies Act, there are provisions, section number 73 to 76. So section 73 to 76, these provisions has to be complied, and also relevant provisions of CLB and the NCLT. If the CLB means Company Law Board or National Company Law Tribunal, if at all they have passed any order against the company with respect to deposits, the requirements of that order should also be complied with. So these are the 3 requirements with respect to deposits. What are they? The company should comply with the requirements of RBI directives, section 73 to 76 of Companies Act, and the requirements of order passed by CLB or NCLT. So whether these are complied or not, auditor needs to report under clause number 5. Next, moving to clause number 6. See, clause number 6 is also simple, which speaks about cost records. So whether maintenance of cost records has been specified by central government under section 148 subsection 1. If you see, central government has prescribed certain types of companies to mandatorily maintain cost records. If at all the company for which the auditor is auditing, the cost records are prescribed, whether it has properly maintained the cost records or not, that you need to report. See, you need to observe, clause 6 is asking only about cost records, not cost audit. Auditor need not report about the cost audit, just cost records. Are they prescribed? If prescribed, whether the company is maintaining them, that's it. Next, clause number 7. Clause number 7, it is with respect to statutory dues. So, under subclause A, statutory dues means PF, ESI, income tax, all the amounts that has to be paid to the government are known as statutory dues. Now, auditor needs to report whether all the undisputed statutory dues are regularly paid to the government or not. If at all, company is not paying the statutory dues regularly, then auditor needs to report how much amount is outstanding as on balance sheet date for more than 6 months. Understanding? So, whether company is regularly paying the statutory dues, if not, as on balance sheet date on 31st March, how much amount of statutory due is outstanding for more than 6 months, that you need to report. Clear? With respect to undisputed statutory due, if there is any dispute going on with respect to statutory due, then of course company will not pay it because of the dispute, correct or not? So with respect to disputed statutory due, you will report in subclause B. So whether statutory dues which have not been deposited on account of any dispute, then amounts involved and the forum where the dispute is pending shall be disclosed. So whether the dispute is pending with the appellate authority or the CBDT, understanding. So with whom the dispute is going on and how much amount is involved in the dispute. These things you need to report if the statutory due is not paid because of a dispute. Clear? Yes. Next, clause number 8, which is disclosure of undisclosed income. See, generally what happens is, in your income tax returns that the company files, it needs to disclose all its income that it has earned during the year, correct or not? But some companies, in order to avoid the taxes, they will not disclose some of the income. Let's say for example, for some 3 years back, for let's say for financial year 2024-25, company has not disclosed some portion of income, only some portion it has disclosed and paid the tax. Now after 3 years, let's say some 2027 and 28, income tax department will come up with a scheme known as disclosure of undisclosed income scheme. So the purpose of this disclosure of undisclosed income scheme is that, see, companies or any individual, if at all in the past have you not disclosed any of the income and not paid the tax, now you disclose it under this scheme, I will charge you less penalty. Like this, income tax department will give a offer. That is, if in that offer any of the company has disclosed the income that is not disclosed in the past, then you have disclosed it in the scheme that the income tax department has given. What about books of accounts? In the books of accounts also you should reflect this undisclosed income, correct or not? So auditor needs to report if in case during the year company has disclosed any of the income under this disclosure of undisclosed income scheme given by the government, whether the same has been properly accounted for in the books of accounts or not. This has to be reported by the auditor under clause number 8. Clear? Yes. Next, moving to clause number 9, which deals with loans, advances raised by the company. Okay, clause 9 deals with loans and advances taken by the company. So with respect to loans and advances taken by the company, what points? Let us see. Whether company has defaulted in repayment of loans or other borrowings or interest thereon to any lender if yes period and amount of default. So the loans that you have taken, did the company properly repay them, or is there any default? If at all there is any default, the auditor needs to report amount involved in the default and the period for which, okay, for how much period the company is not paying that amount. These things needs to be reported by the auditor. Next, whether company is declared as willful defaulter like Vijay Mallya, Nirav Modi. If yes, auditor needs to report it here in clause number 9. Willful defaulter means wantedly company is not paying the loan. Like this, if any bank has declared the company as willful defaulter, auditor will report it in the clause number 9. Next, whether term loans were applied for the purposes for which the loan has actually been taken, or is there a diversion of funds? If at all there is a diversion of funds, you need to report it here. Next, funds which are raised on short term purposes like working capital loan, OD facility, these should be used for short term purposes only. You should not use it for long term purposes. Okay, so funds which are raised for short term purposes should be used only for short term purposes. You should not use it for long term purposes. So if at all there is any diversion of short term loans to long term purposes, you need to report it here. Next, whether company has taken any funds from any entity or person to meet the obligations of its subsidiaries, associates, or JVs. If so, details thereof with nature of transactions and the amount in each case. So, did the company take any loan for the purpose of meeting the obligations of its subsidiary, associate, joint venture? If at all company has taken any such loans, auditor needs to report amount involved in each of that loan taken by the company. Got it? Yes, simple. Company taken the loan and utilized that loan to repay the obligations of subsidiaries, associates, and joint ventures. Understand? So on behalf of its components, company taken the loan. If this is the situation, auditor needs to report. Next, whether company has raised loans during the year on pledge of securities held in subsidiaries, joint ventures. So by keeping the shares of subsidiaries, joint ventures as a security, did the company taken any loan? If yes, again you need to report. See, JVs or associates. If so, give the details thereof, and also report if company has defaulted in repayment of such loans. Clear? This is clause number 9. Next, moving to clause number 10, which is very simple: end use of funds. So, if company has raised the funds through IPO or FPO, in the prospectus, company would have mentioned that I will use these funds for so and so purpose. So, apart from that purpose, if the company has used that fund for any other purpose, auditor will report here. So, diversion of funds raised from IPO and FPO is subclause A. Similarly, company can also raise funds through private placement. Private placement means IPO means you will give shares to the public. Private placement means you will give shares to some selected persons and raise money from that persons. So even in this private placement or the preferential allotment also, you will mention that I will use this fund for so and so purpose. So apart from that purpose, if you use that fund for any other purpose, auditor has to report it here. Another requirement here is there is section number 42 and section number 62 of the Companies Act, which deals with or which provides certain conditions with respect to preferential allotment and private placement. Whether the conditions prescribed in 42 and 62 of Companies Act has been complied or not. This will also be reported by the auditor in clause number 10. Clear? Yes, sir. Clause 11, which is about fraud. So this fraud reporting, it is there in two areas. So first of all, fraud reporting, it is there in clause 11 of CARO, right? Clause 11 of CARO, and also section 143 subsection 12 of Companies Act. Now as per clause 11 of CARO, any fraud on the company or by the company will have to be reported by auditor. But as per clause, as per section 143 subsection 12, only frauds on the company, on the company by employees or officers of company, only these things will be reported. Understanding? Here again, in case of section 143 subsection 12, if amount involved in the fraud is less than 1 crore rupees, it will be intimated to the audit committee. If audit committee is not there, to the board of directors it will be intimated. But if amount involved is more than 1 crore, then it will be intimated to central government. In form ADT4 you will intimate it. Understanding? So this is the fraud reporting under clause 11 of CARO and also section 143 subsection 12 of Companies Act 2013. Now we will see as per clause 11. So here you need to report whether any fraud, you need to observe this, by the company or any fraud on the company has been noticed or reported during the year, if yes, nature and amount involved. Whereas if you go and read 143 subsection 12, it says only fraud on the company by employees or officers of the company. Clear? Yes. Next, there is a linking between 143 subsection 12 and CARO also. So as per section 143 subsection 12, if amount involved in fraud is more than 1 crore, you will file form ADT4, you will intimate to central government. So what CARO says is that if at all you have intimated to central government any frauds under 143 subsection 12, you mention it here also. See, whether any report under section 143 subsection 12 has been filed by the auditors in form ADT4 with central government. If yes, you show it here. You say that yes, we have filed form ADT4 with central government for so and so purpose. Got it? Next, auditor should also report whether he has considered whistleblower complaints, if any, received during the year by the company. What is meant by whistleblower complaint? See, whistleblower is a mechanism that is established in the organization for purpose of communicating any frauds in the organization. Let's say for example, Mr. A is employee of the organization. He is committing some fraud. Now the chance that Mr. A is committing fraud, it will be most probably known to his colleagues, right? His colleagues like Mr. B, Mr. C. These people will be the first people who will come to know that Mr. A is doing fraud, correct or not. Now, company should have a mechanism known as whistleblower mechanism, wherein by using this mechanism these colleagues can communicate to whom? To top management that Mr. A is committing so and so fraud. Okay, this mechanism is known as whistleblower mechanism. Got it? Yes. See, so the complaints received under this whistleblower mechanism should also be considered by the auditor. That is clause number 11. Next, moving to clause number 12. Nidhi companies. What is meant by Nidhi companies? See, the main objective of Nidhi companies, they will collect funds from the members and give loans to the members. So with respect to Nidhi companies, you have to check three things. First one, whether Nidhi company is maintaining net own funds to deposit ratio of 1:20. That means for every 1 rupee of own fund of the Nidhi company, maximum deposit it can accept is only 20 rupees. More than 20 rupees it cannot accept. Understanding? That means for every 1 rupee of own fund that the Nidhi company is having, maximum 20 rupees of deposits it can accept. That means if it is having some 2 crore worth of own fund. Maximum amount of deposits it can accept is 2 crore multiplied by 20. How much it becomes? 40 crore, right? So maximum is a 40 crore deposit it can accept. This is maintaining net own fund to deposit ratio of 1 is to 20. So whether this is 1 is to 20 or more than 1 is to 20, auditor needs to report this. Next, whether Nidhi is maintaining 10% unencumbered term deposits as specified in Nidhi rules. Unencumbered term deposits means, let's say Nidhi has accepted total term deposits of 100 crore rupees. Okay, now these term deposits which the Nidhi has accepted, it will give as a loan, correct or not? It should not give entire 100 crores as loan. It can give only 90 crores as loan. Okay, the remaining 10%, okay, 10% of deposits accepted, how much it becomes? 10 crore. So minimum 10 crore should be kept as freely available whenever it wanted to use. That is known as unencumbered. So at least 10% of term deposits should be kept as unencumbered. Understanding, should be kept freely available whenever it wanted it can use. Unencumbered means it is available for free, you can use it whenever you wanted. That is known as unencumbered. Got it? So whether unencumbered deposits of 10% is maintained or not, you have to report. Next, whether there has been any default in payment of interest or deposits or repayment. So Nidhi will accept deposits. On that deposits, it has to pay interest. So whether there is any default in repayment of interest or whether there is any default in repayment of actual principal, if yes, auditor will report it here. That is clause number 12. Got it? Yes. Next, clause number 13. Clause number 13 is also simple. So if the company enters into any related party transactions, it needs to comply with section 177 and 188 of Companies Act. See, section 177 and 188 contains certain requirements, certain resolutions that has to be passed. So the actual content of section 177, 188, you need not know. You just remember that if the company enters into related party transaction, auditor need to report whether section 177 and 188 has been complied or not. That is clause number 13, related party transactions. Next, clause number 14, which deals with internal audit. So auditor needs to report whether company has an internal audit system incommensurate with the size and nature of its business. So let's say the size of the entity is some 1,000 crore worth of business, and in the internal audit department there is only one person. Is the size of internal audit department commensurate with the total size of the company? No, at least some number of members should be there for that much size of the entity, correct or not? So auditor needs to report this, whether the internal audit department size is incommensurate with the size of the entity. Next, now, by the time statutory auditor comes to audit the entity, already internal audit would have been done. 4 internal audit reports will be available. The statutory auditor should consider those internal audit reports. So, statutory auditor under clause 14, he need to report whether he has considered the internal audit reports or not. See, whether the reports of internal auditor for the period under audit were considered by the statutory auditor. Got it? Yes, that is clause number 14. Next, moving to clause number 15, which is non-cash transactions. What is meant by non-cash transaction? Any transaction in which no cash is involved. That means barter, you can say, simple exchange of goods, right? So there is a land, company is having 1 acre of land, director is having 1 acre of land. So director is giving his 1 acre, company is giving its 1 acre. No cash has exchanged, just the lands have exchanged. This is a non-cash transaction. Now for these non-cash transactions to take place, there is section 192. The requirement of section 192 of the Companies Act has to be complied. So in case any non-cash transaction has taken place, whether the requirement of Companies Act has been complied or not, auditor needs to report. Got it? Generally, for non-cash transactions, approval of shareholders is required. That will be said in section number 192. Clear? Yes. Next, clause number 16. So, clause number 16 is with respect to NBFCs. So, with respect to NBFCs, the points that you need to report. Generally, in order to do the business of NBFC, you have to obtain certificate of registration from RBI. Without obtaining certificate of registration, you cannot do the business of NBFC. So, you need to report whether company has obtained registration under section 45IA of RBI Act, or is the company doing whether the company has conducted any non-banking financial or housing finance activities without a valid certificate of registration. If yes, you will report it here. Got it? Yes. Next, you should also report whether company is a core investment company. Core investment company means there is a definition for it. Minimum 90% of its total assets should be in the form of investments in its group companies, and minimum 60% of such investments should be in the form of investments and equity share capital of its group companies. Understanding? Then you will call it as a core investment company. Core investment company means its main purpose is to do the investments in the group companies. Got it? So whether company is a core investment company, if yes, okay, as defined by RBI. If so, whether it continues to fulfill the criteria of CIC. I told you, in order to continue as a CIC, you need to satisfy certain conditions, 90%, 60%, whether the conditions are being satisfied. And in case company is an exempted unregistered CIC, whether it continues to fulfill such criteria. So you need to report whether such criteria of 90%, 60% are being followed or not, okay, fulfilled or not. Next, now, if the group is having more than one CIC, you need to report how many CICs are there in the group. Let's say Reliance Industries. In the Reliance Industries, there will be core investment company, okay, which will invest only in the group companies of the Reliance Industries. Now, if this group, Reliance Industries group, is having more than one core investment companies, then auditor needs to report how many core investment companies are there in your group. Got it? So, where the group has more than one core investment company as part of the group, if yes, indicate the number of core investment companies which are part of the group. That is clause number 16. Next, moving to clause number 17, which is about cash losses. Cash loss means, see, for the profit or the loss, as per the profit and loss statement, if you make the adjustment related to non-cash items like depreciation is a non-cash item, correct or not, and some incomes which are accrued but not yet received are also non-cash items. So for the profit that you have arrived, if you make these non-cash item adjustments, if you are arriving at a cash loss, then you need to report it. Let's say, for example, in the profit and loss statement, company has shown profit of 20 crore. So, and in the income side, there is a particular income which is recognized on accrual basis, but still that income is not received. Let's say the value, the amount of such income is some 25 crore, which is a non-cash item. Now in this profit, this 25 crore also included. So if you reduce this non-cash item from the profit, you will go into 5 crore loss. So if company is making any such cash losses, cash loss, how to calculate cash loss? By adjusting the non-cash items. Understanding? In such a situation, see, cash loss for the current year, cash loss for the previous year, both you have to report under clause number 17. Got it? That is cash losses. Next, clause number 18, which is about resignation of auditors. So whether there has been any resignation of the statutory auditors during the year, if so, whether the auditor has taken into considerations issues, objections, concerns raised by the outgoing auditor, Now, during the year, you have been newly appointed as auditor because the existing auditor has resigned. Now, since the existing auditor has resigned, the newly appointed auditor should consider the reasons, objections raised by the resigning auditor. So, have you considered those objections and issues raised by the resigning auditor? If yes, you will report it here. Okay, have you considered his objections or not has to be reported in clause number 18. Next, moving to clause number 19, which is very simple. So, auditor, you have done this much audit now, you have verified these many clauses now. Based on your audit, do you believe that company will be able to continue as a going concern or not? You have to report it in clause number 19. Okay. Next, clause number 20, which is unspent CSR. CSR means corporate social responsibility, right? So, in case of certain listed companies and in case of certain specified companies, 2% 2% of profit has to be spent on corporate social responsibility purposes, CSR, that means giving back to the society. Now, the time limit is within end of the financial year, within 6 months, you have to spend this amount. If at all you fail to spend, then from the end of financial year, within the 6 months, you have to deposit unspent CSR in a specific fund by name IEPF. IEPF is a investor education and protection fund that is maintained by central government. So the requirement is every company means certain specified companies, listed companies, and certain criteria of companies are there. For those companies, every year of the profits that they make, 2% has to be spent on corporate social responsibility like planting trees and some society welfare activities. If company fails to spend the amount, that becomes unspent CSR. Now this unspent CSR has to be deposited in investor education and protection fund of government within 6 months from the end of the financial year. Whether such a deposit has been made properly or not will be reported by auditor here in this particular clause. Next, in some situations what happens is, let's say the entity wanted to construct a school as part of its CSR activity. Now construction of school, it will not take place within 6 months or 1 year. It will take some 2 years or 3 years for construction, correct or not? So you will call it as ongoing CSR project because it will take more time to get complete. Now you are spending the amount on ongoing CSR project. In such a situation, you need not deposit this fund in IEPF account, but you keep this fund in a separate bank account of your own and utilize this fund for that ongoing CSR project. So, whether any amount remaining unspent under section 135 subsection 5 pursuant to any ongoing project means the project completion will take some long time. In such a situation, has been transferred to special account in compliance with section 135 subsection 6. Got it? Yes. Next, final clause, clause number 21. I told you clause number 21 is applicable only to the audit of consolidated financial statements. Why it is applicable only to the only to the consolidated financial statements? Let me tell you. So, in the consolidated financial statements, you will include the financial statements of subsidiary, financial statements of associate, financial statements of joint venture, correct? Now there will be separate CARO report for subsidiary, right? There will be separate CARO report for subsidiary. There will also be separate CARO report for associate, the individual auditors they will have audited. and given CARO report. For joint venture also there would have been some separate CARO report, right? In each of these CARO, the reporting on 20 clauses will be done. All the 20 clauses which we have discussed, the 21st clause will not be done because these are not consolidated financial statements, right? So reporting on all the 20 clauses will be done, right? Now the financials of all these will be included in the consolidated financial statements, and auditor of consolidated financial statements, he has to give CARO specifying only clause 21. Okay, CARO of consolidated financial statements consists of only clause 21. Okay, clause 21, only clause 21 will be there. Now what has to be reported in clause 21? Let me tell you. Now in the subsidiaries CARO, if any clause has been reported negatively, if there are any remarks with respect to any clause, let's say with respect to subsidiary CARO, clause 7 has been reported negatively, there are remarks in clause 7. Now the clause 7 you will copy as it is from subsidiaries CARO and you will paste it here in the CARO of consolidated financial statement. Similarly, if in the associates CARO, let's say for example clause 9 has been reported negatively. Reported negatively means certain qualificatory remarks, certain points have been mentioned there, so that you will copy paste into CARO of consolidated financial statements in clause 21, that is clause 21. Understanding? So all the negative remarks of CAROs of components will be copy pasted into CARO of uh, CARO of consolidated financial statements, which is nothing but clause 21. Now we will read clause 21. You will be able to easily understand it. See, whether there have been any qualifications or adverse remarks by the respective auditors in CARO reports of the companies included in the CFS. Which companies will be included in the CFS? The subsidiaries, associates, joint ventures will be included in the CFS. If auditors of those companies have given any qualificatory or adverse remarks, if yes, then indicate the details of companies and the paragraph numbers of CARO report containing the qualifications or adverse remarks. Got it? This is clause number 21. By this, the complete discussion of CARO is completed. Now, so if you like the class, you know what to do. What will you do? You will comment the best lecture. Got it? Yes. So now let me open chapter number 7. So yes, I have opened chapter number 7. If you see chapter number 7, it is completely about audit evidence. So the name of the chapter number 7 is also audit evidence. So here we are going to discuss around 6 standards. So if you see, not even 6 standards, 7 standards we are going to cover. If you see till now, what are all the standards that we have discussed? Yes, say 200 is done, 210 is done, right, from 200 series, and next from 300 series almost 300 is done, 315 is done, right, 320 is done, 330 is done, and 400 series 450 is done, 408 is not there for our syllabus, and 500 series we haven't discussed yet. Now we will start 500 series. 600 series also not discussed yet. 700 series completely done. All the 5 standards of 700 series is also done, right? So almost all the standards are getting completed, right? Now we will discuss the audit evidence. Here we will be covering 6 standards from 500 series and 1 standard which is SA 230. Okay, if you see SA 500, which is audit evidence. So with respect to basic concepts of audit evidence, we will be covering in SA 500, like what are the characteristics of audit evidence, and what are certain generalizations related to audit evidence. Like this, the basic concepts related to audit evidence we will be seeing in SA 500. Next we have SA 501. See, SA 501 also deals with audit evidence only, but with respect to certain three selected items. Okay, in case of those three selected items, which are nothing but inventory, litigations and claim, and presentation and disclosure of these segment information. So with respect to these three things, how to obtain audit evidence, we will be exclusively dealing in SA 501. And next we have SA 505, which is very familiar to you, nothing but external confirmation. So during the audit, lot of times you will use external confirmation. So how to perform this procedure with respect to this aspect, we will be covering in SA 505. Next you have SA 510, which is verifying or obtaining audit evidence about opening balances in case of initial audit engagement. So what is meant by initial audit engagement? Is the auditor having any responsibility with respect to opening balances? These things we will be seeing. So if you see SA 510, it will be somewhat similar to SA 710. So in SA 710, we have seen about comparative information. So comparative information belongs to previous year. Previous year figures you will give in the current year as comparative information. Auditor will verify that comparative information. Here also, in case of SA 510, opening balances of current year are nothing but closing balances of previous year, correct or not? So the procedures that you have performed in SA 710 will be somewhat similar. I don't say exactly similar, some similar kind of procedures we will be seeing in SA 510 also. Okay. Next, SA 520, analytical procedure. So how to obtain audit evidence by using analytical procedures, and in which situations you will use analytical procedure? First of all, what is meant by analytical procedure? All these aspects we will be covering. Next, SA 530, audit sampling. So with respect to audit sampling, we will see in SA 530. I will explain while discussing SA 530. And finally SA 230, which is audit documentation. So whatever the evidences that you have obtained in all these standards or various other standards, those evidences needs to be properly documented as per the requirement of SA 230, right? So we will be covering these standards in this particular chapter. So let us start with SA 500, which is audit evidence. Now, what is the objective of auditor as per this SA 500? I told you each and every standard will be having its own objective. So as per SA 500, objective of auditor is to design and perform audit procedures so that he will be able to obtain sufficient and appropriate audit evidence. Now, what is meant by sufficiency, what is meant by appropriateness, we will see it. Okay, these are the two characteristics of the audit evidence we will see in this particular standard only. Okay, next, you can use as audit evidence either accounting records means the books of accounts, the financial statements, the vouchers, right, bank statements, all these comes under accounting records. So you can use accounting records as audit evidence, or other information also you can use as audit evidence. Now what is meant by other information, sir? So information like minutes book, which you can use as a evidence, but minutes book, it is not part of accounting records, correct or not? External confirmation, all these things which are other information also can be used by you as audit evidence. So you can use audit evidence. See, information used by auditor in arriving at conclusions on which auditor's opinion is based, nothing but audit evidence is based, and it includes both accounting records as well as the other information. Got it? Yes. Next, types of audit evidences. See, the types of audit evidence, you can classify them firstly based upon the nature of evidence. So, on the basis of nature of evidence, audit evidence can be either oral. Oral means through words you will just communicate, or visual. So, through visual also audit evidence can be there. And finally, documentation. So, these are the three categories of evidence based on the nature. Okay, visual, oral, documentary. In case of audit, 99.9% of the cases auditor should try to get a documentary evidence. So because documentary evidence is more reliable when compared to the other two types of evidences. Next, depending upon the source from which that evidence is generated, you can classify the evidence into either external evidence or internal evidence. External evidence means evidence that is generated outside of the entity. Examples: purchase invoice. Entity has purchased certain goods. For that, you will get a invoice, purchase invoice. Now tell me, who will generate that purchase invoice? Seller of the goods will generate. Seller is a outside party. Correct or not? That is the best example for external evidence. Internal evidence, best example is sales invoice, which will be generated within the organization by the entity itself. Now tell me, of these two things, which one is more reliable? Of course, external evidence is more reliable because it is generated externally, right? Next, audit procedures you already know. RAP, FAP. FAP is again of TOC and substantive procedure. This we have discussed almost three times, right? In SA 315 we discussed, SA 330 we discussed, again it has repeated here also, right? Substantive procedures, they can be again bifurcated into test of details, substantive analytical procedure. Test of details again bifurcated into test of balances, test of transactions, right? This we have already discussed lot of times in this marathon session only, right? Next, examples of procedures to obtain audit evidence. So some of the examples of audit procedures which you can perform to obtain audit evidence. Let us see. Firstly, inspection. See, in the examination, they can ask you question on this. How they will ask? They will give certain scenarios, certain 5 to 6 scenarios they will give, and they will ask in each of these scenario which procedure is being performed. If you see these type of questions, they are there even in our question bank also. Okay, so by solving that question bank, you will get a idea of types of questions that the institute can ask. So inspection means verifying. You can inspect two things. You can inspect inventory. You can also inspect documents of the organization. These two things can be inspected. Understanding? In the questions also they will ask this only. Okay, auditor has verified detailedly the documents or records of the organization. What procedure is this? They will ask. You have to specify as inspection. Okay, inspection will be done with respect to documents, records, and inventory. Getting it? Yes. Next, observation. Observation means just sitting and observing the procedure that the management or other person is performing is observation procedure. Next, external confirmation we will see in SA 505. Generally, to obtain audit evidence with respect to the balances like debtors, creditors, bank balances, for all these things you will use external confirmation, right? Next, recalculation. So management has already performed a particular calculation, like let's say calculation of depreciation. Now auditor again recalculating that depreciation to verify whether the calculation done by the management is correct or not. This is also best example for recalculation. Next, reperformance means management has already performed a particular procedure, like preparation of bank reconciliation statement is a procedure that the management has performed. Auditor is again reperforming that BRS. This is best example for reperformance procedure, right? So you should not confuse. In the there is this particular question, Management has prepared the BRS. Auditor is again preparing that PRS. What procedure is this? You should say it as re-performance. Students will confuse between recalculation and re-performance. You should not confuse. Okay. Next, analytical procedures. So analytical procedures we will see in essay. There is some construction going on, so these sounds are coming. Okay, analytical procedures we will see in essay 520. Okay, what is meant by analytical procedure we will see in essay 520. Next, inquiry. Inquiry means asking questions. So you will ask questions and you will get answers to that particular question. So those answers are nothing but your evidences. This is also one of the audit procedure that you can perform. So these are the examples of certain audit procedures that the auditor can perform to obtain audit evidence. Next, inconsistency in or doubts over reliability of audit evidence. So auditor is having doubt over the reliability of audit evidence. So is the audit evidence that I have obtained, is it correct or not? He is having a doubt. And next, there is a inconsistency. Means inconsistency means, what is meant by inconsistency? Let's say for example debtors. With respect to debtors, the first evidence that you will see is the sales that you have made to the debtor, the sale invoice. In the sale invoice, amount is being shown as 20,000. This is a credit sale. Now for debtors you will also send external confirmation. When you send the external confirmation, debtor told that, see auditor, I have to pay 15,000 only, not 20,000. Now if you see, there is a inconsistency between two evidences relating to the same aspect. So in case there is any inconsistency, you need to determine what modifications or additions to audit procedures are necessary to resolve the matter and consider the effect of the matter, if any, on other aspects of the audit. So what additional procedures you have to perform to resolve this inconsistency? You need to determine that additional procedures to resolve the inconsistency. Got it? Yes. Next, characteristics of audit evidence. I told you there are two characteristics of audit evidence. First one is sufficiency. Second one is appropriateness. Now, what is meant by sufficiency? Sufficiency refers to the quantity, right? So, if someone offers you food, if you went to someone's house, they will give food and they will ask whether the food is sufficient. That means whether the quantity that is kept to you, is it sufficient? So quantity is related to, sorry, sufficiency is related to quantity. If the same people asks you how is the food, that is related to quality. Okay, appropriateness means quality. Understanding? So sufficiency is related to quantitative aspects of evidence, whereas the appropriateness is related to qualitative aspect. See, sufficiency is a quantitative aspect affected by ROMM, risk of material. So some of the quantitative aspects of audit evidence. So how much audit evidence you have to obtain, that depends on the ROMM. If ROMM is high, you will obtain more audit evidence, correct or not? So sufficiency will be affected by ROMM. Materiality, if the item is very much material, then you will obtain more audit evidence, correct? Next, size and characteristics. So if the size of the organization is very huge, then you will obtain more audit evidence, correct or not? And characteristics of the population. So these things will impact the sufficiency, quantity of the audit evidence. Next, going to appropriateness. Appropriateness refers to quality of the audit evidence. See, this quality will be again impacted by two more things. First one is reliability and the second one is relevance. Reliability means whether you can believe that audit evidence or not is known as reliability. There are certain generalizations with respect to reliability. Understanding what are those generalizations related to reliability, we will see. So firstly, External evidence is more reliable than internal evidence. This point we have discussed. Evidence that is obtained from outside of the organization, you can believe more on that than the evidence that is generated within the organization, because the evidence that is generated within the organization, that is in the hands of management, they can alter it, correct or not. Next, evidence that is generated within the organization is also more reliable if internal controls are working effectively. See, internal evidence is also reliable if controls are effective. Next, the evidence that is obtained directly by the auditor is more reliable than the evidence that is obtained through the management or through any third party. Understand? So if you obtain the evidence first hand through your hands directly, it is a more reliable. Next, documentary form is more reliable. I told you this already. Than visual and oral, documentary evidence is more reliable, and also evidence in original documents is more reliable than photocopies. Right. Next, using the work of management's expert. So, auditor, can he use the work of management expert? Yes, he can use. For example, in the entity there is a provision for gratuity. Now, provision for gratuity, it involves various calculations, various assumptions about how many employees will retire, how many employees will stay for more than 5 years. If they stay for more than 5 years, how much amount we have to pay, like this. Lot of assumptions and calculations will be involved in case of provision for gratuity. Now management, they cannot calculate this provision for gratuity, they have to depend on some expert who can help the management in making these calculations. So management has hired a expert for calculating provision for gratuity. Now auditor, during the audit, he has to verify that calculations, verify that assumptions correct or not. Now auditor, if he wants, he can appoint his own auditor's expert, or he can also rely on the same management expert that the management has already appointed. Now if auditor decides to use the management experts instead of using auditor's expert, then what aspects need to be considered by the auditor before deciding whether to use the work of management expert or not? Let us see that. See, before deciding to use the work of management expert, consider the following things. So competence, capability and objectivity of expert. Competence means what is the capability, what is the experience of that expert, can he make the calculations properly or not, that you will consider. Now how can you know about the competency of that expert? By going through certain aspects like personal experience. If already in the past you have already used the work of that expert for some assignment, then you already know the competence, capability of that expert. Next, discussion with the expert, you can once just discuss with the expert. So once you speak with him for 15 minutes or half an hour, you can get to know about his knowledge, correct or not. So discussions. Next, discussion with others who are familiar with the expert's work. So there might be some of your friends, there might be some of your friends who are also chartered accountants, who have used the work of that expert in the past. Then by discussing with them how did that expert has helped you, you can get to know about that expert's knowledge, capability, right? Next, knowledge of expert's qualification. So just like chartered accountant, if he is also having any qualifications like actuary is a professional, right? So if he is having any such specific calculations, then also you can rely on his work, then also you will get to know about his knowledge, capacity, capability, right? Next, published papers or books. So when will you write a book? If your knowledge overflows, then you will write a book, right? So if he has wrote any such books or documents or any papers, you can go through those articles, books, to get to know about his knowledge, correct or not. So By going through all these things, you will get to know about the knowledge, capability, capacity of the expert. Next, now by doing all these things, you got an idea whether that expert is having knowledge, whether he is having capability to do the work or not. Now you will see, you will understand the work that the expert has performed. So first of all, you have understood the expert. Now you will understand the work that the expert has performed. So for this purpose, what you will do, you will understand relevant field of expertise. So if you see, for example, in case of doctors, there will be lot of specialists. There will be one doctor for heart, there will be one doctor for eye, like this. Are there any specializations in the field of expert? If yes, in which thing he is specialized, you need to understand it. Next, whether experts field has areas of specialty. Next, professional or other standards apply. So just like for chartered accountants, we are having auditing standards, accounting standards, just like that, for the work of the expert, are there any standards that are applicable? If there are some standards that are applicable to the expert, and did he follow that standards? If he follows that standards, of course auditor can place more reliance on his work, right? Next, assumptions and methods used by the expert. See, if the work of expert involves any assumptions or any methods, then you have to understand what assumptions expert has used, what methods the expert has used, and those assumptions and those methods, are they reasonable or not? This you will see. Okay, so this is how you will obtain understanding of the expert's work. Okay, expert is having competence, capability, and he has also done his work properly. Now you will see whether that work is appropriate for me. See, just because of the reason that he is having proper knowledge and he has done the work properly, I will not use it if I have no use of it. Correct or not? Only if that work is relevant for me, I will use. Otherwise, why will I use? Correct. So you will see that evaluate appropriateness of the expert's work. Clear? Yes. Next, the concept of audit trail. Sir, what is meant by audit trail, sir? See, audit trail is a feature that will be there in the accounting software. Okay, audit trail is a feature that will be present in the accounting software that the organization have. Now what will this feature will do, sir? It will maintain a record, it will maintain a log of who have passed entries in the books of accounts, that is in the software, and at what time and at what date they have passed the entries, and who have altered the entries, and at what time and at what date they have altered the entries. All this record will be kept by this feature, and we will call that feature as audit trail. Now tell me, is this audit trail feature useful for the auditor? Of course it is useful. How? Now auditor, he goes to the entity at the end of the year to do the audit. Once, if he gets any doubt about any transaction, he will go to the audit trial feature and he will check who has passed this entry, when it was passed, and he will ask that doubt to that person. Correct or not? Next, he will, by going through the audit trial, it will have record of all the changes that are made to the particular transaction. Correct or not? Now if any particular transaction has been changed a lot of times, then there is a possibility that there can be some adjustment or there can be some fraud that might have taken place in the transaction. So auditor will focus more on the transactions. Correct or not? Yes. So for all these purposes, audit trial will be useful for the auditor. He can basically track the history of the transaction with the help of this audit trial feature. Got it? Yes. So now we will see some of the advantages of this audit trial. So firstly, it will enhance internal controls and data security. So I told you, I explained you what is meant by audit trail. Now tell me, can audit trail be called as an internal control? So since it will keep a track of all the people who have made the changes, at what time it has been made, if any fraud has been taken place in entering the entries, you can identify it by going through the audit trail. So it will act as a internal control. Audit trail will increase the internal control in the organization, correct or not? Yes. It will also fix the responsibility on a particular person who have entered into the transaction or who have made entries in the books of accounts, because audit trail will clearly keep a track of who has altered the entries, who has made the entries, right? So you can fix the responsibility on the people, right? Next, rebuild events upon occurring of some problem. So if any problem occurs, either auditor or management can rebuild, trace back to the origin of the transaction by going through the audit trail feature, correct or not? Yes. Next, specify reason of the problem. So you can identify the reason for the problem that has occurred, and ensuring operations of system as or going through as intended. So audit trail will help you for all these things. These are advantages that you will get because of audit trail. So hope you understood what is meant by audit trail and its advantages. Now we will start with the next standard essay 501. So I told you essay 501 also deals with audit evidence only, but with respect to certain specific selected items. So if you see, even the name of the standard, it says audit evidence, specific considerations for selected items. Okay, how many selected items? For three selected items, certain specific consideration we have seen in third chapter about, as not third chapter, fourth chapter, about assertions, right? Balance sheet items will have certain assertions, P&L items will have certain assertions, right? So with respect to these three items also, not all the assertions we will be dealing, only with respect to certain specific assertions or specific consideration. So first of all, we will see what will be covered in this essay 501. So the assertion that will be covered, and with respect to which item. So with respect to, first of all, inventory, existence and condition of inventory. So to obtain audit evidence about existence and condition of inventory, what audit procedures you have to perform, that we will be dealing here. Okay, so with respect to inventory, there are other assertions also apart from existence assertion, like completeness, valuation, right, rights and obligation. All those assertions we will not be seeing generally in case of audit. What happens is, let's say for example, there is a item fixed assets. Fixed asset is a balance sheet item. So for the fixed asset, the assertions that will be there is existence, correct, completeness, right? Next, rights over that asset, right over that asset, right? Next, valuation of that asset, and presentation and disclosure, like this. These type of assertions will be there. Now auditor has to obtain audit evidence with respect to existence of fixed asset. Okay, so for that he needs to perform certain procedure. Next, auditor should also obtain audit evidence with respect to completeness of fixed asset. Again, audit evidence with respect to right over fixed asset, audit evidence with respect to valuation of fixed asset, like this. For each and every assertion of the item, auditor has to perform audit procedure and obtain the audit evidence. Clear? Now, in case of SA 501, we will be dealing only with respect to what procedure has to be performed with respect to existence of inventory, not all the other assertions. Next, with respect to litigation and claims, the assertion we will be addressing is completeness. Okay, to ensure, to obtain audit evidence about completeness of litigation and claims, what audit procedure you have to perform, that we will be seeing. Similarly, segment information. So with respect to segment information, presentation and disclosure. So with respect to audit evidence about presentation and disclosure of segment information, what audit procedure you will perform, that we will be seeing. Got it? Yes. So let us first of all start with existence and condition of inventory. So with respect to existence of inventory, tell me generally what audit procedure you will perform. You will perform physical verification. You will physically to go to the place where inventory is present and you will check whether actually inventory is in existence or not. Correct. So the same procedure is prescribed even by the standard also. See, attend at physical inventory verification. So by attending at physical inventory verification, what should you do? You have to evaluate management's instructions and procedures. So management would have given certain instructions to the employees of organization for doing the physical inventory verification. You need to evaluate whether those instructions given by the management are they proper, or should additional instructions should be given. Like this, you will evaluate the instructions given by the management. Next, you will also observe the procedures that the management is performing. So for physically verifying the inventory, they will perform certain procedures, correct or not? So you will observe those procedures. Next, you yourself will also inspect certain inventory and you yourself will perform certain test counts. Got it? So by attending at physical inventory verification, you will do these four things. Got it? Yes. And while attending at the physical inventory verification, what aspects you need to consider with respect to inventory? So you need to consider what is the nature of inventory and stages of completion of work in progress. So in this organization, to convert raw material to finished good, how many stages are there, that also you need to consider, because based on number of stages, that many number of work in progresses will be there in the organization, correct or not? Next, romum, risk of material misstatement of inventory you need to consider, and nature of internal control around that inventory, timing of physical verification, whether perpetual inventory records they are maintaining. Perpetual inventory record means, see, there are two types of systems for maintaining inventory records. One is perpetual system, another one is the periodic system. So under perpetual system, what happens is, as and when the transaction takes place on a real time basis, the entries will be made into the books of accounts. That will be perpetual system. In case of periodic system, once the transaction happens, after some 1 week or 10 days, all the transactions will be entered together in the records. That is periodic system. So if the entity is maintaining perpetual system, the way how you will audit will be different. If the entity is maintaining a periodic system, then the way that you will audit will be different. So you need to consider this also, whether entity is maintaining perpetual system of inventory records or periodic system of inventory records. Next, locations at which inventory is held. Okay, at how many locations inventory is there, this you need to know, because you have to plan the presence at the physical inventory verification location, correct? Next, whether assistance of any auditor expert is required, or auditor he himself can handle the situation, this also should be considered by the auditor. Got it? Yes. Next, inventory verification, certain special cases. So certain special scenarios, certain special cases with respect to inventory verification we will see. So I'll explain it directly here. So inventory verification, generally you need audit evidence about inventory that is present as on 31st March of so and so year, correct or not? So as on this date, how much inventory is there? For that you need the audit evidence. Now auditor, let's say for example, management, they have conducted physical inventory verification on some other date apart from 31st March, understanding? So they have conducted physical inventory verification on 29th of March only, and auditor has attended this physical inventory verification. In this situation, auditor got evidence about inventory present as on 29th March. but he wants evidence about inventory as on 31st March. So what he will do for this inventory, however, he has the evidence. So for this, he will add purchases and reduce sales that has taken place during this period, and he will perform procedures on this purchase and sales. Through that, he will obtain evidence about inventory as on 31st March. Understanding? Yes. Similarly, if the entity has conducted physical inventory verification after 31st March on 4th April or some other day, what he will do for this inventory, he will add sales and reduce purchases. Correct or not? Yes. So this is the first special situation where entity has conducted physical verification of inventory on a date other than 31st March. Got it? Yes. Next situation, 31st March, entity has conducted physical inventory verification on 31st March only. Okay, on 31st March, exactly entity conducted physical inventory verification. But our auditor, he was not able to attend the physical inventory verification that is conducted as on 31st March due to certain scenarios, like he is not feeling good or some of his personal reasons or whatever the situation might be, he was not able to attend as on 31st March. But entity conducted physical inventory verification as on 31st March. Now auditor was not able to attend. So here what the auditor will do is, auditor will conduct physical inventory verification after 31st March. So on some 2nd of April or some other day, he will conduct physical inventory verification. So by conducting physical inventory verification on some other day, he got audit evidence about the inventory as on that date. For that, he will again make the same thing. Reduce sales, add purchases. Sorry, reduce purchases, add sales. By doing this, he can obtain audit evidence as on 31st March. Got it? This is a second special scenario. So in the first scenario, auditor attended, but it was conducted other than 31st March. In second scenario, it is conducted on 31st March only, but auditor not attended. Got it? Yes. Next, coming to the third scenario. In case of third scenario, what happened is, entity conducted physical inventory verification on 31st March only, but it is impracticable for the auditor to go to that location. Impracticable means it is not at all possible, like that inventory is located beneath the earth, or that inventory is located in the borders where there is a threat. Okay, army threat is there. If auditor goes there, his life is at threat. So in such situations, it is completely impracticable to attend physically at that location. Correct? So this is the third situation. Then what the auditor will do? It is impracticable to attend, but auditor wants evidence about the inventory. He will see whether he can perform some alternate audit procedures to obtain the evidence. So what could be the alternate procedures? See, he cannot physically attend, but he will see whether I can send drones. So through drones, can I obtain evidence about the existence of inventory? Like this, he will check whether it is possible to obtain evidence through alternate procedures. If it is not possible through alternate procedures also, then he will modify his opinion, because audit evidence is not there na, he will modify his opinion. Got it? Yes. So those are the special scenarios. Okay, all those three special scenarios, you'll find them here. Next, inventory under the custody of third party. That means the entity's inventory is available with third party, like entity has sent them on sale or return basis or on consignment basis, in which situations the inventory is present with the third party, but entity is the owner. That will be present in the balance sheet of the entity, but physically it is there with third party. In that situations, what the auditor has to do? Auditor has to obtain a confirmation. See, inventory under custody of third party, if it is material to the financial statements, request confirmation from the third party. So he will send a confirmation to the third party. See, third party entity is saying that inventory is present with you. Is it actually present with you? Please give me a confirmation. Clear, right? Like that the auditor will say. Auditor will perform procedure. If at all it is not possible, the entity is not allowing you to send a confirmation, or you are having a doubt over the confirmation sent by that third party. Okay, third party has given confirmation that yes, inventory is present with me, but auditor is having doubt. He is not able to rely on the confirmation given by the third party. In such situations, what the auditor will do, see, if there is a doubt about the integrity objectivity of third party, then auditor he himself can attend or arrange another auditor to attend that location of third party and check the inventory. He can also use service auditor's report or inspecting documentation regarding inventory held by third party. So from these things, he will do any of the thing if he is having doubt over the integrity of that third party. Next, perform inspection or other appropriate audit procedures. So this way you will obtain audit evidence about inventory that is located at the third party's location. Clear? Yeah. So with respect to inventory, it is done. Now we will go to litigations and claims. So with respect to litigations and claims, what assertion we are addressing? We are addressing completeness assertion, correct or not? So procedures to identify litigations and claims. So what procedures you will perform to ensure that all the litigations have been included in the balance sheet or the financial statement? See, inquire management or others within the entity. You will ask questions. Inquire means asking questions. So you will ask whether any litigations that have been missed from recognizing in the books of accounts. Give us a complete list of litigations. Like this, you will ask questions with the management, because management are the people who will have complete information about the effects of the organization. So first of all, you will start with the management only. Next, you will review minutes of meetings of board or those charged with governance. See, if a entity is facing any litigations or any claims or any court cases, discussion about how to resolve it, what action should be taken against it, it will be discussed in the board meeting, correct or not, or the any other meeting that the entity has conducted. So by going through the minutes of that meeting, in the minutes what will be there, everything it will be detailedly written down, whatever is discussed in the meeting. So by reading the minutes of the meeting, if at all any discussion about the litigations or claims has taken place, auditor will get to know about that, yes, these litigations or claims are existing against the entity, correct? Yes. Next, review legal expense account. So when you have inquired with the entity, management told that, see auditor, we are not having any litigations and claims. But when you are going through the profit and loss expenses, you found legal expense account. Legal expense account means fees that you have paid to the lawyer or some other expenditure with respect to the legal cases will come under legal expense. Now if entity is having no legal cases, why is it paying legal expenditure? So this will also reveal some that some of the legal cases are pending against the entity, correct or not? So these procedures also you will perform. Clear? Yeah. So if in case, see, if the auditor assess Romum regarding litigation or claim, then seek direct communication with entities external legal counsel. External legal counsel means entity's lawyer. So if the auditor is having more doubt, if he has assessed that the risk of material misstatement in case of these litigations and claims is very high, then it is better to once you yourself directly consult with the lawyer of the entity. So that you will do. If management refuses the auditor, so auditor wants to directly consult with the lawyer, but management is not giving access to the lawyer. Management is refusing. Auditor, you should not speak with the lawyer. Lawyer also not responding to the auditor. In this situation, auditor, see, communicate with entities, external legal counsel. Management is refusing, or legal counsel he himself is refusing to respond. In this situation, auditor will see whether I can perform any alternate audit procedures to obtain evidence about the completeness of these litigations and claims apart from speaking to the external legal counsel. If you are able to perform and if you are able to obtain evidence, then that is well and good. You will perform those procedures and you will get the evidence. If it is not possible to perform alternate audit procedures also, then what you will do, you will modify your opinion. See, auditor is unable to obtain sufficient appropriate audit evidence by performing alternate audit procedures also, then auditor shall modify the opinion. Clear? Yes. So this is with respect to litigations and claims. See, another important point, I told you that auditor, he will communicate with the external legal counsel, right? Now whenever you are communicating with the external counsel, whatever the letter that you write to the external legal counsel, that letter should be always on the letterhead of the client, letterhead of the management. You should not use letterhead of auditor, because that external legal counsel is appointed by management. He knows who is management, the identity of management. He doesn't know who the auditor is. Correct or not? Auditor's identity is not known to the external legal counsel. So if you send the request on letterhead of the auditor, there is high chance that legal counsel will not respond to it. So you should always use the letterhead of the management. Clear? Yes. So see, letter of inquiry has to be prepared by management on company's letterhead and to be sent by the auditor. So it has to be sent from the auditor's mail ID or through auditor's address, but on the letterhead, okay, you have to type this letter on the letterhead of the entity client. Clear? Yes. Next, segment information. So what is meant by this segment information, sir? See, segment information means if the entity is doing businesses in more than one location, like in some 10 or 15 countries it is doing, or entity is having certain 15 to 20 products, in such a situation, entity can give performance of each location in which it is operating, performance of each product. You will call it as nothing but segment information. Okay, product wise you will segmentize the revenues, purchases, expenditure, and you will present it. That is segment information. So with respect to segment information, the assertion that we are addressing is presentation and disclosure. So whether proper presentation of segment information has been done, whether proper disclosure of segment information has been done or not, that's what you are checking. Correct? Yes. See, so obtain sufficient appropriate audit evidence regarding presentation and disclosure of segment information. So for this purpose, what audit procedures you will perform? See, understanding the methods used by the management. So what methods management is using for preparing this segment information, you will understand that methods. See, basically the accounting standards, Indian accounting standards, they have prescribed certain methods for bifurcating the revenue, for bifurcating the expenditure, because whatever the in the books of accounts, the expenditures that you will maintain will be for overall company, but in segment information you are bifurcating product wise or location wise. In such a situation, expenditure should also be bifurcated. For that, how you are bifurcating the expenditure? So you will follow certain methods. Correct? Next, auditor has to understand that methods. Next, whether such method results in disclosure as per the applicable financial reporting framework. So whatever the method that the management is following for preparing that segment information, by following that method, can the presentation and disclosure as per the applicable financial reporting framework, can that type of presentation be achieved, or will it deviate the requirements of applicable financial reporting framework? Okay, that you need to see. Next, test application of such methods. Once auditor he himself has to apply that methods and test whether proper results are being occurring and perform analytical procedures and other procedures. Got it? Yes. Next, some of the examples of matters relevant in obtaining understanding of methods used by the management. So here the first step is understanding the methods used by the management. So what are some of the examples of ways through which you can obtain understanding of those methods? So how the management has eliminated intersegment amounts. Intersegment amounts means, see, if you see segment wise, North India, South India. So entity is having operations in North India, operations in South India. There is a branch in North India, there is a branch in South India. Now, if the transfer takes place from South India to North India, in segment information that will be sale for South India, purchase for North India. But if you are preparing the complete picture, complete financial statements for the entire entity, this inter transfer between North India, South India has to be eliminated in the complete financial statement. So how you are eliminating it? So by this, okay, by understanding this, you are understanding the methods that the management is following. Next, comparisons with budgets and other expected results. So management, it would have prepared budgets, so you will compare the actuals with budgets. Next, allocation of assets and costs among the segments. So for allocating the entire assets of the company, how the management is allocating among the segments, in which ratio they are allocating. Let's say for example there is factory. Now this factory belongs to company. In the financial statements you will show that it belongs to company, but when you are preparing the segment information, so for product 1, product 2, product 3, you have to bifurcate the value of this factory among the 3 products. How you are bifurcating it, in which ratio, whether you are bifurcating it in the ratio of sales or in the ratio of how many products are produced in that factory, so which method you are using. So by understanding that also you will obtain understanding of methods that the management is following. Next, consistency with the prior period. So whether the methods that the management has used in the current period, are they consistent with the methods that the management has used in the previous year or not, you will see. So whatever the methods that you have used in the previous year, same method should be used in the current year also. Correct or not? It is not that you can use whatever method you wanted in each of the year. So consistency will also be checked by the auditor. Right. Now let us start with essay 501, which is external confirmation. So what is this external confirmation, sir? See, external confirmation is a type of audit procedure that you will perform. So you can use this external confirmation with respect to debtors, with respect to creditors, right? With respect to bank balances, you will send a request to that particular third party to confirm whether the amount is correct or not. So this is external confirmation, which can be used as a audit procedure. See, meaning is that audit evidence obtained as a direct written representation, response to the auditor from a third party in a paper form or by electronic or other media. Next, types of external confirmation request. There are basically 3 types of external confirmation request. First one is a positive confirmation request. So in positive confirmation request, what will happen? Let's say for example, a debtor in the books of accounts of the company, it is showing that Mr. A has to give 2 lakhs to the company. So to confirm whether this 2 lakhs is correct or not, auditor he sent the external confirmation to the Mr. A stating that, see Mr. A, in the books of accounts it is showing that 2 lakhs has to be given by you. Now tell me whether this 2 lakhs is correct or not. Now here you will ask Mr. A to please respond to me whether you agree with this amount or you don't agree with this amount. In both the situations you give a response to me. That is a positive confirmation request. So in positive confirmation request, you will ask for the response in both the situations whether he agrees or doesn't agree with the amount. Whereas in case of negative confirmation request, what happens is you have sent the confirmation request 2 lakh rupees, and you will tell the debtor that, see debtor, if you agree that the 2 lakh amount is correct only, you don't respond me. If you don't agree with 2 lakh amount, if you feel that less amount has to be paid or more amount has to be paid but not 2 lakh rupees, then you respond. Understanding? That is negative confirmation request. So in case of positive confirmation request, the responding party has to respond in both the situations, whether he agrees or doesn't agree. Whereas in case of negative confirmation request, the responding party has to respond only if he doesn't agree with the amount. If he agrees with the amount, he need not respond. That is a negative confirmation request. Generally you will use this negative confirmation request if there are large number of small transactions. Understanding? Or if you feel that the risk of material misstatement in that area is very less, in those kind of situations you will use a negative confirmation request. But most of the situations you will use a positive confirmation request only. Got it? So first one is positive confirmation, negative confirmation. Third one is blank confirmation request. So in case of blank confirmation request, generally blank confirmation request is a type of positive confirmation request. Here what will happen is, generally in case of positive confirmation, you are mentioning this amount of 2 lakhs and sending to the debtor. Now what is the guarantee that he will actually verify this 2 lakhs from his books of accounts and he will respond? There is a possibility that debtor might respond to you without proper verification. To avoid such a possibility, what you will do is, you will not mention this amount, you will just keep a blank, and you will ask the debtor, you fill how much amount has to be given by you to the company. So in this situation, to fill this amount, he will have to compulsorily verify the books of accounts of him, and he has to respond. So to avoid the possibility that debtor or the third person might respond without properly verifying, to avoid that thing, you will use a blank confirmation request wherein the person has to fill that blank. Got it? Yes. Those are the three types of confirmation request: positive, negative, blank confirmation request. Next, management's refusal to allow the auditor to send external confirmation. See, auditor wants to send external confirmation to a particular debtor, but management is saying that auditor, you should not send this external confirmation to that debtor. Now you will ask the management, what is the problem? You will ask the reasons, correct or not? Now management will say reasons so and so, so and so, so and so. Now if auditor feels that yes, the reasons given by the management are valid only, then you will see whether you can obtain audit evidence through alternate audit procedures. If you feel that you cannot obtain audit evidence through alternate audit procedures also, then you will show your impact on the opinion, you will modify your opinion. If it is possible to obtain audit evidence through alternate audit procedures, you will obtain the evidence and you will give the normal opinion. Got it? Yes. See, inquire reasons for management's refusal and seek evidence as to that refusal. Next, evaluate implications on ROMM. So now management is not letting me to send external confirmation. So why management is not letting? Are there any frauds? So if there are frauds, then the ROMM will increase. So this will, because of this situation, I have to reassess ROMM for the entire entity. Correct or not? So what impact this situation of management not allowing me to send the external confirmation will have on the entire ROMM of the entity? You need to reassess that entire ROMM. Next, perform alternative procedures to obtain audit evidence. So in order to obtain audit evidence, you need to see whether I can perform any alternate audit procedures. So if you are able to perform alternate audit procedures and you are able to get the audit evidence, then that is fine, well and good. If you are not able to perform alternate audit procedures, then see, if auditor concludes that management's reason is unreasonable and not able to obtain sufficient appropriate audit evidence from alternate procedures, then communicate with those charged with governance and determine implications of the auditor's opinion. Got it? Yes. Next, now with respect to external confirmation, you need to consider certain factors. Okay, now to send the external confirmation, you will design the request, confirmation request, correct or not? So you need to consider certain factors in designing the confirmation request. So what factors you have to consider? See, first of all, assertions that are being addressed. So to get the evidence about which assertions you are sending the external confirmation, you need to consider the assertions being addressed. Because if you are addressing assertion of valuation in the external confirmation request, you will ask about whether amount is correct or not. If you are addressing assertions of existence, then you will ask whether this is actually present with you or not, correct or not. So the way you will design the wordings of the request will change based on the assertion being addressed, correct or not? Yes. Next, identified romum. So if the romum of that particular area where you are requesting the external confirmation is more, then the way you will design the request will be different, correct? Next, layout and presentation. So you should also focus on layout and presentation of the external confirmation request. So you have to neatly design it so that the party to whom you are sending it, by just seeing it, he should get a feeling that he has to respond to that request in such a manner. You have to design the layout and you have to present it in such a manner. Got it? Yes. Next, you should also see the prior experience. So in the previous years also, you would have sent the external confirmation request. So for that external confirmation request, whether you received the response or not, if you haven't received the response for them, then you need to change the designing, correct or not? So your previous experience also should be considered in designing the external confirmation request. Next, method of communication. Method of communication means how you are communicating. Are you sending the request through mail, or are you sending it through the post? So that also you need to consider for designing the confirmation request. Next, management's authorization. Is management willing to give the authorization to you to send external confirmation? You need to see that also, is management authorizing me? Next, ability of the intending confirming party. So you are sending the external confirmation request to accountant, let's say. Now accountant of that organization is not at all having the information that you are asking for, or accountant is not permitted to disclose that information. Then what is the use of sending the request to accountant? So you have to send the request to such a person in that organization who is having the information and who is having authority to share that information. Getting it? Yes. So that factor also you need to consider. Next, auditor shall maintain control over external confirmation procedures. See, auditor, he should not assign the task of external confirmation to some other person. Okay, in this external confirmation procedure, there will be certain tasks like determining the information to be confirmed. So for which information we have to send external confirmation? Okay, should we ask about amount, should we ask about existent, which information? That needs to be decided by the auditor, he himself. He should not assign this task of deciding the information to be confirmed. Okay. Next, selecting the appropriating confirming party. There are 1,000 debtors in the entity. Of these 1,000 debtors, to whom we should send the external confirmation request, that should be selected by the auditor only. He should not assign this task to internal auditor or any other person. Understanding? Next, designing confirmation request. So the confirmation request should also be designed by the auditor only. He should not assign this task. Again, this confirmation request, it should be designed on the letterhead of the auditor or the letterhead of the management. It should be designed on the letterhead of the management. Why? Because that third party, he doesn't know who the auditor is, but he is having relationship with the management, so he knows about the management. So there is a high chance that he will respond if you give the request on the letterhead of the management. Understanding? Next, sending the request including follow-up request. So auditor, he himself has to send the request, and the follow-up request should also be made by the auditor he himself. He should not assign this task to any third party. Understanding? Yes. So basically about this we will be seeing in essay 16 using the work of internal auditor. So they can ask you a question linking essay 5 not 5 and essay 16. How in essay 16 there is a concept of direct assistance. Now they will ask whether auditor can use, that is the statutory auditor can use direct assistance of internal auditor as per essay 16 with respect to these particular aspects of the external confirmation. Like this they will ask. Now the answer is he should not use the direct assistance of internal auditor, because these on these things the statutory auditor should exercise complete control. He himself has to perform these things. Getting it? Yes. Next. Now, negative confirmation request, positive confirmation request, which is more reliable? Of course, positive confirmation request is more reliable, because in both the situations you will get the response, correct? So, positive confirmation is more persuasive than a negative confirmation request. Positive confirmation provides more persuasive, more believable audit evidence than the negative confirmation request. So there are, you cannot use negative confirmation request in all the situations. Only in the following scenarios you can use negative confirmation request. So what are the scenarios in which you can use negative confirmation request? We will see. See, negative confirmation provides less persuasive audit evidence, right? And you shall not use this as a sole audit procedures unless all the following situations are present. What are they? Romum of the area is low and controls are operating effectively. So, in order to use negative confirmation request, Romum of the area should be less and the controls around that area should be operating effectively. Next, large number of small homogeneous populations. Okay, in case the items are huge, like thousands or 10,000 number of items are there, and all of them are homogeneous and small amounts like 100 rupees, 200 rupees. For example, there are 10,000 debtors in the organization, 10,000 number of debtors, and each debtor's value is 150, 160, 200, like this small amounts are there. In this situation you can use a negative confirmation request, because if you send positive confirmation request for all the 10,000 small debtors, you will get a response from all of them. Now you have to open each request and check whether they have agreed or not, correct? Now in this situation, if you use a negative confirmation request for all the 10,000 debtors, only those debtors who don't agree with the balance, they will respond you back. So it is sufficient if you just check the responses that you got. Understanding? So in this situation also, where the number of debtors or the number of items are more and the value is small, in that situation also you can use negative confirmation request. Next, very low exception rate is expected. Exception rate means misstatements, the number of misstatements expected are very less, then also you can use the negative confirmation request. Not aware of the circumstances that cause recipients to disregard the request. So auditor does not have anything to believe that if I send a request to the third party, he will take that request and throw it in the dustbin. Understanding? Throwing it dustbin means not considering that request, not at all looking at that request. So auditor doesn't have anything to believe that the third party will not consider his request. The third party will disregard his request. In that situation also you can use negative confirmation request. Understanding? So only if all these situations are present, you can go with negative confirmation request. Otherwise you should always use positive confirmation request only. Got it? Yes. Next, now once you have got the responses, see, external confirmation procedure doesn't end by just sending the request. It will end only after you evaluate the responses that you have received. So external confirmation procedure involves two parts. First part is sending the request. Second part is the second part is the responses that you have received, they should be analyzed. That is the second part. Only if you analyze the responses, the complete external confirmation procedure gets completed. Understanding? So evaluation of evidence obtained. How you will evaluate? When evaluating results of individual external confirmation, auditor has to categorize the responses into following categories. What are they? First one, a response indicating agreement without exception. So you have got responses. So in these responses, how many are the responses for which there is no disagreement? The third party have agreed with the amount. That is response indicating agreement without any misstatement. Next, response is deemed unreliable. So first category is this one. Second category is you have to category all those responses on which you don't have belief. They are agreeing only, but on that response you are not having belief. That you will categorize into second one. Next, non-response. So for some of the debtors, you have sent the external confirmation for 1000 people. Some 800 people responded, 200 not responded. So you have to categorize the identify the non-responded people. So for non-responded people, what you will do? You will send a follow-up request, correct or not? For the second category, what you will do? You will perform further audit procedures to get confirmation, correct or not? For the first one, you can accept it without any further procedure. Finally, response indicating exception. Exception means in the books of accounts amount is showing as 20,000, but in the response that you received it is showing as 25,000. So there is an exception. In this situation, you need to identify which is correct, whether amount showing in books of accounts is correct or the amount showing in the received in the response is correct, or both are wrong. That you need to identify. Okay, this is the fourth categorization. Like this, you need to categorize the responses and perform the respective procedure that is relevant for each of the category. Got it? Yes. Next, moving to essay 510. So this essay 510, it deals about opening balances. See, opening balances of current year, they come from the previous year closing balance, right? So what procedures the current year auditor should perform with respect to opening balances of the current year, that too in respect of initial audit engagement, not with respect to recurring audit engagements. So what is this initial audit engagement and recurring audit engagement? See, if the audit for the first year is done by Mr. A, and audit for second year also done by Mr. A, then the second year audit will be recurring audit for Mr. A, because in previous year he only done. Next, in third year, let's say Mr. B has been appointed as auditor. Now for Mr. B, the third year audit will be initial audit engagement. Now in this initial audit engagement, the closing balances of second year will be the opening balances of third year, correct or not? Now the opening balances, they will have impact on the closing balances of third year, correct or not? So Mr. B has to perform certain procedures with respect to these opening balances which have come from the closing balance, correct? So from this aspect, SA 510 will be dealing. See, SA 510, initial audit engagement with respect to opening balances. First of all, what is meant by an initial audit engagement? An engagement where financial statements of previous year were not at all audited or audited by predecessor auditor. That means apart from current year auditor, some other auditor has audited the previous year financial statements. We will call him as a predecessor auditor. Now the predecessor auditor should be an auditor from other firm, not within the firm of chartered accountants of current period. Understanding? See, predecessor auditor means auditor from a different audit firm who audited financial statements in prior period and who has been replaced by the current auditor. Understanding? So in those two situations, you will call the current period audit as the initial audit engagement. Now, what are the objectives of auditor with respect to opening balances of the current year? See, first of all, he needs to obtain sufficient appropriate audit evidence that opening balances do not contain misstatements that affect the financial statements. So the current year auditor, the for the initial audit, he needs to obtain audit evidence that opening balances that have been carried forward from the previous year do not contain any misstatements. This is the first objective of the current period auditor. Next, whatever the accounting policies that are reflected in the opening balances are consistently applied in the current period financial statement. So in the opening balances, whatever the accounting policies are being reflected, the same accounting policies should be followed in the current year also. If at all there is any change in the accounting policies of current period, then such a change should be properly accounted for in the books of accounts. Got it? So this is the objective of a current period auditor with respect to initial audit engagement, right? Yeah. Now, what audit procedures the current period auditor should perform with respect to opening balances? Let us see. First of all, he needs to check that whether the closing balances of previous year have been correctly brought forward to the current year or not. Okay, the current year opening balances, they should match with the closing balances of previous period. It should not be that in the current year opening balances, whatever figures you wanted, you just brought them and kept them. No, they should match with the closing balances of last year, right? Determine whether closing balances are correctly brought forward. Next, determine whether opening balance reflect appropriate accounting policies. So whatever the opening balances, in opening balances, whatever the accounting policies that have been used, are they correct? See, the first requirement is whatever the accounting policies reflected in the opening balances, that should be followed in the current period. Before that, you should first of all check whether that accounting policies followed in the opening balances, are they appropriate, are they correct? First of all, if they are correct, then they should be followed again similarly in the current period also. Okay, if a prior period financial statements are audited, once peruse those financial statements. So if at all the last periods, the previous years audited financial statements have been audited, once go through, peruse means just once reading the financial statements. Next, evaluate whether current period audit procedures provide evidence relevant to opening balances. So sometimes what happens is, while you are performing audit procedures related to current period, they will provide you audit evidence about opening balances. Like, let's say for example, during the year, amount has been received from debtors. Now, while performing audit procedures on these transactions, you will get evidence about existence of debtors in the opening balance. Only if debtors are present in the opening balance, the amount will be received during the year, correct or not? So in some situations, performing audit procedures on current period transactions will give you audit evidence about the opening balances. Understanding? So that also you have to see whether the audit procedures that I perform on current period transactions, do they provide me any evidence about the opening balance? Next, reading most recent financial statements and predecessor audit report, if any. So if there is any most recent audit report available, once go through it. These are the audit procedures that you will perform with respect to opening balances. Next, another thing that you need to ensure is there should be consistency in the accounting policies. So you need to obtain sufficient appropriate audit evidence about whether accounting policies reflected in the opening balances are consistently applied in the current year. This point we have already seen, right? In the objective itself, we have seen it. So if at all there is a change in the accounting policy, whether they are properly accounted for and disclosed. Let's say, for example, in the previous year, you have provided depreciation by following written down value. In the current year, you are following SLM method. Is it proper? No. Whatever the procedure, whatever the accounting policy you have followed in the previous year, same thing should be followed in the current year also. If in case you wanted to change the accounting policy, then you have to properly account for it, right? So let's say you want to change from WDV to SLM for this year, then the requirement is that you need to make adjustment of what would have been the depreciation if SLM has been followed uh, retrospectively. Okay, from the beginning itself, if you have followed SLM, what should have been the value of the asset and what should have been the depreciation, that effect you give now and follow SLM. Understanding? So the basic requirement is you need to follow accounting policy consistently. If at all you want to change the accounting policy, then properly account for that change. Getting it? Yes. So that's what the auditor will see with respect to accounting policy. Next, audit reporting. So there are certain situations, and in each of that situation, how the auditor will report. Let us see. So situation number 1, unable to obtain sufficient appropriate audit evidence regarding opening balances. So regarding opening balances, auditor is not able to obtain audit evidence. That means if audit evidence is not available, you will give either qualified or disclaimer based on the pervasiveness of the matter, right? So qualified or disclaimer. Next, concludes that opening balance contain misstatements. So concludes means evidence is available. There is a evidence available that in the opening balance there is misstatement that materially affects current period financial statements and effect is not properly accounted. So there is a evidence and the misstatement is material, and you don't know whether it is pervasive or not pervasive. Since the evidence is available, you will give either qualified or adverse based on the pervasiveness of the matter. So see, qualified or adverse. Next, predecessor auditor opinion includes a modification. So in the previous year, auditor has given a modified opinion, whatever it might be, qualified, disclaimer or adverse, and it remains material to current period financial statements. So that matter is very much material for the current period financial statements also. In such a situation, you will modify the current period financial statements also, or current period opinion also you will modify, right? Yes. So this is a discussion of SA 510. Next, moving to essay 520, which is with respect to analytical procedure. So if you remember, I told you that analytical procedure can be used as both. So analytical procedure, it can be used as both risk assessment procedure as well as further audit procedure, right? So risk assessment procedure you will use for identifying and assessing the risk. Further audit procedure, as a response to that risk assessment procedure, you will design further audit procedure. Now we will see how you can use analytical procedure as risk assessment procedure first of all. So see, so one of the analytical procedure is trend analysis. So in the past 5 years, the revenue of the company is growing at a constant rate of 5%. Now suddenly in the current year, revenue has grown at 8%. This is nothing but you are doing a analysis of the trend. In the past 5 years, it is growing at 5%, but for the current year, it has grown at 80%. So there are two possibilities. Firstly, it could have been a genuine increase, or there could have been a fraud committed here. Correct or not? From these two things, anything would have happened. So you have identified the risk here. Correct or not? Risk of material misstatement you have identified. How did you identify? By performing a analytical procedure. So this is how you can use analytical procedure for identifying the risk. Got it? Next, how you can use analytical procedure as a substantive procedure. Okay, substantive procedure is one of the further audit procedure, detailed procedure. So let's say, for example, in the P&L statement, I guess I told you this while discussing SA 315. So in the P&L statement, there is salaries. Now you wanted to obtain audit evidence about the salaries, and you wanted to use analytical procedure. So what you will do? You will ask the management how many number of employees are there and how much average salary you are giving to them. You will multiply. So let's say 100 employees, on an average you are giving 10,000 salary into 12 months. How much it will become? 1 lakh, 10 lakh, 1 crore, 20 lakh, right? 1.2 CR. So now you will see, based on your analysis, 1.2 crore should be present in the P&L. So in the P&L, in the salaries, actually how much it is there? If it is 1.2 crore only, then it is fine, your analysis is correct. If it is 1.1 crore or 1.3 crore, you will investigate why the difference has occurred between your expectation. So this 1.2 crore is your expectation. How you are expecting? Based on certain analysis you are expecting, and this is the actual figure. You will compare the both and see whether there is any difference. If there is a difference, you will investigate the difference. Understanding? Yes. So this is how you will perform analytical procedure. Let us see this SA 520, which is exclusively dealing with analytical procedure. See, meaning of analytical procedure: evaluation of financial information through analysis of plausible relationship among both financial and non-financial data. So if you see in our example, number of employees is non-financial data, average salary is a financial data, and there is a relationship between these two. We have used that relation to perform analytical procedure. So they are giving the meaning of analytical procedure as a evaluating the information through analyzing the plausible relationship between financial and non-financial data. So that means in order to perform analytical procedure, a relationship should exist between financial and non-financial data, or two financial data. Only then you can perform analytical procedure. And investigation to identify fluctuations or relationships that are inconsistent with other relevant information. So this is nothing but a trend analysis, right? Yeah, types of analytical procedure: comparison of client data with industry data. So in case of this analytical procedure, you can compare data of the client, sales of the client, with the data of the industry. Industry means, like, let's say entity is in the car manufacturing. Okay, is car manufacturing. Now all the companies that manufacture the car, taken together, you will call it as an industry. So comparing the company's data with industry data, or comparing the company data to similar prior period data. So current year data of the company you are comparing with the prior period. That is also an analytical procedure. Next, client determined expected results. Expected results means budgets. Okay, client would have prepared a budget and he has arrived at certain actual amount. Now comparing the actual amount with the budget is also an analytical procedure. Next, auditor determined expected results means, see, in our example, by multiplying average salary and the number of employees, auditor has expected a certain amount. That is auditor determined expected results. You will compare with the actual figure. This is also an analytical procedure. Next, expected results using non-financial data. So this is nothing but projection. Expected results means how much expectation the company has made, projection it has made. You will compare the projections with the actual data. So all these are the different analytical procedures. Now, what is the objective of this analytical procedure? Simple. Obtain relevant and reliable audit evidence when using substantive analytical procedure. Okay. See, for whatever the audit procedure, the objective is to obtain audit evidence. Similarly, for analytical procedure also, you will have the same audit, same objective. Next, purpose of analytical procedure. Use comparisons and relationships to assess reasonableness. So, reasonableness means you have expected that 1.2 crore should be the reasonable amount of salary based on your calculations, average number of employees and average salary. So the reasonably it should be approx 1.2 crore. So you have arrived at a reasonable amount that should be there in the P&L. If it is exceeding or below it, you will investigate, right? So that is one of the purpose, to expect a reasonable amount. Next, interfirm and intrafirm comparison. So with the help of this analytical procedure, you can compare the performance of your firm for the current year with last year, and you can also compare the performance of your firm with another firm, that is interfirm, intrafirm. Okay. Next, independently verify the correctness of some of the items of expenses. Just like I have explained you about how to perform analytical procedure on salaries, you can also perform analytical procedure on various expenditure items of the P&L. You can perform analytical procedure on rent, on electricity, on purchases, like this on almost all the P&L items. You can perform analytical procedures. Next, factors to be considered for a substantive analytical procedure. See, if you want to perform analytical procedure, there should be certain factors that should be there. What are they? Let's see. First of all, availability of data. So data should be there with the organization. Without data, you cannot perform analytical procedure. If you see our example, for that verification of salary expenditure through analytical procedure, we required data such as the number of employees, average amount of salary you are giving, correct? So this data should be present. Only if the data is there, you can perform analytical procedure. Otherwise, it is not possible to perform analytical procedure. Next, disaggregation. Disaggregation means, okay, data is available. That data is segregated to various areas, so that is present in lot of areas, then it takes time to collate all that data. So if the data is highly disaggregated, then also it is not possible to perform a analytical procedure. Next, account type. So what is the type of account on which you want to perform analytical procedure? If you want to perform analytical procedure on balance sheet item, it's quite impossible to perform analytical procedure on balance sheet. Once check fixed assets, liabilities, once see whether you can perform analytical procedure on any of those items. You cannot perform. But on P&L items, it's quite easy to perform analytical procedure. So you should also consider what is the type of the account on which you want to perform analytical procedure. Next, what is the source from which the data has been extracted and the reliability of that source. Next, there should be a predictability. So only if the amount can be predictable, you can perform analytical procedure. If you can't predict the amount, you cannot perform analytical procedure. Got it? You can just to take the example, even in that sales trend or in the salaries expenditure, you should be able to predict the amount. If you are not able to predict the amount, you cannot perform a analytical procedure. Clear? Next, nature of assertion that you are going to address. So if you want to address assertion like existence, it's impossible to perform analytical procedure for existence assertion. But if you want to address assertion like valuation or the accuracy, you can perform analytical procedure. So which type of assertion you want to address, that also you need to consider while using the analytical procedure. Next, inherent risk or what can go wrong. So all these things you need to consider in determining whether you can use analytical procedure for that area or not. Clear? Yes. Next, techniques available for analytical procedure. This is simple. trend analysis, ratio analysis, reasonableness test. Reasonableness test means that salaries example you can take. Okay, the test we have performed, average salary multiplied by number of employees, that is nothing but a reasonableness test. Next is structural modeling. See, structural modeling is a advanced version of reasonableness test. Here in this structural modeling, you will develop a custom formula for establishing the relationship between the items. That is structural modeling, which is quite complex. Got it? Yes. Next, steps in performing analytical procedure. So, what are the steps that are involved to perform analytical procedure? Let us see. First of all, you will determine suitability of particular substantive analytical procedure. So, for the assertion, for the item that I am going to audit, is analytical procedure suitable? Can I use analytical procedure in this situation? You will check that first of all. Next, evaluate the reliability of data from which expectation is developed. So once you got an idea that yes, in this situation I can perform analytical procedure, now you will check whether the data is available, because for performing analytical procedure the first thing that you require is the data. Without data you cannot perform analytical procedure, and that data should also be reliable. If you don't have reliable data, the expectation that you make based on analytical procedure will be wrong, will not be reliable. So the data that is available, is it reliable or not, also you will see, correct or not. See, that's what you are saying, reliability of the data. Once you felt that yes, data is available and even that data is also reliable, now now you will develop a expectation. How will you develop a expectation? Just like multiplying average salary with number of employees, you will arrive at certain amount. That amount is nothing but a expectation that you have made. Getting it? Yes. So that's what, develop an expectation of recorded amounts. This is the third step. After you have developed an expectation, determine the amount of any difference of recorded amounts from the expected values. So you have expected that salary expenditure should be 1.2 crores, but actually in the P&L statement it is also 1.2 crore only. Then there is no difference between expected amount and the actual amount. If at all there is any difference, you will investigate it further, right? That is the fourth step. Okay, determine the amount of difference of recorded amount from the expected values that is acceptable without further investigation. Got it? So this is a analytical procedure, steps involved in analytical procedure. Got it? Yes. Next, investigating results of analytical procedure. Just like this external confirmation procedure doesn't get completed by just sending the request, you should analyze the request responses received, correct? Just like that, in case of analytical procedure also, you need to analyze the results. How you will analyze? See, if analytical procedures identify fluctuations, so after performing analytical procedure, if you have identified any fluctuations, inquire with the management. Management, I am getting a difference. I got that actually your salary should be 1.2 crore as per my expectation, but in your financial statements you are showing 1.5 crore. What is the reason? You will ask with the management, because management is the one who will have complete information about their entity. So you will first of all ask the management. Next, perform other audit procedures. Based on the responses given by the management, you will perform certain other audit procedures also. Got it? Yes. So that was essay 520. So next, essay 530, audit sampling. So audit sampling. Why will auditor use sampling? See, in case of large companies where there are thousands of transactions, it becomes difficult for the auditor to audit each and every transaction. So auditor chooses to go for sampling. So under sampling, what happens? Let's say there are thousand population. Population means total number of items. Now, since he cannot test all the population, he will take a sample of 100 items and he will perform audit procedures on these 100 items. And let's say, based on his audit procedures, he found out that there is one misstatement in this 100 sample. Now, he will project this misstatement to population. That is, in 100 number of sample there is one misstatement, then in 1000 numbers how many misstatements will be there, like this he will cross multiply. So in how he will cross multiply, 1000 divided by 100 multiplied by 1, so 10. So like this, in sample of 100 there is one misstatement, then in total 1000 population there can be 10 misstatements. Like this he will make a guesswork. Now, because of this sampling, there is a sampling risk. Correct or not? Why this sampling risk arise? Because you have not performed audit procedures on complete population, but you are telling that there will be 10 misstatements in the population, which is not correct, right? Just based on sample you came to this guess. So in the population there can be more than 10 misstatements or less than 10 misstatements possible, right? So you will call it as sampling risk. Understanding? Yes. So what is meant by sampling? Application of audit procedures on less than 100% of entire population is known as sampling. Clear? See, audit sampling. Application of audit procedures to less than 100% of items within a population of a audit relevance, such that all sampling units have a chance of selection. This is the concept of sampling. So what is meant by population? I told you, the entire data set on which auditor has to frame a opinion is known as population. You will take sample from the population, right? Next, sampling risk. Risk that auditor's conclusion based on a sample may be different from the conclusion if entire population was subjected to same audit procedure. So what they are saying, the risk that auditor might reach a different opinion by performing audit procedures only on 100 items instead of performing the procedures on complete items. Such a risk is known as sampling risk. Next, anomaly. What is meant by anomaly? So let's say, for example, in this sample of 100, let's say you have found 5 misstatement. Of these 5 misstatements, one misstatement is such that it is very rare, it will not be there in entire population. Okay, you have found a particular misstatement in the sample, and that misstatement is very rare that it is found only in the sample. If you search entire population, such a kind of misstatement for sure you will not find in the entire population. So such a type of a misstatement is known as anomaly. Understanding? So the misstatement which is found only in the sample, but for sure 100% it will not be there in the entire population, will be known as anomaly. Now, when you project the misstatement to the population, you should exclude this anomaly. So there are total 5 misstatements in 100 items. Now, of that 5, one is an anomaly. So, while projecting, you should consider only 4 misstatements. So, you should say that in a sample of 100, there are 4 misstatements. Then, in a population of 1000, how many misstatements will be there? 40. Like this. So, while projecting the misstatements from sample to the population, you have to exclude anomaly, because such a type of misstatement for sure 100% it will not be there in entire population. Got it? Yes, that is a concept of anomaly. Next, tolerable misstatement. Tolerable misstatement means if that misstatement is till that level, it is okay to the auditor. It will not impact the opinion of the auditor. Like, see, for every audit, auditor will keep a tolerable level of misstatement. Like, let's say 1 lakh rupees. That means even until and unless misstatement crosses 1 lakh rupees, auditor will not be concerned with that. Okay, so if misstatement is less than 1 lakh rupees, it is okay to the auditor, is known as tolerable level of misstatement. See, a monetary amount set by the auditor in respect of which auditor seeks to obtain appropriate level of assurance that the monetary amount set by the auditor is not exceeded by the actual amount. So he will always ensure that the actual misstatement will not cross this tolerable level of misstatement. Clear? Yes. Next, characteristics of population. So what characteristics should be there in the population? See, from the population you are selecting the sample, right? So the population should be appropriate. So if you want to perform audit procedures on sales, then your population should be sales, right? Since you want to obtain audit evidence about the sales, your appropriate population would be sales invoice. So that is the first character. Next, completeness. So you want to perform audit procedures on sales, there are certain 1 lakh number of sale transactions and you wanted to take out a sample from this. Now, while taking out the sample, you should consider complete 1 lakh number of sales transactions. You should not just consider only 50,000 number of sales transactions for the purpose of selecting sample. If you consider only 50,000, what will happen? You are neglecting, you are ignoring the remaining 50,000 sales transaction, correct or not? So another characteristics of sample is that another characteristic of population is that it should be complete. Clear? Yes. Next, reliable. Of course, you are taking sample from the population. If population itself is not reliable, how can you rely on this sample? Correct. So the population should be reliable for the purpose of auditor, right? These are the characteristics of population. Next, approaches to sampling. See, broadly speaking, there are two types of sampling, broadly speaking. One is statistical sampling, another one is non-statistical sampling. Again, in statistical sampling there are further types of samplings, in non-statistical also further type of sampling, but broadly there are two, statistical and non-statistical. Now what is meant by statistical sampling? See, statistical sampling will have certain features. So what are the features of statistical sampling? First of all, there will be randomness. Random selection will be there in case of statistical sampling, and you will use scientific formulas in case of statistical sampling. See, statistical sampling has a random selection and use of probability theory, and it is more scientific when compared to non-statistical sampling, because statistical sampling is based on certain statistical formulas and it is widely used when compared to non-statistical sampling. So statistical sampling is having a reasonably wide range of application and there will not be any personal bias in case of statistical sampling. Some of the advantages of these statistical sampling: see, sample size does not increase in proportion with population size. So let's say for example, there is 1,000 population, you are taking a sample of 100. Now if population size increases 10x, 10 times to 1 lakh, now sample size also will not increase 10x, it will increase either 2x or 3x. Okay, it might become either 200 or 300. So that is one advantage. So sample size will not increase with the same rate as the population size increases. So because how this becomes an advantage to you, because you need not perform audit procedures on more items. Correct. Even though the population increases rapidly, you can perform audit procedures only on some of the items. Some of the sample size will not increase at the same ratio. Understanding? Yes. Next, sample selection is more objective means, so objective means based on facts. So sample selection will not involve any biasedness. Based on the facts, based on the formula, you will select the sample. So less biasness, less not, almost zero biasness will be there while sample selection in case of statistical sampling methods. And means for deriving a calculated risk. So, with the help of a statistical sampling, you can arrive at a calculated amount of risk because it is completely based on formula. So, if I wanted to test these many number of samples, how much risk I will be taking, you can fix the risk. In order to reduce the risk, how much sample size should be increased, like this a calculated decision you can make with the help of statistical sampling, since it is completely based on formulas and better description of large mass of data. So by using statistical sampling, you can get a clear idea of huge population by performing audit procedures on just some of the sample. Getting it? Yes. Next, estimating a minimum sample size associated with the specific risk and precision. So you can say, I wanted to take this much amount of risk. So for taking this much amount of risk, how many transactions, how much sample I should select. So this kind of decision making can be done with the help of statistical sampling. On the other hand, non-statistical sampling is non-scientific. It involves personal bias, personal knowledge and judgment of the auditor. See, personal experience and knowledge of auditor is required for non-statistical sampling. Generally, non-statistical sampling is not used that much. Okay, it is not widely accepted. Next, sampling methods. So here we will be seeing some of the statistical sampling methods and also non-statistical sampling methods. So firstly, random sampling is a statistical method. So this is of two types. First one, simple random sampling. Simple random sampling means, see, there will be random number generators. If you go to the Google and type random number generator, a interface like this will come. Let's say your total population is 1000. So minimum is 1, maximum you set to 1000, and once you click on generate, it randomly generates a number. So you will pick that item into sample. Again, once you click generate, it randomly selects, you will pick it again, like this. How many items you wanted to include into the sample, that many times you will click generate and you will pick that item into the sample. That is nothing but a random sampling, for which you will use this kind of random number table generator. Got it? Yes. So this is simple random sampling. So what we have seen there is a simple random sampling. Now stratified random sampling. Now what is meant by stratified random sampling? Let me tell you. So let's say there is a population of 1000. Now you will divide this 1000 population into strata, or you will call it as a stratum. Now, each stratum, you will divide it in such a way that it has 200 items. Okay, 200 items, 200 items, 200 items, and 200 items. So, and another feature of this stratified random sampling is, see, you will call this as strata or stratum. Now, all the items of this stratum will have similar features. Same characteristics will be there in all the items of the strata. Getting it? Now, you have divided the population into strata. Now from each strata randomly you will select some of the items. So from this strata, from 5 items randomly you will select. From this strata another 5, another 5 you will select, another 5 you will select, another 5 you will select. Now total 25 items you have selected into sample from 1000 items. So this is a stratified random sampling, wherein first of all you have divided the population into strata such that all the items of same characteristics are brought into a single strata. Now from the strata you have applied random sampling. Getting it? This is a stratified random sampling. Got it? Yes. So what is the use of this stratified random sampling? You can avoid a situation where the items of same characteristics will get selected into the sample. Understanding? If you do stratified random sampling, you will have items from all the characteristics into your sample. Clear? Yes. Next, interval sampling or systematic sampling. So what is this interval sampling? Let me tell you. Let's say again, same 1000 population is there and you wanted a sample size of 50. Okay, sample size is 50. Now what you will do is you will first of all select sampling interval. So sampling interval will be 1000 divided by 50. So 20 is the sampling interval. So from this 1000, every 20th item you will take into sample. So this is nothing but a interval sampling or a systematic sampling you can call. Got it? Yes. So that is interval or systematic sampling. Next, monetary unit sampling. See, monetary unit sampling is a very complex selection process. I will just tell you briefly. So let's say there are these kind of items in the population. One item value is 1 lakh rupees. Another item value is 2 lakh rupees. Okay, another item value is 500, another item value is 1000 rupees, another item value is some 50,000 rupees. Now if you are using monetary unit sampling, the chance of selection of a higher value item into the sample will be more, and the chance of selection of lower value item into the sample will be less, because you will consider the value of the item also if you are using monetary unit sampling. Got it? This is briefly how the monetary unit sampling will look like. Here you will give importance to the value of the item. Clear? Yes. Next, haphazard sampling means, haphazard means no structured technique you are following. You will call it as haphazard, as you wish. You will select the sample. This is non-statistical sampling. Next, block sampling. Block sampling means, let's say there are sales invoices. Sales invoices will be there in each and every month, correct or not? So every year will have 12 months. Every month will have sales invoice. Now, in the first month, you have selected block of sales invoice from 1st to 10th date. So, all the transactions that has taken place between these two dates will be selected into sample. Same with the second month also. In second month also, 1st to 10th. Third month also, 1st to 10th. So here you are selecting a block of continuous items into the sample. This is nothing but a block sampling. Getting it? Yes. So this is block sampling. So all the sampling methods we have discussed. Next, moving to steps in audit sampling. There are 5 steps in applying this audit sampling. Once we discuss these 5 steps, this standard gets completed. Let us see the 5 steps. So the first step is sample design, size and selection. So while designing the sample, you have to consider the purpose for which you are making the sample. Okay, purpose of procedure and characteristics of the population. So in designing the sampling, you need to consider these two things. Next, sample size. Sample size means how many items should be there in the sample. So sample size should be selected in such a way that overall sampling risk will be reduced to a acceptable level. Got it? Yes. Next is sample selection. Now, while selecting the sample, you need to select it in such a way that each and every item of the population is having equal opportunity of being selected into the sample. So these rules you need to follow with respect to sample design, sample size, and sample selection. So now you have selected the sample by following these rules, right? Yes. See, once you have selected the sample, the next step is you will perform your audit procedures on the sample, correct or not? So, performing the audit procedures. So, perform audit procedures appropriate for the purpose on sample, not the population. Okay. Now, if audit procedure is not applicable to the selected item, perform procedure on replacement item. What is this replacement item, sir? Let's say, for example, you are performing audit procedures on checks issued. So you have selected some 50 sample checks and performing audit procedures. So in that 50, there is one particular check which is cancelled check. Now, the audit procedures that you are performing are not applicable to this cancelled check. Then what will you do? You will replace this cancelled check with another new check and perform the audit procedures on that new check. So here, this cancelled check becomes a replacement item. Getting it? Yes. So during your audit procedures, if you find any item selected into the sample to which your audit procedures are not applicable, then you will call that item as a replacement item and you will remove that item from the sample and take a new item into the sample and perform audit procedures on that new item. Clear? Yes. Next, if you are unable to perform the procedure, see, for the selected item, procedure is applicable. Your procedure is applicable, but you are not able to perform your procedure on the selected item. In such a situation, you have to treat it as misstatement. Understanding? Yes, let's say, for example, debtors. So 100 debtors you have selected into sample and you are sending external confirmation. There is one particular debtor whose address management has not given, whose details management has not given. Now for the selected debtor, the procedure of external confirmation is applicable, but you are not able to perform the procedure because you don't have address of that debtor, management has not given. Now you will treat this as a misstatement. Getting it? Yes. So there is a difference between the first situation and the second situation. If you are unable to apply the designed audit procedure, treat that item as a misstatement. Clear? Yes. Next. Now, after you perform audit procedures on the sample, so this is the sample. Now, on this sample, you have performed audit procedures. Once you have performed the audit procedures, you will identify what? Misstatements, correct or not? You have identified the misstatements. Now you need to evaluate those misstatements. See, evaluate nature and cause of deviations and misstatements that you have identified. See, identify misstatements having common features. That means from these misstatements, you need to identify whether any of these misstatements are having common features. Like, let's say all the misstatements are being found only in the sales that are made to Mr. A. Now, what will you do? So, all these misstatements are having a similar characteristic. What is that characteristics? All of them belong to sales to made to Mr. A. Now, what you will do? You will go to the population and you will check all the sales made to Mr. A. Getting it? So, you have to evaluate whether the misstatements that you have identified Are they showing any common characteristic? Okay. Next, if auditor treats misstatements as anomaly, obtain higher degree of certainty that it is not a representative of the population. So if any of the misstatement that you have found, if you feel that it is an anomaly means, I told you that misstatement is there only in the sample, you will not for sure find it in the entire population. Now you have to get 100% evidence, 100% proof that of course it is an anomaly. Like such a type of evidence you need to obtain with respect to anomaly. Okay. Yes. Next, projecting the mistake. So in the third step, what did you do? You have evaluate. See, once we will see all the steps. First of all, you have selected the sample. On the selected sample, you have performed the procedures. After performing the procedures, you identified the misstatements. So you have evaluated those misstatements. Once you have evaluated the misstatements, you will project these misstatements to entire population. So in the sample, there are 5 misstatements. So in the population, how many misstatements can be there? Like this, you will project the misstatements, correct or not? See, that is the fourth step, projecting the misstatement. So for test of details, project the misstatement. So test of details means account balances and transactions. For that, you will project the misstatements. Whereas with respect to controls, you need not project. See, for misstatements, see, with respect to amounts, you will call it as a misstatement. With respect to control, you will call it as a deviation. Now, misstatements will be measured in the terms of monetary amounts, but deviation in the control will be measured in terms of percentage. You will say that there is 5% deviation in the control, there is a 10% deviation in the control. You will not say that there is 1 lakh rupee deviation in the control. How can you give monetary value for the control? Understanding? So, in case of deviation in the control, you need not project the deviation to the population, because if you project the percentage will not change. Okay, in the sample of controls, you identified that there is a 5% deviation. If you project this 5% to the total controls, the 5% will be 5% only, it will not change, correct or not? So with respect to the controls, you need not project the deviation to the population, but with respect to the uh, amounts, that is the test of details, test of transactions, you have to project the misstatements to the population. Next, if there is any anomaly that you have found in the sample, you need to exclude that anomaly while projecting the misstatement from sample to the population. This point I have already told you while discussing the definitions, right? So exclude anomaly while projecting the misstatements. Clear? Yes, sir. And the final step is you will evaluate results of sampling. So I have performed sampling. That does sampling give me proper results, or should I perform more procedures, or should I include more items into the sampling? Like this, you will evaluate the results of sampling. See, whether use of sampling has provided a reasonable basis for conclusions about the population. So this is how you will evaluate the results of sampling. Got it? Yes. That is essay 530. Now we'll move to essay 230. This is the last standard of this particular chapter, right? Yeah, which is nothing but audit documentation. See, this audit documentation, it is very easy and very important. Okay, so whatever the evidences that you have gathered, whatever the procedures that you have performed, all those things need to be properly documented. Why you should document? Because if you don't document, you cannot prove in the future that you have performed this work properly. So to prove to others, others means entity, various authorities, okay, to prove them that you have performed the work properly. You need to maintain documentation. See, if there is no documentation, it means that you have not done the work at all. Okay, so documentation is very much important. See, audit documentation. So, what is the definition of audit documentation? It is record of three things. So, record of what three things? Audit procedures performed, audit evidence obtained, and the conclusions reached. So, audit documentation is record of PEC, procedures performed, evidence obtained, and the conclusions reached. Got it? Yes, sir. Got it. Next, what I told you, each and every standard has its objective. We are seeing those objectives till now. Now, similarly, what objective this SA 230 is having? See, the objective of SA 230 is prepare documentation that provides record of the basis for auditor's report, and audit was planned and performed in accordance with audit. So, the objective of SA 230 is to help the auditor to prepare the documentation that will help him to prove that audit was performed in accordance with standards on auditing, and to also provide a basis for the opinion that he has given in the audit report. So, simply speaking, the purpose objective of SA 230 is to help the auditor to maintain documentation, right? Next, form, content, and extent of audit documentation. So you can get it out, sir. SA 230 is saying that every auditor has to maintain documentation, but in which format the audit documentation has to be maintained? Form. See, form, it can be either physical or of a soft copy. Okay, and content, what should be included in that audit documentation, and extent, how much audit documentation should be maintained. With respect to these two things, content and extent, you have to maintain that much amount of audit documentation which will enable a experienced auditor who is not associated with your audit to understand following these three things. What are they? Nature, timing, extent of audit procedures performed. So, a experienced auditor who is not having any idea of your audit, he should be able to understand by seeing your audit documentation what procedures you have performed. He should be able to understand, and results of that audit procedures performed. So, after performing that audit procedures, what results, what evidences you have obtained, that should be able to be understood by a experienced auditor who is not associated with your audit, and he should also be able to understand significant matters arising during the audit and the conclusions reached. So, what conclusions you have reached should be able to be understood by that experienced auditor by just seeing the audit documentation. Now, you got an answer to what should be the content of documentation, extent of documentation. So, your audit documentation should be maintained in such a way that by seeing that audit documentation, a experienced auditor who is not having a prior connection with your audit understands these three things. Getting it? Yes, sir. Next, why audit documentation is required? There are a lot of benefits because of audit documentation, right? Let's see what are the benefits that you get because of audit documentation. First of all, it will assist the engagement team to properly plan and perform the audit, correct? So, if you document the strategy, plan, and the program, and engagement team also document whatever the evidences that they have obtained, it will help the engagement partner and also engagement team to properly conduct the audit, to properly plan the further audit, right? That is the best, one of the most advantage of audit documentation. Next, audit documentation will also help to direct, supervise audit work and discharge review responsibilities. Review responsibilities means the audit, it will be done by article assistance. So whatever the work that is done by the article assistance, it has to be reviewed by the engagement partner, correct or not? So what will the engagement partner review? the documentation that the engagement team has maintained, that only will be reviewed by the engagement partner, correct or not? So for doing that review, for giving a guidance, for directing, for supervising the engagement team, audit documentation is very much important, correct? Yes. Next, audit documentation also will help to fix accountability for the work. So once the article assistant he has obtained the evidence, he will sign it that he has performed this work. So by signing, you are fixing the responsibility on that person who is signing it, to ensure that whatever the work that he has performed is correct only. In future, if any mistakes are found in his work, you will be able to identify who performed that work, and you can ask the person to rectify it, correct or not? So with the help of audit documentation, you can fix the responsibility, correct? Yes. Next, retaining record of matters of continuing significance. Of course, if you maintain the documentation, you can hold that documentation with you for the future also. Continuously you can retain it, right? Next, enabling the conduct of quality control reviews. So we have the concept of engagement quality control review, that we will be seeing in which standard? SQC1 and SA 220, right? So for the engagement quality control reviewer to do the engagement quality control review, he requires audit documentation. That is also one of the benefit or advantage of audit documentation. Next, enabling the conduct of external inspections. So who will do the external inspections? See, the people like NFRA, people like quality review board, people like peer review board, they will perform external inspections. So for doing that external inspection also, audit documentation is very much important. Got it? Yes. Next, factors influencing form, content, and extent of audit documentation. So, what factors will influence the form, content, and extent of audit documentation? Let us see. First of all, size and complexity of the entity. If the size of the entity is huge, then the amount of documentation will also be huge, correct or not? Next, nature of audit procedures to be performed. So if your audit procedures are mostly technology based, then the form of your audit documentation will be soft copies. If most of your audit procedures are manual procedures, then lot of your audit documentation will be manual in the physical copies, correct or not? So the nature of your audit procedure also impacts the form of your audit documentation. Next, identified ROMM. If ROMM is high, more documentation. If ROMM is less, less documentation, correct or not? Yes. Next, significance of audit evidence obtained. So if the evidence obtained is more important, you will preserve it in a more safety fashion, correct or not? Yes. Nature and extent of exception identified. So if there are more exceptions, more misstatements, then you will obtain more evidences. Next, need to document a conclusion and audit methodology and tools used. So all these things will impact form, content, and extent of audit documentation. Next, now there are certain things that need not be kept in the audit documentation. So what are the things that need not be kept in the audit documentation? Let us see. Audit documentation need not include superseded drafts of working papers and financial statements. So before you prepare a final version of a financial statement or a document, you will be having various draft versions. Those draft versions need not be kept in the documentation file. Understanding? You can discard them. Next, notes that reflect incomplete or preliminary thinking. Certain working calculations you would have maintained, right? Which need not be kept in the audit documentation. Those are just preliminary thinking purpose. That thinking you would have kept in a final version. Okay, if that final version is available, that preliminary thinking and Notes which are incomplete need not be part of audit documentation. Next, previous copies of documents corrected for typographical or other errors. So, in the audit documentation, while preparing them, there can be some spelling mistakes. To correct those spelling mistakes, you would have prepared another correct version of document. When you have that corrected version of document, the previous document that contains spelling mistakes, it need not be kept in the audit documentation. Got it? Yes. Next, duplicates of documents also need not be kept in the audit documentation. If you keep the original documents, that is sufficient. So all these four things need not form part of audit documentation. Next, matters arising after the date of auditor's report. See, if new audit procedures performed or new conclusions are drawn after the date of auditor's report, auditor shall document the following. See, generally, once the audit report is issued, you will not perform any audit procedures. But if any circumstances have arisen because of which you have to perform audit procedures even after issuing the audit report, in such a situation, you have to document what are those circumstances because of which you are forced to perform audit procedures after issuing the audit report, and new or additional audit procedures that you have performed. So what are such new additional audit procedures that you performed after the date of audit report? You need to document, and when and by whom the resulting changes to audit documentation were made and reviewed. So these things you need to document if at all you are making audit, or if at all you are performing audit procedures, some of the audit procedures after the date of audit report. Got it? Yes. Next, certain specific documentations as required by SA 230. So, as per SA 230, every auditor has to mandatorily keep these particular documentations. So, what are those documentations? Let us see. First of all, nature, timing, extent of audit procedures, and also record the following. So, every auditor, this is very basic, right? So, every auditor, he has to document what is the nature, timing, and extent of audit procedure that he has performed. See, nature of audit procedure means whether it is external confirmation, whether it is inspection, whether it is observation, whether it is reperformance. So what is the nature of procedure you have performed? You need to document it. Next, timing. At what time you have performed that audit procedure? That also you need to document it. Next, extent. Extent means on how many items you have performed this procedure. That also needs to be documented by you. So you need to document nature, timing, and extent of audit procedures that you have performed. And you should also record the characteristics of the items on which you have performed the audit procedure. See, you should also document characteristics of specific items or matters that have been tested. Let's say, for example, you are testing debtors value exceeding 2 lakh rupees you have tested. So you need to document the characteristics. So value of debtors exceeding 2 lakh rupees that has taken place between so and so dates, we have performed audit procedures. Like this, the characteristic of the item you need to document. Okay. Next, who performed that work and on which date that procedure was executed, and who reviewed the audit work and the date on which that audit work has been reviewed. So all these things you need to document. Got it? Yes. Next, discussions of significant matters with management, those charged with governance, and others. So with management, those charged with governance, and others, if you have discussed any of the significant matters, you should also document all those significant matters. Next, if information is inconsistent, information inconsistent means, see, let's say example, debtors. I have already told you this example. Debtors, sale invoice of debtor is showing 10,000 rupees. You sent external confirmation to the debtor. The external confirmation from the debtor you received as 20,000. So now there is a inconsistency between these two things. How did you resolve that inconsistency? That also should be documented by you. See how the auditor addressed the inconsistency. Clear? Yes. Next, audit file. So what is meant by a audit file? See, all the audit documentation related to a particular audit engagement. If you collate them and keep them together, that becomes a audit file. See, one or more folders containing records that comprise audit documentation for a specific engagement of that particular year, you will call it as audit file. Next, timeline for documentation. See, audit documentation should be completed within 60 days from the date of audit report. So if the date of audit report that you have given is 1st of July so and so date, then from this within 60 days you have to finalize the audit documentation and keep it. Getting it? Yes, sir. So 60 days from the date of audit report. Next, retention period. So this audit documentation that you have maintained, for how much long you have to retain it? It is 7 years. 7 years from when? 7 years from the date of audit report you have to retain the audit documentation. Getting it? Yes. Next, certain administrative changes you can make even after the 60 days also. So what will be included in the administrative changes? Some of the examples: deleting or discarding superseded documents. Superseded means certain draft versions. If by mistake you have kept them in the audit documentation, you can remove it even after 60 days, no issues. Next, sorting, collating and cross referencing the working paper. So sorting the working papers, all the documents relating to particular item, taking them and pinning them, or cross referencing the documentation. This thing is an administrative change which you can do after 60 days also. Next, signing of the completion checklist. Signing of completion checklist means, see, in the audit documentation file, so this is the audit documentation file. So in this file, what are all the documents should be included? For this, there will be a checklist. Understanding? There will be a checklist of what documentation should be included in the audit file. Now, signing of this checklist, that means checking whether this document is there, whether this document is there, whether this document is there. That can be done even after 60 days also. That is also a administrative aspect. Understanding? Yes. Those are some of the examples of administrative aspects. Next, ownership. Who is the owner of audit documentation? Of course, the auditor is the owner of audit documentation. Correct or not? Yes. So this is discussion of yes they 230, right? So you know what to do. If you like this revision, you have to motivate me by mentioning the words the best lecture. Got it? Yes. So by this we will be completing the first part of marathon session. The remaining chapters revision you can find them in the second part of marathon session. Got it? Yes. So see you. We'll meet in the second part of marathon. Until then, take care. Bye bye. See you.